Good morning. We are super happy to welcome you here at the Conference.Exchanges. We are super excited. This morning, the 5th of March, the third edition of the Conference.Exchanges is happening right now. So thanks once again for coming, for your time. We have an amazing day today, 7 hours that is dedicated to DeFi exchanges, trading, everything that is connected to crypto world in 2021. So let me introduce myself. I'm Natalie, and I have small but very brave team that is somewhere around me, behind me. It's Anna and Bogdan. And if you have something to tell us, if you have any comments, any question that is related to our event, related to our speakers, you are free to find our Telegram group. You can find it at our website, and there must be a link just right now on your screen. Feel free to contact us if you have any questions. You have also our chat that is happening right now at our link on YouTube. So feel free to ask any questions that you have to our speakers, to moderators, to our team. So let's start. I would like to recall 1 year ago, the 5th of March, Amsterdam, we were having our second edition conference, offline, of course. And we would love to be just right now in Amsterdam, having you all guys offline, networking, having fun, discussing different topics. But unfortunately, we are right now in our small studio, and you are probably, I don't know, at home. Just text us. Where are you guys? Are you at your workplace? Are you at home? Where are you? And we'll find out. Plus, another question: where are you based? We know that probably for the US guys, it will be a little bit early to connect, but still. So probably you are right now in Europe, Asia. I don't know. Tell us. Last year, it was our second edition, the Conference.Exchanges in Amsterdam. Before, the previous year, we had in November our first edition. It was a meetup in Singapore during Singapore Fintech Week. It was amazing. The main idea of that meetup was basically pretty simple. We wanted to grab exchanges. We wanted to invite, and we invited basically our friends, traders, regulators, exchanges. But in November 2019, it was mostly centralized exchanges. Previous year in Amsterdam, last year in Amsterdam, we had lots of fascinating speakers, lots of incredible companies. And this year, it's a little bit different edition. It's DeFi-Edition. What is it all about? So let's just, during this year, lots of things changed. The way we live, the way we network, the way we work, the way we communicate. And of course, crypto market 2021 is a little bit different right now. Mostly, we need to say thanks companies that is work in DeFi industry. What is DeFi industry right now? What is crypto world today? What is crypto exchanges in 2021? How do you exchange crypto to traditional money? How do you see the future of crypto market today? These topics we're gonna raise today, and I hope that we all got some answers because we have an incredible lineup today. We tried to grab amazing companies today. So agenda for today is, we have how many? 6 sections. So first section will be more general. It is about crypto world today. What do we have? We have few speakers, amazing speakers. We have discussion panels. We have single speaking slots presentations. Second section, of course, it's DeFi market. What is it? What is it all about? We have amazing companies over there. Third is DEX and SEX. What is it? We have also presentations. We have discussion panels. It's amazing. This section is fantastic, really. We have section number 4. It's about trading. We have probably the most interesting traders right now in this section. Amazing section. We have security frauds. We have regulation and legal issues today. So you can find our agenda. You can find our schedule just on our website. Follow it. We try to follow our agenda. We try to follow our schedule. But of course, we can have some like minor problems, drops. So it's fine. Just follow our schedule and everything will be fine. We want to say thanks to our sponsors. It's, as you can see on the screen below, it's Crypto.com, our platinum sponsor. Bitstamp is our general sponsor. Nash, title sponsor. Acquia Network and Itez. These companies will have something to say to you today, so stay tuned. We really want you to enjoy this day and enjoy our agenda. So let's move on. And let me introduce our first speaker. It's our sponsor, Crypto.com, Teana Perez. I hope you enjoy her presentation. Her topic will be mostly about their exchange, but of course she has some interesting insights to share it with you today. So if she's here, I want to give her our floor, and I'm happy to introduce Teana. Are you here? Teana? Oh, she's here.
Hi there.
Okay. So I'm giving you the floor. Please feel free.
Excellent.
20 minutes is yours.
Sure.
Let's do it.
Good stuff. Excellent. Hi, everyone. Pleasure to be here again. It's been a couple of years now, so it's always lovely to be back, even during such testing times. So I'm Teana Perez. I'm the SVP of the institutional sales at Crypto.com. I oversee the expansion of our exchange platform. And with that, again, just an absolute pleasure to be here, and I'll give you an introduction of just that. So before getting into the exchange and the wider Crypto.com ecosystem, it's certainly noteworthy to touch on the traction and adoption that we're seeing in our industry today. So we're now part of an industry that boasts 100 million users and with a market cap of over 1.5 trillion and growing. And whilst this is somewhat inarguably compared to the global population and equity market caps, so on and so forth, just imagine where we'll be in 5 years' time. The growth and opportunities in this space are absolutely tremendous. And we certainly, as a firm, as part of the wider industry, hope to be at the forefront of the next financial wave of change. Many of us that have been here, whether from 2016, 2017, we've seen endless amount of naysayers recently turn to compatriots, doubts being cast aside as our industry definitely sets the shape of future finance. From Goldman to JP Morgan and beyond, the impact of our industry has certainly been undeniable. We've seen companies such as PayPal entering the space, and it's no small feat. We're talking about potentially 346 million active accounts potentially accessing crypto, not to mention potentially 26 million merchants globally through that incorporation alone, as well as players like MicroStrategy holding over 90,000 Bitcoin, a huge number and an even huger nod to our industry. We're certainly in the right place at the right time. And of course, lest we forget, Mr. Musk himself with Tesla acquiring $1.5 billion in Bitcoin. And why does that matter? It matters because, in the words of Elon himself, Bitcoin is on the verge of mass adoption. And we're proud to say that we've been here from the start, and we're definitely ready to bring crypto to every wallet. So that brings me on to Crypto.com. So at Crypto.com, we believe that it is your basic human right to control your money, your data, and your identity. And so we're of the belief that blockchain is the tech that safeguards human rights and essentially building upon that. We believe in accessibility to funds anytime, anywhere. We believe in controlling our data and enabling you to do so. And of course, we believe in protecting not just ours, but your identity. So it's with that belief that we push forward and expand on our ecosystem to build upon our core beliefs.
You, Diana, we cannot see your presentation. Can you share the screen, please?
Oh, apologies.
It's okay.
Apologies, guys. So yeah, here we are. So essentially, what I just touched upon was the Crypto.com belief and essentially what we're building on. So yes, in short, we are of the mind that it is your basic human rights to control all of those that you can see and that I've just mentioned: data, money, and identity. And so with that, our goal is, of course, to put cryptocurrency in every wallet. So across our ecosystem, we're working to redefining how money is transferred, spent, and invested one innovation at a time, and always with the end user in mind. So we're constantly working to design sleek and user-friendly financial services with a positive and hopefully long-lasting impact. So when we look at our solutions, so apologies, you'll see that we're covering a wide array of solutions in this space. So on the payment side, we have what we're extremely well known for, so our Visa card. So this is a card that enables you to transfer between fiat and crypto and spend at will whilst receiving cashbacks. And of course, we have Crypto.com Pay, which is powered by Crypto.org chain, enabling you to pay merchants while simultaneously receiving rewards and purchase on your purchases also. And alongside that, we of course have something that I suppose I would fall under is our trading solutions. We have the Crypto.com app, again, similarly something that we're very well known for alongside the Visa card, which allows users to manage, spend funds with the Visa card, as well as accessing other in-app perks such as Earn. I guess something I tend to liken to a crypto savings account. Very cool features that I've definitely recommend testing out. And so within the trading umbrella, we of course have Crypto.com Exchange. So here you're able to access some of our more advanced trading solutions, such as spot trading with very low fees and deep liquidity, margin trading with 3 times leverage, and our newly launched derivatives trading platform. And this is, and I very proud to say, this is definitely boasting one of the fastest engines in the space, coupled with ultra low latency. It's one of our new launches and one I'm very excited for. But moving on to our solutions overview. Lastly, and certainly not least, we have our financial services offering, so Crypto Earn. So this is something that allows users to earn interest on over 30 cryptocurrencies and stable coins. So whenever you're depositing coins for an agreed set amount and term, you're able to gain interest on that deposit. And we also have a crypto credit that empowers the users by accessing credit limits that they want and need as opposed to what they're given. Again, really kind of building upon this, safeguarding of human rights and empowering the end user and allowing financial services to work for you. So here you're able to essentially monetize your assets without having to sell them whilst paying back at a schedule most suited to you. Again, really kind of building on what's been our core belief and continues to be since inception. The belief is that we're trying to empower users and enabling individuals to control their assets. And of course, our solutions are created with that in mind all the time. So wrapping up our financial services offering, we have our DeFi solutions. So from a fully decentralized wallet, granting you full control of your keys, to earning interest on DeFi protocols, as well as our swap offering, where users are able to farm popular DeFi tokens. So with this brief summary of our services, I hope that it's apparent that Crypto.com is more than just one solution for one client or one problem. We're a crypto ecosystem. And with that, we have tasked ourselves with becoming somewhat of a one-stop shop or an end-to-end solution, if you will, for all of your crypto needs. Which brings me to a solution dear to my heart, of course. So Crypto.com exchange. So Crypto.com exchange is a little over a year old and is currently boasting an average of around 200 million US dollars in daily volume across Bitcoin, USDT, and CRO markets. So our exchange builds upon our native solutions and network in the sense where it kind of presents an advanced platform to our existing user base to trade and obtain leverage in crypto. We're proud to boast very robust liquidity and an institutional grade infrastructure. So on the exchange, you'll essentially access best execution prices and liquidity with extremely competitive fees, if not completely free for those that opt to stake CRO. And as previously mentioned, on the exchange, you will be able to access spot trading, margin lending services, as well as the previously mentioned derivatives platform. And here we are. So the derivatives platform is somewhat new, probably less than a couple of weeks old. And it's currently live with BTC USDC perpetual contract using USDC as margin and 50x leverage on one of the industries, and I do not say this lightly, most robust and fastest engines. And I kid you not, it really is. Definitely something worth trying out if you're into derivative trading. And so at the moment we have the one pair with more coming week on week. So definitely watch this space. So another offering that launched earlier this year on the exchange and has had huge success is the VIP program. So this is a program that has had tremendous traction with our users and wider network. So here, VIP clients who trade a minimum of 1% of the exchange's monthly volume are accessing exclusive incentives and perks. So that's anything from trading fees to beta testing new products before official launch, as well as designated account managers and tech support, plus perks that we're constantly kind of revamping and relaunching. So yeah, definitely one to tap into if you are to consider yourself a VIP trader. And so at Crypto.com, I would say we definitely work hard to answer the calls of all users. And I mean that figuratively as I mean literally. And we definitely roll out our solutions with the end user in mind, aiming to cater to every user. So we definitely look at kind of building on our existing kind of bread and butter, so to speak, our retail users. So the retail users of the exchange receive retail-only benefits, such as some of the previously mentioned VIP perks, as well as on-exchange interest via soft staking services. And we also boast a very generous referral program that rewards users with bonuses and commissions for each successful referral, as well as new user promotions and incentives. So our retail users are also lucky enough to access other services on the exchange, such as discounted token allocation through the syndicate, as well as mining DeFi tokens by depositing CRO on Supercharger. And again, whilst we are tirelessly working to roll out a sophisticated trading venue, the goal is to continue catering to and nurturing the 10 million users across our ecosystem. So making our exchange as accessible as possible to those users in our wider network is definitely always at the forefront of our goals. And so with that said, and something that of course my team is particularly focused on, we also provide our corporate user base with an institutionally friendly exchange platform, catering to their specific needs. So Crypto.com exchange, as I've mentioned a couple of times before now, boasts a robust API and WebSocket server. And with that, our institutional users are able to benefit from fast settlements and transactions, as well as increased rate limits, enabling them to go to market with minimal friction. And as with everything, we always like to reward our users and incentivize them. So our institutional clients are absolutely no different. Market-making discounts and incentives are available to select participants on the exchange, as well as attractive credit lines in select currencies with minimal interest rates. On top of which, our clients also receive dedicated technical support, as well as round-the-clock support from my team. So yeah, so since inception, Crypto.com exchange, and I would say all the products, but seeing as we're on the exchange, that's what we'll touch on, has certainly undergone continuous improvements across performance, scalability, and resilience. So we work tirelessly with our clients and partners to improve daily. It's not just only internal initiatives where we decide what we think needs improving. I think engaging our wider network and especially our users is definitely something that we're good at, and we aim to definitely kind of keep our ear to the street, so to speak, and roll out as many improvements as we can with the end user in mind. So with that said, we actually have delivered on improvements that have seen some solid and improved transactions per second, with latency as low as 50 microseconds, and eliminating any single points of failure, with more to come as we scale. And I don't say that lightly. The goal is to constantly improve, and we're doing just that. And so I bring you to, our global reach. So an ever expanding one at that. So with a high number of trading pairs across Bitcoin, USDT, and of course, CRO pairs. And it's definitely something that we're constantly working to add on. So our markets will definitely be very well covered as we grow and expand with our users. And so this brings me to one of our most recent announcements, exciting partnership with the Aston Martin Formula One team. So in celebration of that, alongside our new partner, we've launched a derivatives trading race. So those of you that wish to participate from March 4th to April 1st stand to share a reward pool of $200,000, some Aston Martin Formula One co-branded prizes alongside us, and many more perks. And some I'd probably say money definitely can't buy. So I would definitely tune in, I would if I could, into the trading race. So certainly if any of you are interested, please don't hesitate to get in touch throughout the conference, and happy to share more information. And so with that, I leave you with some of our global reach stats. So numbers that truly, truly reflect the efforts and output of our team as more than just a company, but a team of, certainly, I consider, individuals that are dedicated to changing the way the world interacts with cryptocurrency. I'm definitely fortunate enough to be building alongside some of the industry's most gifted and dedicated professionals, and certainly with some of the industry's most loyal and amazing users, clients, and friends. So thank you very much for tuning in. And that is Crypto.com Exchange.
Teana Baker-Taylor, SVP Crypto.com, previously AVP at Okex and head of OTC sales at B2C2, Teana oversees the institutional sales efforts at the Crypto.com exchange.
Hello once again, Teana. Very interesting presentation. I really learned a lot, so thanks once again. I also really hope that you enjoyed it too, guys. So if you have any questions to Teana or to company Crypto.com in general, you feel free to ask questions that you have to Teana or to Crypto.com. We have just below the section for your comments. So please feel free to send us to text questions, but we will ask them in our panel discussion. We're going to have another speaker from Crypto.com. It will be Teana Baker-Taylor. So just after this speech, discussion panel goes. The name of it is Crypto World in 2021. So we have amazing moderator. It's co-founder James Simpson, co-founder of mStable, James Simpson. We have participants. It's Kraken, Bitstamp, Nash, Okex, and Crypto.com, of course. So once again, guys, if you have any questions, just after this discussion panel, we'll have like 5 minutes, maybe 7 minutes for your questions. we'll take them. Moderator will ask our speakers those questions from chat that we have just below in after the comments on YouTube, or we can grab some questions from our Telegram group. If you are there, just tag us, or tag me, or tag Anna, and we'll just forward those questions to moderator. So I hope our participants of this discussion panels are ready. We hope that moderator James is also in our hidden room. So let's go. Discussion panel, Crypto World in 2021. Hello, guys.
Hello.
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 Hi there.
It's quite the dramatic entrance, by the way.
No, it's absolutely fine. We are still waiting for our moderator. So maybe just you can introduce yourself, guys, like two sentences about you, the company that you represent. Because again, James is somewhere around, so probably he'll looking for some good connection of internet. So please feel free. Once again, we welcome you here in discussion panel. Let's start. Any? Chris, you.
Yeah, I'll start. So Chris Aruliah, pleased to be here. I head up business development at Bitstamp. I've been at Bitstamp a couple of years now, and prior to that, I was with a company called Token. So I've been on the crypto journey probably for the last 5 years or so, and really, like I said, happy to be here.
Okay, Quentin, great.
Hi, this is Quentin from Okex. I lead the, yeah, can you hear me? Yeah, I lead the,
Yes,
here. I lead the business development of Okex for Europe and US.
Okay, Teana.
I am Teana Baker-Taylor. I am the UK General Manager for Crypto.com. I lead our UK market strategy, operations and regulatory affairs. I have previously worked for Binance. I used to lead a global regulatory advocacy organization called Global Digital Finance. And I've been in the crypto space for about 5 years now.
Okay, great. Thank you, Maximilian.
Yeah, nice to meet everyone. My name is Maximilian. I'm the head of banking and payments, amongst other things, at Kraken Exchange. Been with Kraken for 3 years and a few months now. And before that, I used to work in banking in the Netherlands. I'm excited to be here.
Thanks.
Hi, my name is
Nash,
Kellogg.
our sponsor. Hi.
Yeah. Hi, my name is Kellogg Fairbank, and I'm from Nash. Incredibly excited to be here. I have been in fintech for more than a decade. I know I look young, but I am actually a little bit older than than you might think. I'm just joking, by the way. And so I've been in fintech. I've worked for companies such as PayPal, Braintree, and Venmo, and now Nash for the past year.
Great. So our moderator is here. We are really happy to see you here, James. So I'm giving you the floor. Please feel free to ask any questions that you have.
Thanks very much. Sorry, I was a bit late to the call. I had timed it to get here at 22, but I think we're a bit ahead of schedule, so apologies for that. Personally, I'm very excited to be moderating this panel today. As background, I'm co-founder of a DeFi protocol called MStable. We unify pegged assets and try and optimize them for our users in terms of efficient trading between same peg assets, as well as creating metastable coins with that are kind of have the best risk return profile possible in terms of the native yield they receive, but also some security mechanisms built in. I'm kind of an outlier here. I think everyone on the panel is from top tier centralized exchanges. So I'm really interested in kind of discussing with the panel today some questions related to CeFi, the kinds of offerings that CeFi has that DeFi doesn't have, and kind of digging into the relationship between these two ecosystems.
James, I'm just going to correct you. I'm just going to correct you very quickly. This is Kellogg from Nash. Everyone is centralized here except for Nash. We are decentralized.
We also have a decentralized platform too, so a little more balanced than maybe we initially thought.
Same for us. We have a decentralized one as well. Well, so it seems like there's kind of it's not quite either or. There seems to be kind of offerings on both sides. Perhaps we could start there then. Kellogg, could you kind of just explain your offering and how it kind of relates to DeFi?
Sure, absolutely. So I think Nash has been around since the idea first came around in 2017, and in 2018 we had the first security token offering in Europe. We raised 20 million in the STO and then 10 million from leading blockchain VCs. I think, and where I'm getting at is that we were founded on the principle of being a decentralized exchange, non-custodial. And we've noticed that we've seen over the past 2 years of building and putting our exchange out onto the market, we haven't really seen the engagement that we were looking for, and so we've really transitioned into more of a so-called crypto first bank, if you will, right? So what we see is we're a non-custodial wallet, if you will, but we allow for we bridge the gap between crypto and your local currency. So essentially, our crypto cash exchange service combines low fees with instant delivery to a very secure, safe wallet.
Thank you. And Crypto.com, I know you have a kind of an AMM implementation as well. Interested in understanding your decentralized offerings.
Yeah, so Diana was on before me, so I don't want to necessarily kind of rehash the whole thing, but Crypto.com has a platform or an entire suite of services. One of those is a DeFi platform, which enables a number of financial service offerings within that, which kind of complements the app that we have, the exchange, our card, and a number of other kind of financial services around earning yield, etc. So we are really an ecosystem builder, and we're focused on putting in place the access for people to join crypto asset participation in a variety of different ways. I think we've seen a lot of interest in DeFi over the last year, especially in the last 6 months, and I think that's really driven by one, some experimentation for sure, and two, the ability to kind of create new market pools, new liquidity pools that kind of react differently than your traditional order book environment. Things like reduced slippage, et cetera, I think are driving some of the trading activity that we're seeing in the DeFi space, especially in our environments.
Great. And finally, I would love to hear from Okex. I understand that there's a move to create OK Chain. Would be interested to kind of hear about how Okex is positioning itself in the DeFi ecosystem.
Yeah, sure. So the strength of Okex is really lies in its derivative platform, where we have a very strong retail, institutional participation. And I think, the question of centralized exchange versus centralized, it makes sense if you consider especially derivatives, where you need to have like a very strong risk management framework and technique that are difficult to implement on decentralized. On decentralized exchange, what it's great is for innovation. It's to be able to launch lots of new projects and to iterate quickly. And it's very interesting as a first step for like new protocols to list and to build their community. And that's why we want to do as well. We want to attract new projects on our OK chain, so they can build up quickly and try their UX, try their user engagement. And hopefully there will be a bridge as well to our centralized platform later on.
Thank you. I might move on to Maximilian at Kraken. You guys obviously were one of the first Bitcoin exchanges, and I'm interested in kind of understanding how you see a CeFi being positioning itself in this kind of DeFi environment. I might be kind of a biased participant, given that I work in DeFi, but I'm interested in understanding what Kraken and centralized exchanges can offer that DeFi can't.
Yep. I mean, there are several aspects to it. First of all, I think we can all agree here that there is an increasing interest in DeFi products from various types of customers, right? The traditional financial markets cannot, offer what they used to offer to investors, so they look for alternatives. And we at Kraken, we definitely see that as well. That's why we are starting to list more and more of these DeFi assets on our exchange, so that people can, at the very least, get some sort of a staking return, primarily. Right? We definitely see that as arguably one of the biggest trends of this year. When you ask me now about pros and cons of centralized versus decentralized exchanges, that would probably go beyond the 40 minutes that we have here. But I think, my perspective, there's room for both in the market. Depends on your preference as an investor, depends on a product, depends what you look for. Of course, a centralized exchange has certain advantages of being able to offer high liquidity, access to various fiat currencies, etc., etc. But again, this depends heavily, from my point of view, on what you, as an investor, as a customer, look for. Right? So there is no right or wrong answer from my point of view.
One thing that I think centralized exchanges have a real edge on is dealing with institutional players. I don't think that a large institutional player or companies like Tesla, for example, I don't think they bought their Bitcoin on Uniswap. I don't think they bought wrapped Bitcoin on Uniswap. So interested in hearing from Chris and Maximilian and Quentin, perhaps on kind of institutional purchases of Bitcoin and Ethereum and perhaps other DeFi assets, and how you guys are positioning yourselves on that front. With particular kind of reference to whether we've seen an uptick in institutional interest in 2021.
Yeah, I can add something there. It's what I mentioned earlier. I think to understand the difference, it's you have to consider, first of all, derivative versus spot. Currently, it's pretty hard to true derivatives on DeFi, even though there is a couple of interesting protocols that are trying to build a perpetual swap, for example, or even options. But to have a good in the derivative market, you need to have like market makers. You need to have a lot of institutional players. Spot, on the other hand, a lot more can be done on DeFi. And you can have this interesting innovation that was done on the automated market maker, the AMM. It works pretty well to get liquidity, and actually institutions as well are starting to be more active on DeFi project, for example, such as Aave. So I think the boundaries is a bit more different now. But again, spot versus derivative is an interesting framework to consider the differences, I believe.
Yeah, and I think just to add to what Maximilian said as well, and to answer the question on institutional, James, certainly what we're seeing right now in terms of the rally, at least the uptick in the volumes, is mainly driven by corporates. The level of retail demand has also increased, but certainly not to the levels of 2017. And it's certainly being driven now by corporates. And the reality is that corporates look for a certain makeup of institution that they can trade with, and they require that from a counterparty risk perspective. So, regulated, liquidity, etc. But that's the perspective from the corporates. You mentioned the likes of Tesla and MicroStrategy. Those orders are coming into the market, through regulated venues, but also being split across those regulated venues given the size. And that size of order, that we're all seeing has increased massively. Obviously, it's public in terms of the purchases from those companies. I do agree with Maximilian on the point of CeFi versus DeFi. One of the things I think the great thing with our market right now is the tremendous amount of innovation that we're seeing. And in the DeFi space, that innovation can advance at pace. And I do think it's a combination of both that really is the exciting part for us, where essentially what you're seeing happening is the development of a parallel financial system, with the option for different participants to go down different paths, or even to go to vendors that could offer both. So it's just a great time, I think, that we're seeing in our space right now.
Thanks, Chris. I mean, definitely agree with you with what you said. Also, we see on our end, an increase of interest from institutional customers, and it can be everything, right? It can be family office, can be hedge funds, can be money transmitters, can be investment banks or smaller private banks. We see a wide interest, an increasing interest in this space, in this new asset class, and both on the spot side, but also especially on the future side at Kraken. It's going very well.
Yeah, and I think as well to add to that, and also to what Quentin said, the option of spot and derivatives, as we see, obviously in the crypto space, we see a number of derivatives players and venues, but we're also now seeing institutions come in, right? So Goldman trading crypto derivatives now, and we're certainly seeing, when we talk to institutions, that there is the question around spot and futures and options. So this we see as an area of the market that will grow tremendously, particularly as traditional institutions come into the space.
James, can I just add to that around the infrastructure piece? So I think one of the main differences that we're seeing at the moment between CeFi and DeFi is we're in the DeFi space, kind of where we were potentially 3 years ago in the CeFi space, that there is interest, which is clear, and the infrastructure might not be completely ready in the DeFi space. And, it's absolutely not. We're still in the test and learn and evolution stage, where we're experimenting. So one of the things that, we have done recently is launch a fund, so Crypto.com Capital, which will help to incubate and provide funding for projects that are looking to build on our mainnet, Crypto.com chain, but really to help the ecosystem build those products and companies that provide ancillary services in the DeFi space that potentially can provide more robustness to the infrastructure. So I think we'll start to see more of those interested parties at the institutional level get involved in DeFi once some of the infrastructure challenges are resolved. I think the other thing that's potentially holding some of those, institutions back, whether it be family offices or hedge funds, et cetera, is we still have some smart contract issues. And so, until those are resolved and, there's a more certain way of kind of validating that smart contract has been road tested, we're going to continue to see, some snafus in the DeFi space that I think would be less, reduces the risk appetite, I think, for an institution to get involved as deeply as they might want to today.
Yeah, I think I'd be interested to kind of touch on the way that CeFi is relating to DeFi and how that could potentially change. So right now it seems like they're two pretty distinct ecosystems, even though there's obviously the players on this call have kind of pretty significant interests in both. Is there a world where CeFi is a compliant front end to DeFi? Is that a world that the CeFi players on this call are potentially envisaging?
Well, I think from the compliance,
sorry, go ahead, Teana.
Sorry. From the compliance standpoint, I think you raise an interesting point. So we, again, DeFi being new, we're in the middle of, getting more clarity from the CeFi perspective, from a regulatory perspective, right? And so now we're seeing a lot of questions from regulators and standard setters globally around how they should be thinking about or potentially addressing any consumer risks as related to DeFi. Today, DeFi, one of the benefits and the attractiveness of it is that anyone, anywhere can participate at any time, right? It's completely decentralized, where in the centralized space, most of us are operating in jurisdictions that require us to do a significant amount of KYC, which doesn't today apply in this DeFi space. But certainly for players like Crypto.com, who have a cross section of business in a number of different areas and platforms, that becomes a concern when you're looking at your business risk overall. So I don't know if there's going to be a way to kind of put a front end onto DeFi, and whether or not that's something that is helpful or harmful when looking at DeFi from a centralized perspective. I'd really like to hear Chris's view on this one, actually.
Yeah, I think on this one, it's an interesting one, really, because we face, from a centralized perspective, we do face that challenge of, if we're connecting to a counterparty, what does that regulatory framework look like? My personal feeling is that what might happen is that aspects of DeFi could get absorbed into the CeFi space, or there could be partnership elements that emerge. Whether it becomes a front end necessarily, don't know. But from a CeFi perspective, certainly we look at what's happening in DeFi and the innovation that's happening there, and the big question we have is, how can we participate and how can we utilize? So if we can find models that allow us to do that, if it is a front end onto it, so be it. I suspect that regulatory wise that's not possible, but certainly we'd look to see what options are open. But definitely it's some kind of ability to absorb that innovation.
Yeah, thanks. That's really, really interesting. Would be interested to hear from the panel more more views on the regulatory direction of crypto in 2021. We've had such success in the past 12 months, but I think with success comes more regulatory oversight, and that's not necessarily a bad thing. So interested in just where the panel thinks major regulators around the world, potentially specifically the EU for Bitstamp and the US for Kraken, where where the direction is going.
Yeah, I mean, maybe I'll kick off. You know, as we see happening, regulators around the world are more and more interested in this space, and rightly so. And we welcome regulation. You know, regulation is something that is good for the market. We will see more of it. Obviously, in Europe, we've got the MiCA regulation coming, which is equivalent to MiFID, essentially. And all of us that participate in Europe will have to prepare for that. We already are subject to anti-money laundering regulation via the VASP regulations in Europe, so Virtual Asset Service Provider. And so certainly regulators are going to add more to us. It's welcome. Particularly, I think the next step is consumer protection areas. And as the market grows, and you know the size we're at now, there is obviously going to be more regulation coming in, which I think all of us you know accept is welcome.
Yeah, no, I totally agree, Chris. I couldn't agree more with you. In fact, with what you just said, if you look at the history at Kraken, we always have been, you know, the forefront of regulation, and I also agree that it's important. It gives confidence into the market. It generates more trust, it generates more oversight, and it leads to, you know, wiping out all the bad players in the market, which I think we all agree here is good for all of us. We definitely see also that there is an increased interest of regulators in various countries across the world, not only Europe and the US, but across the world and other countries that are getting into the space, that are thinking about it. And, you know, I think the days of the wild west of crypto are a little bit gone now. Some people might be sad about it, others not. And I think that this is definitely something that will continue in the future, right? I mean, we at Kraken, last year, we got our SPDI license in Wyoming, for instance. We got our futures MTF license in the UK. And this is something that we will continue, right? Regulation is not something bad. It can be something very good. However, a little addendum here, I think it needs to make sense. Right? Regulation just for the sake of regulating something, I think is not the right thing to do. But if there are regulators out there, which there are, they think about it and really want to construct a good, fair framework for all, let's call white collar or good participants, then that's absolutely something we support everywhere.
I have to agree with that as well. I mean, you know, Nash has worked with regulators since 2017, right from the start, and continue to do so. And we are fully compliant here in Europe, and believe that it helps to legitimize digital assets, right? And I think that bringing that clarity, you know, is good for the industry.
I think from a regulatory perspective, MiCA is going to be very powerful in that it will be one of the first regulatory regimes that covers multiple countries, right? So if we're looking at all of the EU member states ascribing to a similar regime, that starts to level the playing field for all of the players in Europe and people transacting in and out of Europe. And I think there's a little bit more alignment too with other jurisdictions across jurisdiction, which has been a challenge. One of the things that from a global perspective, regulators originally had a strong concern around AML, and we've seen that addressed, at least in theory, by the FATF recommendations and the rollout of AML regimes to most of those member countries. What regulators are looking at now, I think we're kind of getting into the nitty-gritty of more complex issues like how are unhosted wallets going to be addressed, previously off the table, now coming back into discussion, things like DeFi. And one of the key things, I think, as we start to mature in the market, regulators are looking at market integrity. So things like market manipulation and front running, et cetera. Whilst we've got kind of the big issues out of the way, and we're starting to see some more collaboration across jurisdiction, which will make global participants like Crypto.com and everyone else on this panel breathe a sigh of relief that we're kind of getting some framework in place so we understand the rules of the road. I think regulators are now more experienced, more educated, and they're going to start going deeper into actually how we operate. I would expect that to come.
Thanks for those answers. It's obviously an evolving landscape, and I'm interested to talk about kind of touching on regulation, but also stablecoins. So obviously, stablecoins are kind of my bread and butter. Interested to touch on USDT. A lot of particularly non-crypto people I've noticed are really concerned about USDT and the kind of risk that a failure in USDT could pose to the Bitcoin markets. Most DeFi and other crypto native participants, in my view, seem less concerned about it. There's a recent ruling in New York that kind of bolstered the legitimacy of Tether even further. Interested in your view on USDT and how that asset could pose potential risks to the crypto markets.
Maybe I'll jump in on this one. Yeah, I mean, I think USDT is a tough one because depending on which side you're on, traditional finance does look on it with a lot of scrutiny and a lot of questions. It also, because of that, makes it harder. We don't list USDT, and you know, there are reasons for that from a regulatory perspective. But it does form a part of the market, an important part of the market, and you know, on one side, you know, in terms of the on and off ramp into certain exchanges, it is quite important. So I think you know, the questions around it, you know, it's good that they're resolved, whatever route that's through. And obviously, you mentioned the New York ruling. I think clarity for all in the market is a good thing. And obviously that's something we would encourage.
What's the kind of long-term outlook for stablecoins in your view? Is USDT going to be around in 15 years, or is there going to be a different kind of model? Will it be a regulated variety, more regulated variety like USDC, or will central bank digital currencies come about? How do you see kind of the future panning out in terms of stablecoins?
I think looking 50 years out might be a bit tough, if I might just sort of respond quickly. But if we look to the immediate future, I think the recent Citi report's quite interesting. There's a chart in that where they describe 3 different networks. You've kind of got the CBDC network, you've got the crypto network, you've got the stablecoin network, and they all interact. So I definitely think there's a lot of potential for stablecoins in providing a new network option, many other options beyond USDT, and good options as well. So yes, stablecoins certainly will be a big part of our ecosystem in the future, and quite a few coins participating in that.
I mean, I would have to agree. I think stablecoins, if you look at from 2020 on, we've had 500% growth in the number of stablecoins, right? So I think a euro stablecoin to rival USDC would be welcome. And I also think maybe, you know, potentially DM, which is also formerly known as Libra, could make waves and be as popular as Tether and USDC, and possibly take over in that front. And on the CBDC side, I think you know, if you look at the Chinese, you know, the digital yuan, I think that's also something that's super interesting. So I see stable coins, you know, gaining speed and here for the long run, and something definitely that we are looking at for the Nash platform.
Yeah, and I think if we look at Tether and its inception and evolution, what problem was it trying to solve? And I think one of the key things that it addressed early on was the lack of safe, secure, and available fiat on and off-ramp access to the exchange environment, right? So several years on, most of that access has been resolved for most exchanges. And that also comes from the regulatory clarity piece, right, around working with payment service providers to provide users with access in and out, through fiat. So then, what is the evolution of the stable coin in general? And we still see, a huge appetite for a stablecoin as an underlying asset, for example, for a futures contract, again, going back to institutionals, for somebody who may not necessarily want to hold the BTC asset, but they feel more comfortable in the stablecoin space, for example. We're also starting to see, different authorities anoint, or maybe that's not quite the right word, but authorize the use of stable coins, most notably in the US, and allow banks to take custody and hold custody of those. So I think that stablecoins still provide a really important tool. Who the winner is going to be, and is it a one-horse race? I don't think so. But it would be impossible to predict today.
Yeah, I totally agree with that. I mean, especially looking at 15 years now, it's like 90 years in normal life, right? 15 years in crypto is 90 years in normal, or even more. It's impossible to really say. I mean, what I'm convinced of is that stablecoins are currently and will, for the foreseeable future, continue to be an important part of the ecosystem. Absolutely. Whether or not you're going to need 600 different US dollar-backed stable coins, probably not. So it's not going to be a marathon with thousands of participants, but probably you're going to have more than one asset, right? So it's going to be a multiple horse race from my point of view, and they're going to continue to be an important part of the ecosystem.
And I think just really quickly, it's important to interject here that especially in Europe, we're seeing a lot of attention placed by regulators on stablecoins. Most notably, we had Lagarde making a number of statements around stablecoins, and the interest by the European Commission to take a deep look into their structures, how they're being used, and any risk around them. So that's evolving.
Yeah, the stablecoins have become an essential part of the derivative already, where it's used for settlement, it's used for people to take their P&L, and that's here to stay. Right now, it's mostly USD, but I agree with the rest of the panel that there's probably room for at least maybe 2 more or 3 more like stablecoin. But that's already like more than 50%, I believe, of the derivatives are settling in stablecoin. So we can even believe that it's going to increase compared to derivatives that are sitting directly in ETH or BTC.
Another theme I want to touch on in 2021 is derivatives and option markets. These are kind of increasingly important markets in crypto. And the vast majority of volume is on centralized exchanges, and there's kind of a growing interest in DeFi, particularly with layer 2. Perhaps we can start with Okex, given your huge BTC futures markets. Interested in kind of understanding just broadly the direction of derivatives and option markets in your view.
Yeah, it's definitely is growing quite fast, and I think. The interesting part is that it's still you still require, as I said earlier, like a centralized exchange to offer like the best infrastructure basically for derivatives to grow. Not only because of risk management, where you need to have like some, for example, price limits. You need to have like a proper liquidation mechanism. You need to have a price discovery as well. And I think it's back to what we said during this conversation. People have to realize that there is a strong connection between CeFi and DeFi regarding price discovery, where the price discovery of the underlying spot market happened on DeFi, and it's basically it's brought to DeFi through arbitrage. Basically, that's why you get like a proper pricing on DeFi, because you have arbitrager trading back and forth, and plus you have the Oracle, and the Oracle are probably the weakest link right now of DeFi, but it's being addressed. So derivatives, in that sense, are going to be a bit more difficult, I think, to grow on decentralized exchange. But there are, again, as I said, there are like interesting projects, but they need probably to come up with some of the same mechanism that have been successful on centralized exchange in crypto and in the traditional assets.
To what extent is Bitcoin's success, and if we define Bitcoin's success as actually reaching some kind of price stability, because people value it as a store of value, might kind of settle at say 200,000 a Bitcoin, let's hope, and then stop being volatile. To what extent does that kind of actually destroy interest in derivative markets? I know that most people are actually interested in these products because of their volatility. So is there a conflict between the current kind of use cases of Bitcoin, which really enjoys its volatility, and its kind of narrative as being this store of value?
Well, I think your question, James, is then focused on, just Bitcoin. So CME's just launched an ETH futures contract. They've seen quite a lot of interest in that. So I think that as, additional assets in the ecosystem, find their feet and their value, the derivatives market will expand to include, other contract pairings that are maybe exclusive of BTC. So I don't necessarily think that's the only asset that's going to play in this derivatives market.
Yeah, I think that's very fair. We have 5 minutes to go. The kind of last theme that I wanted to touch on is network congestion on Ethereum, and the kind of extreme gas prices on there, and whether we see a kind of multi-chain world emerging in 2021. A lot of projects have been positioning themselves for this: Solana, Binance Smart Chain, Polkadot. Is this kind of just a hype cycle, kind of thing that'll disappear, or is this kind of an emerging multi-chain world that we're seeing, driven by huge transaction costs?
Maybe I'll jump in. I mean, I think we will see the emergence of a multi-chain world. At the moment, transaction costs do drive it, but I think there are other elements that drive it. So maybe the short-term transaction costs, but some of the newer chains have quite a lot of attractions to them, and as developers, build out more on those chains, we certainly see a multi-chain world emerging.
Yeah, absolutely. I mean, you cannot say things to 100% guarantee in our industry, so I'm going to be a little bit careful on doing that now here, right? But I mean, I wouldn't call it a hype cycle for sure. We see the growing interest in certain, newer projects, and from my perspective, these are going to stay, right? I mean, Ethereum is not going to disappear by no means, of course, but we do see a growing interest in such an establishment already of projects that were unknown 1 or 2 years ago, that, I mean, I wouldn't bet on them disappearing anytime soon.
And I think if you only have to look at the market to see how many market players are operating in that layer 2 space, specifically to address this problem, congestion fees, etc., and interoperability, right? So again, going back to, one horse doesn't necessarily win the race. I think the cross-chain emergence that we're seeing and the ability for developers to build on Crypto.com chain or Binance Smart Chain, and for those to be able to be, interoperable assets cross-chain is something that is happening now. So, this is early. And it's evolving. And again, Max is right. I wouldn't want to predict what happens in 3 years, but that seems to be the path that we're on. And I think more broadly in crypto, we've started to see consolidation. We've started to see cooperation with competition. For this industry to grow, there is quite a lot of interrelation, whether it's between CeFi and DeFi, whether it's between one market participant and another, and that's how the market's going to mature.
Thank you for those responses. I think the really exciting thing about working in this industry is that none of us know what's going to happen, and every day is kind of exciting for that reason. But certainly, I think we've covered some really interesting themes today. How stablecoins will evolve in 2021, how a multi-chain world could evolve, derivatives markets, DeFi versus CeFi. I think there's some kind of interesting themes that are coming out this year. So we have 1 minute left. Is there any other final comments any of the panelists would like to make before we wrap up?
Thank you, everyone.
I just want to mention that most of the developers that I know now, it's funny, but they are all planning to build across at least 3 different chains. Most of the good projects, they are raising money and they are developing only for Ethereum, but at least they plan to have three chains. So you can see it will be a bit more fragmented, I think, this year. But you will see the same project basically, like operating across different chains. And they want to get listed after, so on us. Perfect.
That's right. Thanks so much. It's been an incredibly high octane group of panelists today from the best in the industry. So thanks everyone for your time. I know it's incredibly busy and busy time for you all. So thank you, and I think we have run out of time now.
Great, thank you.
Thanks.
Bye.
Thanks, Jay.
That was a great discussion. I really enjoyed it. Interesting question. We received a comment that James is asking really nice questions. I totally agree with it. James, thank you once again. All of our participants, thank you. It was really interesting, fascinating discussion, even I would say. And also there's comments in our discussion just below this video that this panel is about centralized exchange. Yes, it is, because panel discussion about DeFi market is just around the corner. So you have some time to grab whatever you want, water, coffee, tea, and but please stay tuned, we are here. So our next speaker is from Itez company. It's Xenia Soborova, and her topic is accepting fiat for crypto business in a new way. So please welcome our next speaker, Xenia, and I'm sure she will tell us something interesting. Move on.
Xenia Soborova, Chief Business Development Officer at Itez, a cutting-edge SaaS that assists businesses in accepting crypto deposits via bank cards.
Hi, my name is Xenia and I'm CBDO at Itez. We help companies in crypto to accept the bank card deposits. And today I would like to cover a little bit of my experience and also to share the market changes, how we have come from the old ways of accepting crypto deposits with bank cards to actually the new ways. So what are they and what exactly is new? And I would also like to cover the experience of Itez in the market with that regard. So I'd like to start with the current state of the market. So I've been in crypto since 2017 for about 4 years now. And I've noticed that, well, the market has really developed. We have plenty of services to buy crypto. And at the same time, I get a lot of questions from the customers. Where to buy crypto? How do I buy Bitcoin? And that is also kind of a question to crypto businesses like exchanges and wallets, because their aim and main goal is to actually successfully onboard and retain new customers. And I think, well, to me, the best way to do that is to actually top up with bank card, because it's something we are so commonly used to, and we do that quite often. So I don't know actually why, and I think it's the best way. So coming to that, so what are actually the old ways of accepting crypto with bank cards? I think there are plenty of them, but in this conversation, I would like to focus a little bit more on direct acquirer and working with a third party, which Itez is also a part of. So when we talk about accepting crypto deposits via acquirer, it always comes to my mind that it's a more suitable way for actually big business, because, well, on the one hand, the positive side is that you have a transparency of operations and you are also able to negotiate a lower commission as a big company. But then on the downside is that you actually have a lot of costs. They are both the financial risks that are related to chargebacks to covering the rolling reserve as well, and also the legal risks because you have to cover fraud yourself. And exactly because of that, the long onboarding process can happen. So it usually takes from 6 months to 1 year to actually be able to sign up with an acquirer, which I think is quite a lot. And to wrap it up, you have to have a dedicated team that is able to support an acquirer for a daily basis. So how exactly what are the other ways to do that? And the other ways to work with a third party. With that being said, Itez is one of them. So the old school fiat to crypto providers are actually I'm pretty sure you know the names of those companies, and I think they've done a great job because they provide a ready-made solution to quickly start accepting the bank cards. Then when we come to risks, they're usually quite low because the companies cover chargebacks, they cover fraud as well. But then as a user, I've noticed that a lot of those companies have actually a very poor user experience. So you have a long onboarding process. You have to fill in all this information about yourself, and then the KYC may take up to 2 days, which I think is quite a long time to wait. But on the business side of things, those companies have, unfortunately, quite low card acceptance rates, usually like between 30 to 40, which means that a whole bunch of potential items to make a purchase is going to nowhere, and you do not receive it as a company. And obviously, one of the drawbacks is that you basically depend on a third-party provider. And then we come to also the question of acceptance rate, because I was talking about it. Why is it so important? Since I work a lot with crypto businesses, I get the question, what is your commission and whether you have the lowest price on the market, which I think is definitely very, very important. But if we look like at this very simple comparative model with a provider one that has, imagine it has the lowest price on the market to buy Bitcoin with a bank card, but also it has quite low card acceptance rate, which is around 50%. That would mean that as a business, out of all the potential atoms to buy crypto, with a bank card, you would only get half of it actually as a successful deposit on the platform. So you lose a lot of money as a business. But then look at the provider two, which has higher card acceptance rate. The good part of it is that actually pretty much regardless of what the price for Bitcoin is, because card acceptance rate is really high, 80%, you will get the majority of transactions being successfully coming to your platform as a deposit. So here we come to the new ways of crypto depositing via bank cards. I think that the industry has changed and it requires a lot of like a modern approach to that. And Itez and some other providers have been quite keen on looking at the problems that the market has faced with regard to crypto depositing. And I think I mentioned here on this slide the major aspects of what should be done differently and what the services are doing differently now. So the most important thing is that those companies take all the risks, like chargebacks, covering fraud as well. They are also keen on neat customer experience, and that's really nice to see in crypto in general, I think, to have a user-friendly, very simple interface and simple flow for a customer. Transparent pricing, I think that's the most important thing, because I've seen a lot of different hidden fees, and as a user, I really kind of hate it myself, because you try to buy crypto and then you see that at some final stage, actually your price is changing because the Bitcoin price has changed, because you have some hidden exchange fees. Pretty upsetting, actually. And the fourth thing is, of course, card acceptance rate. It should be really high to get all the deposits through. And as I'm working within the partnerships at Itez, I think it's important to also mention kind of my experience. I think the most important from our side is that to be able to ensure that we take all the risks for our partners, while also being able to deliver all the benefits of accepting bank cards for crypto deposits. And for our partners, we are also quite welcoming to become a source of liquidity for Itez and to earn from every transaction made through the widget that we have immediately. And here, I just want to wrap it up a little bit and say what's the difference between the regular fiat to crypto providers, like old school way, and the new way, which I hope is representing, and I'm doing my best to ensure that as well from my side. So I think we can talk about two ways. One is what are the benefits for partners and what's the difference for partners, and the second, what's the benefits for the end users, the end customer. Here, when we talk about the customer, the most important is the UX. It should be neat, it should be super simple, it should be in 1 or 2 clicks, and that's what we aim with the service that we provide. And secondly, QIC. As I mentioned before, old school providers can have it up to 2 days. At Itez, we usually aim to do that within 15 to 20 minutes. And as for the businesses, of course, for the partners, the most important thing is that we do not have any fees at any point, no onboarding fees. We cover all of that ourselves. And of course, acceptance rate. We are quite proud at our acceptance rates. Those are depending, of course, on jails, but in general, it's around 80 to 85%, which means that the majority of atoms to buy crypto will get through successfully to the platform. And to wrap up the conversation, I just thought maybe I can give you some pro tips for choosing your provider, regardless it's a gateway, like a middleman, like Itez, or an acquirer. First of all, really look at the legal side. Take care of licensing of the company that you are aiming to work. It sounds pretty simple and pretty obvious, but still really talk to your legal advisor and check the company before you start to work with. Secondly, you should definitely ask for transparency in numbers. Ask for the fraud rates and card acceptance rates. Those are the indicators of how the acquirer or a gateway is good at the work that they're doing. And thirdly, I think you should definitely get more than one provider, because you should not really trust bank card payments in just one hand. Try to make it a stable thing, and if something will happen with one of the providers, you will also have someone else to support you with that, not to lose the revenue that is coming from that method of payment. That was pretty much it. Thank you for your attention. I'm really happy if you have any questions. I'll try to look at the chat if there is any. And yeah, thanks a lot.
Xenia, thank you very much. That was pretty interesting. If you have any questions to Xenia, she is in our Telegram group. So please feel free to tag her, to ask her any questions. I'm sure she will be happy to answer. Okay, let's move on. We have our next presentation. It is from our sponsor, Nash. And we have amazing speaker. He is Kellogg Fairbank. And the topic of his presentation is bridging the gap between fiat and crypto. And I'm sure, because I see it in our chat, that there is lots of huge army of fans. So if you have any questions, guys, to Nash company, to Kellogg, please answer, write your questions. And I think that if we have like 2 minutes, 1 minute more, we'll definitely ask him something interesting. So please do it. Okay, let's move on. Next presentation from Nash company.
Kellogg N. Fairbank, Head of Global Business Development at Nash. Easy to use non-custodial cryptocurrency exchange and wallet.
Hi, everyone. My name is Kellogg Fairbank, and I'm incredibly excited to share with you today Nash's mission of bridging the gap between fiat and crypto. In other words, between traditional and decentralized finance worlds. So before we get into that, what I'd like to do is just talk a little bit about some of the trends that we've seen and what we like to consider Finance 2.0 infrastructure. So we are, over the past few years, we've seen a very strong demand in digital banking. So global neobanking means new banks. So digital banks is valued at around 35 billion in 2020, and the growth rate is about close to 50% for 2021 through 2028. Popularity is driven primarily by the speed, convenience. There's low fees. There are better interest rates. And what we also see, and this is something that started in the summer of last year, 2020, and has really grown and turned into something, is DeFi, right? So March of 2020, the total value locked was around $1 billion, and it's now ballooned or grown to over 40 billion as of March this year. Banks across Europe are now charging account holders negative interest rates. So here in the Netherlands, we are being charged negative interest rates for over a certain amount of money. So we really feel that digital banking and DeFi are the Finance 2.0 infrastructure. So when we talk about DeFi, decentralized finance, what are we talking about, and what are the current barriers to entry? So I would say that seed phrases are one of those, right? So seed phrases and browser extensions, MetaMask, are not accessible to retail users. I would say high transaction fees on the Ethereum network, so for hopping between yield pools. There are no direct connections. So I guess the best way to describe that is that you connect to a CEX, so a centralized exchange, exchange dollars for crypto, and then transfer to a self-hosted wallet. The non-compliant DEXs, so Nash is regulated and compliant, but the other non-compliant DEXs are not trustworthy for retail users entering the crypto space for the first time. And user experience, or the UX, needs to be improved. And that is especially true. I mean, if you look at the space today, it is very, non-technical. I mean, it's very technical, right? So it needs to be non-technical. So the interfaces are something that really can be improved upon. And what we see a huge gap in the market. We really feel that providing digital banking services that make access to DeFi, so decentralized finance, as simple as depositing funds in a savings account, is the future. And with that, what I'd like to do is present to you what Nash is all about. We are a crypto-first digital bank, and we are helping to bridge the gap between crypto and your local currency. We are essentially helping to unbank the banked. We're catering to a growing crypto market. And if you look at crypto, in pre-2020, we were about 50 million users, and we've grown to about 100 million in 2021 so far. To reach the next milestone of 1 billion users, we really need apps with better UX. We need to combine fiat banking, so offering bank accounts that also provide access to a fiat crypto gateway for investing, and the ability to provide DeFi, so decentralized finance, for savings, lending, and borrowing. So we are helping to make DeFi accessible to not only people that are in the space today, but also to a much greater audience. And we're looking to bridge that gap between the old and new financial systems. So the old being traditional finance and the new being decentralized finance. And offering that user access to both in a single seamless platform. So we are providing plugging into DeFi, right? So deposit directly from your bank account to a crypto-powered, let's call it savings account, with UX that is very similar to traditional banking itself. We're going to be providing a fiat gateway, so instant crypto purchases at 0% fees. Funds go to a non-custodial wallet controlled by the user and is secured by MPC, so multi-party computation. We will be providing traditional bank accounts, so full national currency accounts with IBANs, just like other digital banks. And we'll be providing a debit card, so the ability to spend crypto and cash anywhere, earning rewards on every transaction. On the business side, On the business side, we will be offering two services. One of them is a white label fiat gateway, and the second is Nash Link, which is our solution for merchants to accept crypto. Today, I'll be talking about our white label fiat gateway, and what we like to call it is third-party fiat ramps. So these third-party fiat ramps, this is something that, just to give you an example of why, to give you some context as to why we really understand ramps, is when we first started out as a non-custodial decentralized exchange in 2017, we looked to partner with a bunch of third-party fiat ramps for our service to onboard users onto the exchange. It was, to say the least, it was not a pleasant experience, and it's something that we decided to scrap and then go out and build our own. We have the licenses in place, we are regulated, and we feel that we actually really are the best party to be able to partner with in order to ramp that next billion users onto the platform. Looking at others in the space, with us, if you're buying on our, in the wallet, in the Nash app, or if you're buying on the platform, you are for BTC, ETH, and NEO and USDC, you are paying 0% fees. The transactions are instant and they go directly into your wallet, only you control. With the third-party fiat ramps, those are, we're partnering with DeFi protocols and that type of thing. Fees will be 1% across the board for any tokens that are in our wallet. So if you're looking at this, if you spend 500 euros with Nash, you're receiving 495 euros, and that is 20 euros more than any of the competing third-party fiat ramps across the board. So 1% fee, 0% markups, and 0% markups on the network fees as well. And what we've noticed is we've done a number of different calculations across the board, is that a lot of these providers will do a markup on the network fees or markups on the price that you're acquiring itself. So if Bitcoin is today 40,000, then they would charge a 41,500 or 42,000, and that's just not right. And we want to help fix that. So for the retail side, as I just mentioned, we provide a gateway to DeFi. So we offer 0% fees on BTC, ETH, and NEO, which is possible due to our layer 2 exchange. We offer just 1% fees on other assets not integrated into our exchange. So as I mentioned before, we offer BTC, ETH, and NEO, and those are 0% fees when you buy via our Nash app, and 1% fees on all other tokens. Purchases go directly to a wallet only you control. And to give you an example of how this works versus Coinbase, who is probably one of the better known providers in the space, with Nash, when you're spending 1,000 euros to buy BTC, you are receiving this amount, right? So 0.02497. At Coinbase, you're receiving a considerably less amount of BTC, and that is 0.02373, right? What I do want to point out is that our price, which is the Nash BTC rate, is 40,042, and the Coinbase price is 40,523. Both of these purchases happen at the exact same minute, let's say. But it's an equivalent savings of about 50 euros when you're spending 1,000 euros to buy BTC. So I think this is some news that folks are very interested in learning more about, who Nash is integrating with, and I'm happy to make known that we will be integrating Aave onto the platform. So Nash is integrating with Aave. The Aave token will be one of the first new assets to be added to Nash, tradable direct from user wallets through our fiat gateway. So the savings integration will happen in Q2, and Nash will also integrate Aave's technology as the basis of our easy-to-use high-yield earnings options with rates matching Aave's. And we really have sort of the same ethos, if you will. So we are helping to make DeFi accessible to everyone. So one-click transfer of fiat currencies to a high-interest DeFi earnings account. We will be providing, directly connected to your Nash Bank account coming later this year. And lastly, the easiest way to earn interest in DeFi. We will make it as easy as one click, from euro, so fiat currency, to a savings account. And then we'll be providing fiat ramps. So our fiat ramps provide low fees, as low as 1%, fast, instant delivery with no withdrawal logs, and we conduct KYC, AML, and we've worked with regulators since 2017. With that is my presentation. So I really want to thank everybody for paying attention. And if you have any questions, please do visit our Twitter, Nash Social, or our Telegram, which is Nash Social as well. Thank you.
We are back. Kellogg, thank you very much. It was really interesting news. So my congratulations with the integration with Aave. It's really huge. So once again, congratulations. You're building really something interesting. Okay, so we are moving on. Our next speaker is Vadim Koleoshkin. He is co-founder of Zerion. And we are, with this topic, we are moving on to jumping into our next section is DeFi Market 2021. And it will be really interesting, fascinating, I would even say. Okay, so we are, I hope that Vadim is already here. And I'm really excited to introduce his speech presentation, DeFi is a new fintech. So welcome, Vadim Koleoshkin. Let's go.
Vadim Koleoshkin, co-founder at Zerion, an all-in-one interface that allows technical and non-technical users to acquire, track, and manage DeFi assets.
Hey everyone, great to meet you. Oh, is it possible to show my presentation? Oh, yeah. Today I want to talk about how DeFi became a new fintech for a new generation of developers. If we take a step back and see what DeFi really did, we already saw this several times before with the internet. When internet came to several industries, it instantly modularized supply and created this called aggregation theory, where one point of access provides a lot of access to different goods. We can take music industry as an example. So previously, you should get to the label to get access to a singer. When I was a child, all my music interest was locked to one music shop nearby. So I could only get CDs from labels and suppliers that they partnered with. But now, like 15 years later, Spotify provides me access to any singer in the world instantly and without need to pay for each album, CD, or whatever it is. The same happened with the newspaper industry. Initially, again, I was reading a magazine about games. There was a lot of stories of upcoming games, reviews, but everything was tailored by the newspaper and its editorial team. So I was able to choose what games I want to get review on or what games I want to look at in the future. But suddenly Google came into this market, and now I could go to Google or to YouTube and get the content what I really want, and I don't really need like editorial team and for me to tailor the content. Yeah, this could be this is done by three major like steps. So with the internet distribution, costs go down. So now you can distribute your digital content and sometimes physical items globally from the day one. Then the transaction costs are also going down. Even now, if like when you pay like $20 for the transaction on Uniswap, it's still cheaper than settled trade on traditional markets. The only difference is that the end user pays for these transactions, and on the traditional markets, the cost of this trade settlement is made by companies like Robinhood or brokers or market makers. And also, internet provides modularization of supply. So now you can choose from not like tens of different items, but you can choose like hundreds of thousands of items instantly. And ultimately, users become the first order priority. So if you want to get access to the user base, you should put your users first and not try to make money of them unfairly. Because the current state of finance is likely the same as it was like 15 years ago with music and newspaper industry. It's super localized, so you can get access to only what financial assets or companies or applications you have in your own country. And in many countries, you need to be accredited investor, or you should have some sort of like assets on your balance in order to access all these applications. So fintech applications like Revolut, Robinhood, Public.com, they were supposed to fix this gap, but at the end of the day, they were built on the previous rails, so they just switched the storefront of the old like system. But then suddenly DeFi in the past 2 years, they created this new fintech for developers where distribution costs are 0. So once you deploy your product, it is accessible to anyone in the world. And each new product is accessible instantly, and anyone can create a new product for users. DeFi has 3 major properties. It's interoperable, so you can exchange information within the system easily and freely without restrictions. So in traditional fintech, especially outside of Europe, it's hard to get access to the data from other systems. It's also programmable, so anyone with a code could create a smart contract and transfer value and set its own set of rules how it's done. And what's beautiful, it's composable, so it fits perfectly with each other. So you can build products on top of other people's products without need to permission. We see this with all the yield farming opportunities and exchanges, and a lot of new DeFi products coming right now that are totally built on the previous generation of DeFi applications. The end piece of this was stablecoins. So when we can transact within the system with a unit of account that we get used to, it became magical. So now you can transfer US dollars from one point of world to another instantly without need to put a lot of banking details, and then just like upload an image into the internet. The same you can now do with your digitalized dollars. The last bit of DeFi is that despite its new fintech, it's also developer friendly. So previously, if you want to create a financial product and distribute it to the world, you need to have a financial education, or you should be a lawyer. Now you should be a developer to do it. Right now, there's like for the ton of financial derivatives, there's like at least several projects doing it. So it's a competitive market where different projects try to innovate. But soon, once we will done with traditional money Legos like spot trading, money markets, margin trading, ETFs, options, futures, developers will be able to create something new which hasn't existed before. The good example of it is like Uniswap. So automate market makers and LP providing wasn't something not possible before in traditional markets. But when we add this to, let's say, ETFs, now you can have an ETF with the properties of like yield earning assets, which is something new, and that was hardly to construct in the previous markets. To prove this traction, DeFi protocols earned almost over $800 million in the course of last year. So starting slowly, but then with these properties of scaling, and when anyone can access these products, the revenue of the protocols and liquidity providers grew exponentially, and it's still yet to see how far it can go. The total market cap of the DeFi assets reached 55 billion US dollars. It was around 15 when I was doing similar presentation in September. So valuation of these assets is also growing exponentially. And in this DeFi world, we are building an aggregation tool, a marketplace for financial assets. Right now available on Ethereum chain, but we're expanding to other chains as well. So we try to provide an easy access to any DeFi assets out there on the chain with intuitive interface on both web and mobile. So feel free to reach me if you are interested in what we are doing, and happy to answer any questions if there is some.
Vadim, thank you very much. It was great, awesome introduction, I would say, to our DeFi market section. And we are continue our topic, and we are jumping into our next speaker, into our next topic. The topic of the second presentation in this section is bridging blockchain and the real world. The speaker is Dominic Ernst. He's from Aruliah Network, and I'm sure he's already here online in our hidden room. So let's go, bridging blockchain and the real world topic.
Dominic Ernst, Chief Executive Officer at Aruliah Network, a novel cross-chain Oracle solution.
Yeah, so hey everyone, how's it going? Thank you, Natalie, for the quick introduction, and I'm really glad to be here. I'm really excited to talk about bridging the blockchain and the real world. So I'm Dominic, I'm the CEO of Aruliah Network, and today we will talk a bit about oracles. So oracles are really important. So without oracles, DeFi systems couldn't exist. And therefore, blockchains are isolated networks, so they cannot pull or push data to external networks out of the box. So you have to design something that bridges these two worlds. Imagine you have a dynamic NFT, for example, a soccer trading card with the name of the player, his age, his number of goals on it, and this is digitally stored on the blockchain. If this specific player makes a goal in the real world, you have to update this data on your digital trading card as well. And to do this, you need something, as mentioned before, that bridges the real world with the blockchain data. In specific, how does it work? So on one side, you have your smart contracts, which are running on a certain blockchain. And on the other side, you have the internet. And these two worlds are completely separate by design. So you cannot access data from each other out of the box. So you need a bridge between those two. And this is where the Oracle comes in place. In the example of the dynamic NFT, the trading soccer card, the smart contract can request or ask the Oracle for the actual number of goals achieved. And this Oracle will request the data from an external API provider that should be verified. And the data retrieved will be verified by Oracle itself and will be written to the blockchain. And after this, the smart contract can proceed processing because it can read and write the data from the blockchain that was currently fed from the Oracle. But there's a problem, and it's called the Oracle problem. Blockchain is all about decentralization. And the Oracle problem describes a scenario where you only ask a central Oracle. So the whole decentralization is in danger because you're asking a central Oracle system. And the problem with the central Oracle system is that it could be compromised. And therefore, all your smart contracts could be executed with wrong data. And this would cause a huge problem in the DeFi market, especially, but it's not limited to it. So imagine you have a smart contract, and it wants to know the current gold price. And you ask a central Oracle, and this Oracle was compromised. So you will retrieve the wrong price for gold. And therefore, for example, if you have a trading application, trades would be executed too early or too late. And yeah, this causes huge problems in your application. And yeah, is there a solution for it? So the solution would be to use a decentralized Oracle system, or an Oracle system that can guarantee that the data requested and responded is as valid as possible. So this brings me to our project. It's the Korea network. We developed an Oracle system that exactly wants to solve this Oracle problem. There are other Oracle systems out there, such as Chainlink or Band Protocol, which are trying to solve this problem as well. But what makes us so unique and special is that we don't have any middlemen. So the data that is fed into the Oracle system comes directly from the data owner. So there are also an integrated reputation system as well as a monetized incentive to deliver only high quality and valid data to the network. Yeah, this enables users of the network to fully trust the data that is provided. And yeah, therefore you have secure and valid data in your DeFi applications. This was a quick introduction to Oracles and a Korea network itself. If you have any questions, in particular in a Korea network or in Oracles, don't hesitate to contact us via email, or you can join our Telegram group as well, so you can be the first ones getting the latest news from us. And yeah, thank you very much and have a great remaining conference.
Dominic, thank you very much for your presentation. I learned something interesting, something new about Korea network. I hope you guys did the same. So we are jumping into our discussion panel finally. So let me make a quick recall about participants that we have in our panel discussion, DeFi Market 2021. It's really amazing. So moderator is Guillermo Jovanovic in the coin. Yes, it's pretty, I would say, tricky to have a moderator from centralized exchange to ask question about the top, I would say, projects in DeFi market. So I hope you enjoyed it, guys, and I'm really excited about this next panel. Participants, it's B Protocol, Ethan Kachka. I'm sure you know it. It's the top, I would say, top 20 DeFi project that we have currently in our market. I really love this project, so I'm really excited to hear Ethan comments about everything that we have. Let's move on. Kyber Network, it's Dennis Omer. I think that this project is like the top project DeFi from 2018, I think, because we have this project. I've heard about this project. I was following, and I do follow this project from like almost 2 years, and it was a pioneer. Before how many? Okay, let's move on. Maker Foundation, of course, I'm sure that you also know this project. It's amazing. It's #1 right now. Gustav Arentoft will be speaking today, and Matic Arjun Kalsi. It's also, I think, they will tell us more about how they how do they do right now when this DeFi market is blooming. So it's very, I hope that our guys is already here. Let me just check for the next panel. Yeah, so we are ready to start our discussion panel, DeFi Market 2021. Enjoy it. Please don't forget to ask any question as you have. We have our Telegram group. We have our chat just below. You see the screen on YouTube channel. If you have any questions, tag them in our group or write down your question just below the comments we have, and we ask our moderator to ask these questions, and we'll see how they answer. Let's move on. Discussion panel, DeFi Market 2021.
Hello, everyone. How are you guys doing?
Good, good. We're doing good. How are you doing?
Great, great. I'm good as well. Thank you. So I suppose we are still waiting for more people, right?
Gustav, right?
Yeah.
And Arjun?
Cool. Anyways, thanks, Natalie, for organizing this event. It's really great to be here again this year. And today, this panel will be about DeFi Market 2021. With us here, there will be the top leaders within the industry of DeFi. So maybe while we wait, you guys can already introduce yourselves to our audience.
Eitan, do you want to go first?
Yeah, sure, no problem. Hi, everyone. My name is Eitan Kachka. I'm leading the community and the ecosystem development in B Protocol. Before that, I've been in a few different crypto startups since 2014, starting with Lazuz, one of the first non-financial, probably, dApps, still building on Bitcoin blockchain before Ethereum was even live. It was fascinating few years to see how this whole ecosystem is growing so fast, and definitely in the last year, coming back into DeFi and working on B protocol is just, everything is booming. So it's exciting times.
Yeah. And my name is Dennis, and I'm the head of ecosystem growth at Kyber Network. Yeah, I've been involved in the space since early 2016. And back then it was like a completely different world compared to what it is today. And over times, I've met so many different teams from different projects, including on this panel as well. It's been like an amazing ride. And I've been super blessed to be able to kind of live this experience from Kyber's side. And that's a bit of my background.
Sounds great. Gustav, welcome. So please feel free to introduce yourself.
Yeah, thanks for having me. My name is Gustav, and I cover the European and African business development for the Mega Foundation right now. I've been with the team for over 2.5 years, and good to see you again, Dennis. It's been a while.
Yeah,
good to see some familiar faces. And yeah, I got into the DeFi space because I was living in Argentina, and back then, I was looking for solutions to escape the inflation, and that ended up landing me a job at the Mega Foundation. And it's been a couple of very, very crazy years, but it's really good to see kind of like the growth and progress that we've seen in the DeFi space in the last 6 to 12 months.
Sounds great, guys. Thanks all for the introductions. So to start, I guess Gustav actually already answered the question, but I'm just curious to learn more, how did you get into DeFi? Did you start investing first or just exploring? So maybe Dennis, you can start by telling us your first experience that you had.
Yeah, I mean, I first, let's say, used Ethereum back in 2016, and it was a very simple experience. And to go through it, it was just transacting. There wasn't much DeFi at the time, but we always had Maker in the background. It was the one DeFi project from day one that's always been there. With the start of Psi and the early day community calls. And I think the first experience must have been maybe Maker when it first launched, or maybe everyone went through the Ether Delta days as well, which was a very simple order book that was around in 2017. It was kind of primitive. It was clunky. Everyone was front running each other. But those were my two first kind of experiences in Ethereum within the financial, kind of sphere.
Yeah, that's quite interesting. As actually, the DeFi space has been here for quite some time, but only last year it started booming. So when did you realize that? Was it on your first experience, or only later you realized that it was going to be something big?
I mean, I could tell like early on, like there was a promise, and then since 2018, I was writing ecosystem blogs, monthly updates of what's happening in the Ethereum space since then. And every month it was like doubling and tripling, and every metric was kind of growing, and it hasn't stopped since then. So you could tell this train kind of wasn't going to stop anytime soon. And now we've kind of reached its peak. But then in 5 years' time, we'll look back and it'll look very small right now, even though it looks huge to us.
Great. Itan, how was your very first experience with DeFi?
Well, DeFi is kind of it's kind of a new thing, when you look in a perspective. And I think the earliest experience when I before, I'm not talking about Bitcoin and Ethereum, just on real DeFi. I think KyberSwap actually was one of my first experiences with the real DeFi product. I think it was late 2017 or early 2018. Yaron Vellner was the CTO of Kyber, and currently is the founder and CEO of B Protocol. Send me a link. Just try this new thing we're working on. And it was so simple, suddenly, just to swap, your ETH into a new token, another token. So I remember the UI was very, very simple, kind of an Uber one-click thing, one button click.
Yeah.
Just swap and that's it. And I think I've experienced something similar using Uniswap a few months ago when I came back into this space after a few years of the crypto grid. And it was also this simple experience. I think that's one of the main things, and lacking. I think one of the most things that we were still missing in DeFi for non-technical users. So I think this is one of the things I'm most impressed about, and also with B Protocol, we're trying to push in that direction. To give some kind of a simple UI experience as much as possible. Yeah.
Great. Thanks for your comments. Gustav, you mentioned that you experienced DeFi in Argentina. So could you tell me more detail? How is the DeFi ecosystem back then? How did it develop until now?
Yeah, so back then, I think it was mostly Maker, and also like there was some simple dexes as well. And I remember the first time I used Maker. I think back then we had like 7 or 8 steps before you could actually open what was called a CDP. It was like the most tedious process. You had to like approve your ETH, wrap your ETH, take the wrapped ETH, deposit it into the CDP, and so on and so on. So back then it was like a more clunky experience, but it was also like very eye-opening that you could see that you could generate DAI, this stablecoin that you could then take. For example, on Oasis, which was a DEX that also was developed by the Maker team early on, or Kyber or something, and you could directly swap it into other assets, which back then DAI felt not quite as it feels today. Today it's just kind of like a given that it lives everywhere and exists everywhere. But back then, like my first experiences with it was that this was an asset that you created yourself, and you could then use it for transacting with other assets that you already had, like inside your head, like a very strong perceived value of. So I think that was kind of like the first time when I kind of like experienced it. But back then, as I said, like the experience wasn't quite as nice as it is today. It's definitely come like very, very far.
Yeah, definitely agree with that. So I see Aryun has joined us. So maybe you can just quickly introduce yourself. Well, it seems that
he left.
Okay. Anyways, guys. So yeah, it's great to learn how was your first experience. And in terms of DeFi investment, I'm not sure like how experienced are you, but obviously there is great rewards that can be obtained by investing in certain coins, and as well there is some risk. So how would you guys like manage the balance between risk and reward while investing in DeFi?
We have Arjun back as well. Hi.
Yeah. Hi, Arjun.
Hey guys.
Hey.
my internet connection spazzed out at the last minute.
Yeah, no worries.
Definitely. I think when it comes to, I think we've seen like interesting things happen, right? So we've seen I think you would have read recently there was a rug pull on Meerkat on BSE as well, and I think when you're making these kind of decisions when it comes to investing, I think the number one thing which I look at is which is the team which is building this. Like, is it a legitimate team? And the second thing, what I also try to see is that how do the unit economics of this project work out, right? So, at one good a place where you can, so almost every project these days has some white paper out, and if it doesn't have a white paper out, then I don't know, sure if I would trust that. But I go through the white paper. I'd read about what are the token economics, what are they planning to do, what are the different tokens they're offering, how does it, and I think that's when you can make the best decision. And I know this process can be a bit tenuous. I mean, ideally you just want to go click, get started. But I think if you do the right due diligence, you look at the project economics, you look at the team, it'll give you a very fair idea of where you should possibly invest. And I really feel like that is the best way of going about it. I think one of the ways where people get motivated is that they look at all the hype out there, they look at the tweet storm, and then they'll be like, oh, let's go there. But that sometimes can lead you to bad places. So yeah, like in centralized investing, like maybe in stocks or anything, you got to do your research. It's the same. And I think that's something which has worked well for me, and I'm sure that that's something which would work well for others as well.
Yeah, I would just add audits to that list as well. Like many teams are going out.
Very
and
important.
just going like live on production without any audits. Like for me, that's way too risky. And I mean, in general, the way I think of it is like there's two parameters. The longer the platform has been on mainnet, the safer it is, and then the higher the kind of value locked up, the safer it is. And it's a combination of this. Like Maker has been around for so long and has so much value locked up in it, and the fact that it hasn't been kind of hacked and it hasn't lost money, like talks a lot. Whereas if change even one of those parameters, and the equation kind of changes. So that's how I see kind of risk reward within DeFi.
Great answers, guys. Would you like to add something, Gustav, about risk and reward?
I think one thing that we've also seen is that like a lot of these newer projects, right? They often launch with kind of like a multi-sig or like some kind of like backdoor or back entrance in the code. And I think as Adrian he said that it's a legitimate team. We see a lot of these forked protocols. Like I think forking as like a general thing can be positive, but it can also be quite negative, right? You have the ability to attract a lot of capital very quickly in very, very illiquid markets around the native token and make, APYs seem very, very beneficial. But if it's an anonymous team behind it, we have unfortunately seen, like rug pulls. So, like for me personally, I have like a small portion that, I play around with. And then, sometimes I do like very experimental stuff, because, I think a lot of us in this space, we think that these things can also be very fun. But it stops being fun if you do it with a lot of your money and you get rug pulled or something like that. Then it's not that fun anymore.
Definitely. There are so many projects just popping up like mushrooms. I mean, everywhere, every day, all the time. So I guess everybody's just going.
I think in a way, it's I'm kind of I'm a proud boomer. I assume I can say on myself. I'm not aping into too many projects, and I think projects that are, of course, the anonymity is kind of on the regulatory aspect is something that many projects today kind of choose to go in that line. But of course, the risks are coming with that. Once you don't know who is exactly behind the project, is something I think very important to check before you put your money in there. And I think once there's a very, very distinct parameter, maybe if you are risking too much, is how you sleep going on. If you're not sleeping too well, wondering what's going on with your funds, that's probably where you cross the line for yourself. So I think that's something for myself, being in the 2017 ICO boom and, all those projects that somehow vanished, most of them vanished together with, lots of people funds. I think that's something, of course, today the market is very different. I think projects are much more mature. You see actual real products being used, with billions of dollars in them, something that wasn't there in 2017, which was just, a white paper and a nice website. So today you have, all the previous comments are completely true. You can dive in, you can learn about the project, you can see, who's behind it, you can see what they're actually doing. I think it was a few days ago, someone tweeted on B protocol page, we have this risk page where you can actually read all the risks involved in, getting in to use B protocol, as we're building it on top of other protocols like Maker and Compound. So we actually made it very clear to users. They can actually click in, read the white papers. They can learn the risks that are involved in getting into B protocol and the other projects that we're built on. So yeah, that's, I think, something that going to be kind of regular for most projects in the near future, I hope.
Yeah, I also agree. But I guess it also depends how you play in DeFi, because there are so many ways that you can use it. So you can even just farm like USDT and get some tokens. So the risk is pretty low. And of course, there are those guys that just want to jump in new coins that can potentially do 10x or 20x. So yeah, I think it's quite dangerous, but if you play it well, it's better than just having your assets sitting on your wallet.
And definitely that correlation to sleep is like a magic metric right there. Where if you're, depending on how well you're sleeping, you know where your assets are, and I know, and definitely, and I think the audits again. What I've also seen is that have the audits been done by a reputable company as well. Anybody can go and audit anything, to be honest, and then it's so important to look into that as well. So some nuances right there, which you sometimes you need to lose a little money before you learn some of these things. But yeah, the more careful you are, the easier it gets.
Definitely. So guys, in terms of your own projects within your company, what kind of major contributions to the DeFi space have you done so far? So Ethan, if you want, you can start.
I can, though. Probably we are the youngest project on this panel. So B protocol is a backstop liquidity protocol. Basically, we handle liquidations on DeFi lending platforms. We have launched on top of MakerDAO, and recently, earlier this week, basically on top of Compound as well. And users can just opt in through B protocol to make basically more with the funds and keep on doing the exact same thing that they're doing, with Maker or with Compound, and gain also their share of the liquidation profits that are made by the backstop liquidators. In a way, by this, we also, it's kind of a win-only situation where users gain more, but also the platforms get a better stability. So they get a committed liquidators that can make sure kind of more secure during fun events like Black Thursday last year. And also the liquidators, this is something that brings them a better predictability. So we actually bring new big traders who can actually become committed into liquidations, which is something most DeFi users are not aware of. This is one of the probably the most unvalued parameters of DeFi. It's one of the main pillars for most of the platforms to actually stand on. I think there are a lot of projects popping up currently. It's we're in a bull market. Everyone is doing whatever they can to get a slice of that. But I think just like in 2017, it's like only a few are gonna probably stay longer once the bull market will come down. And I do believe that a backstop solution is something that is needed actually for DeFi to scale. So yeah, we're just in the beginning, but I believe this is something that is it's important, for DeFi, for the whole ecosystem to actually scale into something which is close to what CeFi, centralized finance currently has to offer. Yeah, maybe I'll.
Mm-hmm. Sounds great. So Dennis, what about Kyber Network?
Well, I think we were one of the first kind of liquidity protocols to recognize that there's so many great things being built and there's so much liquidity in different products, but they were all somehow siloed. Like the liquidity was just being used within that specific protocol, for example. And we built smart contracts that would allow all these different existing liquidity protocols to come connect to the smart contract, and from there push it downstream to anyone that needed liquidity, like wallets, like games, like let's say you want to sell conference ticket. Instead of accepting just one currency, by connecting Kyber, you could just go and accept DAI or any ERC20 token, and it would go and get it from the best price liquidity out there. So we kind of connected all these different liquidity protocols together. Like we connected Bancor and Uniswap, and then pushed it downstream to over 100 different dApps.
Awesome. Gustav, tell us about Maker Foundation disrupting DeFi.
So the Maker Foundation is the foundation behind the MakerDAO protocol, and I think we are one of the earliest financial protocols on Ethereum. And to this day, we are one of the most important liquidity providers to a lot of other protocols. We are one of the biggest stablecoin liquidities in the ecosystem, and we see a lot of people there, using our platform on, to access leverage and also to be able to collateralize their crypto assets currently, and be able to put it into things just like Aave or Compound or something, and do like rate arbitrage. So we see a lot of the DAI that's being deposited into Aave and Compound and so on being drawn directly from Maker. So in that sense, we kind of like help supply liquidity to the other lending protocols. We also the first DeFi protocol who is really targeting, at least of the major ones, that is at least targeting real world assets. So, since multi-collateral DAI launched late 2019, which was the kind of like the version of the protocol we see today, the first version was launched back in December 2017. We are targeting, real world assets, or the protocol the community is, and the community has been spending, the last 12 months on figuring out how can we onboard traditional companies who can then benefit from the liquidity that we have coming out of Maker, right? So it actually seems like very soon that the community will have onboarded the first real world assets company. I think it will be in a week or two, maybe 2-3 weeks. And then we will have basically traditional companies getting financed directly from DeFi. And I think this is also like a really big step in the right direction, right? We have been a little bit limited by the assets that currently exists within the Ethereum ecosystems. And it was kind of like, well, either the assets need to grow in value, or we need to have more different assets, which, again, would just kind of like split out the value from the other assets. So now we kind of like can target a completely new segment and get like a completely new influx of users and liquidity and collateral into DeFi.
Sounds great. Thanks for sharing your views, Gustav. Aryum, what about Matic?
Sure, no, definitely. So our focus is to essentially solve for scalability of the Ethereum ecosystem and essentially create the kind of infrastructure which would allow, or rather put DeFi into the hands of the common individual. So what we've done for that is that we built a scaling solution where for $10 you can do like 2 million transactions. So the gas costs are extremely low. At the same time, our block times are 2 seconds. So all the transactions are extremely fast. So now it becomes possible to build those kind of interfaces which your typical Web2 investor would be used to. For example, all the different investing apps they might use, like Netflix or Uber, or any app which they're used to in their daily lives. Like you can give them the same Web2 kind of experience, but in a Web3 environment. And of course, what that has allowed us to do is allowed us to basically build DEXs, which where you can swap with next to nothing cost. They allowed us to build staking contracts where, again, people can stake, unstake 100 times in a day and not have to worry about how much it would cost them. And what that has resulted in is that over the last, I would just say 3 or 4 months, we've managed to cross 600 million in TVL, and one of the top dexes on our platform, which is QuickSwap, is doing almost close to 67,000 transactions on a daily basis and has over $100 million in liquidity, and that's like 50. And in terms of transactions, that's 50% the transaction volume of Uniswap. So that's kind of what has been our mission, and we're building on what we've done at Matic. So we built a hybrid Plasma POS scaling solution where you could get asset security by using Plasma, but also throughput by using a proof of stake network. But the next step essentially is to build a generalized layer 2 aggregator platform around Ethereum. So the best way to visualize that is if you keep Ethereum in the middle and build different scaling solutions around it. Essentially, you can offer maximum flexibility to the developer. So we have a hybrid Plasma POS scaling solution, which is production ready and which our entire network runs. But we're also building optimistic rollups, roll-up chains. We're also building ZK rollup chains. We will also have the ability to spawn your own chain. And what this will do is it will create this layer around Ethereum, which is your scalability layer, and allow the developer to build any kind of app, whether it's DeFi or whether it's some interesting concept like NFT plus DeFi. Or what if you want to bring DeFi into into some game and do that in a gamified manner? So we feel that if you can offer these kind of experiences to users, that's how you want to get the next sort of, you could say, 100,000 users or the next 1 million users who are Web2 users who are used to certain interfaces. And this is how you want to be able to get them into Web3 and then sort of really sort of supercharge whatever DeFi is happening within the Ethereum space. So this is kind of what our mission is, and that's why we built this kind of infrastructure to enable that kind of experience, that seamless Web2 experience. So this is kind of where we are and what we're looking to do.
I see. Cool. Actually, you raised some interesting points there. So, there are so many different blockchains which are being used for DeFi. And initially, I suppose Uniswap, Ethereum blockchain were the most popular. Now it's shifting a little bit due to the high fees and so on, but still there are so many blockchains out there which have great potential to actually work in DeFi. So do you guys think like somehow there will be a leader blockchain on DeFi, or it will still remain everything based out of Ethereum, or there will be basically bridges to connect all of them together? What are your views on that?
So one of the ways which I look at it is this way, that of course bridges are going to be important. So currently we have, let's say, different blockchains with all with their each with their own amount of liquidity and their own ecosystems and their own communities. Now, when you build bridges, what you will do is you will connect all of these different islands of liquidity and communities, and over a period of time, what you will see is that now that the communities are interconnected and they can move their assets freely, the community will slowly start coalescing towards this one ecosystem, which sort of suits their sort of requirements the best. So it's sort of a way of natural selection, where sort of ecosystems which do not provide that level of flexibility, which do not provide that level of composability, essentially are going to get pushed out, and it will eventually coalesce into these maybe 2 or 3 chains out there, which will house, you could say, the entire blockchain community. And to accelerate this natural selection process, which is also happening right now, but to accelerate this, the only way is to build those bridges and let the communities interact together, and then let the community decide, which is the best chain. So that's really sort of my high-level view on how I think this is going to play out.
Mm-hmm. Cool.
So maybe I can jump in here. I think like if we're looking at I mean, I don't think that I mean, I know that Binance Smart Chain is doing a lot of transactions now, and I would question the legitimacy of everything that's going on that chain, as I think a lot of other people also would. But like we definitely know that there will be activity on other mainnets, right? And we also see Matic, which is it's a scaling solution, but it is in its essence a separate blockchain, right? Compatible and everything, but I definitely see that we will have Ethereum as being the place where I think most of the major DeFi protocols want to maintain most of their value, right? I mean, if we just look at it from like a pure like protocol, what is the most important thing for DeFi protocol, right? And that's security. Like without a doubt, security. So you want to be really on the most secure and decentralized network if you're handling this amount of money, right? And from my perspective, I don't really see any of the newer blockchains offering quite the same security yet as Ethereum. I know there's a lot of talk about like how some of the other ones can potentially in the long run compete, but we just right now see like a lot of issues with them, right? There's the ones that aren't launched yet or still has like key features missing to launch. We can't really speculate in them. But we also have some of the ones that already launched that, you know, like has problems, right? I mean, we saw, I think it was Avalanche, you know, go offline. Like, how does that even happen? I also saw that Cosmos, I think it was yesterday, had some of their projects go offline. Like, how does that even happen, right? Like, imagine if you have like major price changes in like a blockchain that goes offline. Like you know, you could potentially have like the entire DeFi protocol like simply not be able to survive that because you need 100% uptime, right? And that is what a blockchain should give you. So I think right now we are still like very, very far away from seeing any promising activity on some of the you know competitors. So like as Ian said, like they might in the end be part of the same ecosystem, but I think we're still very far away. And right now most of the activity that we see on these other like EVM compatibles is mostly forks, right? And I think that the ones that then try to alienate the Ethereum community, like Binance Smart Chain, for example, they fork something, but I don't really see them having a lot of like very serious teams building there. It's mostly just, you know, like teams that fork something. And like, if you haven't built it yourself, I mean, you might be able to keep it up for like a while, but I'm not sure you can keep up with the level of like innovation. And you could also just see like problems coming down the road if you don't entirely understand the code. I don't know if you look into like how they actually forked it, like often you see like that there are some problems, right? That they might not understand everything 100%. So I think like it would be very interesting to see how the next 12 months develop with some of these newer blockchains that, you know, should be competitive, like Near and Polkadot, and you know, if we see Cardano launching eventually too, it would definitely be interesting. But they're starting very far behind, and if they're not EVM compatible, another big problem is that they need to build everything from scratch, right? They come out with a new code, like new coding language, like a completely new setup, and they need to have teams that like not only learn how this new language works, but they also need to build everything from scratch, you know. And I think it will take time. It will definitely take a much longer time than people kind of like think it will. I mean, I've seen how big DeFi protocols with so talented dev teams, like how long it takes to actually ship things. Just because, again, going back to my first point, the most important thing is security. And when you have security in mind, you don't do any shortcuts.
Gustav, just quick question then. So does that, I mean, are you ruling out like Maker ever moving to layer 2? And I mean, the reason I'm asking is because right now transaction costs can be like $50, $100. So we are over time pricing out more and more of the wallets where it becomes feasible to use, right? And that's not going to switch anytime soon because Ethereum settlement layer is becoming more and more valuable. So I don't know, like what, you know, for me, like layer 2 seems like that kind of solution. And I don't know if you mean like some of, like how you see Maker fitting into that.
Yeah, so we at the BD team, like what I've been working on, you know, we saw it already like over a year and a half ago, and you know, we also have been in touch with Matic, for example, for like a very long time, because we saw very early on that you know, for example, we have a big community in Latin America, and you know, even when Ethereum transactions, just a cent transaction was like $1, with their average transactions of $10, like it was already too expensive. So we see this kind of like that, like I see this, but like DAI, for example, would be existing on all layer 2s. DAI is already also now bridged to like 7 other blockchains, like Clayton, Ontology, and Neo, Binance Smart Chain. You know, we are on most of the layer 2s as well, and you know, want to continue to be on as many layer 2s as possible. How I perceive it. So I think like DAI as like a stable currency definitely needs to be everywhere, right? But at the same time, I think like the main settlement, at least from my perspective, will probably need to stay on layer 1 for now. And it's also, I know that we price up people taking smaller loans at the moment, and I hope that we can solve that as a community, right? But right now, it's just so important that you have like the security is like the most important thing. And right now, Ethereum is just like the best option, even if it's very pricey.
Yeah. And also, like, you know, another important point is, the point is that, there is no perfect solution, right? You can't have perfect security, perfect throughput, perfect flexibility. Like the solutions like that don't exist. There's always some sort of trade-off. And the way I would see it is that security at the end of the day is it's a technical problem to solve, and they're bound to be solutions, right? So optimistic rollouts, for example, is one of those solutions where you take verification call data to layer 1, you do that. Now it may turn out to be expensive, but that's one approach. Then with ZK rollups as well, we've seen, right, where you have validity proofs, and then you have heavy computation, but you can provide a proof which cannot be challenged. So I do feel that even on the layer 2 side, while right now layer 1 has the highest amount of security, and beyond a shadow of a doubt, and I expect all the whales to stay there for the longest period of time. What I also feel like, just another way of looking at this is that, as a person, like if I were to talk in terms of investments, like, there is money you play around with, and then there is money which is your, let's say, retirement money, right, which you won't touch. So I expect maybe that money to stay on layer 1, which has the highest amount of security, but all your investing, staking, and all of your daily transactions, like for example, many of us who, let's say, so many people do stock trading, daily day trading, right? They do these kind of things to earn extra money, and they invest in options. I feel all of those things are going to move to layer 2. So all the money which people used to play around with, to invest, to grow, that will move to layer 2, while I feel that the retirement money will maybe stay on layer 1 for the foreseeable future until better solutions are found. Like, for example, one of the solutions which worked for us was to checkpoint transactions onto Ethereum. They have to make sure that there is a high degree of asset security. But like you said, it's not perfect. It's not Ethereum security. So
yeah,
I think
but I think
yeah.
So is it like, when I'm talking about security, it's also like if you fragment like the Maker protocol, you could, for example, have like an instance running on a layer 2 that wouldn't be secure, because like there would be too much collateral getting liquidated, or people would be able to manipulate it because it's too small in liquidity and so on. So it's also about like the MakerDAO protocol itself is, I wouldn't say fragile, but like if you start fragmenting it around, all of a sudden you need to govern all of those like smaller versions of it too. So that's just why it's very, very complicated. Where like with, for example, like Aave or Compound, something like that, you have a peer-to-peer money market, right? And like the rates will be what they are, because you will have like depositors, you will have borrowers. Where like with us, we have like the stability of DAI and the security of DAI as like the main priority, and that just makes it like so much more complicated, right? If you look at how much governance we have compared to the other lending protocols, it's really like a world to differ.
And so just to add, like since you guys said security, it's a bit of an abstract term, right? So how would we even like quantify it and say, well, there's 10 units of security on Ethereum and 3 units on Polygon, for example? I mean, any thoughts around that? Because I've just used with layer 1, I don't know how to kind of think about the layer 2 security, even though I know it's less secure.
So there are ways of looking at. So I think there are a couple of metrics here. There isn't like that's a very interesting point, by the way. I never thought of security that way. So this has given me some food for thought. But one of the ways of looking at security, number one, would be decentralization, right? So you should have a fairly decentralized network, where you have nodes, in geographically and in different places. So this is one, offers you a level of security, right? So if all the nodes are in one place, then obviously you're open to manipulation. The second thing is, so for example, we run a proof of stake network. So if I were to maybe talk about that, one of the ways is to see how many tokens are staked on that network, right? And so that gives you a level of how much security there is in terms of, let's say, a number. So if I were to put a number, that gives you, let's say, a dollar figure that, okay, we have 300 or 400 or $500 million worth of sort of volume locked in our contract. So that gives us that much of security in terms of the amount of volumes we can handle. So transactions up to, let's say, 150 or 200, 300 or 400 million are perfectly fine. So that's one way of quantifying it. I think another way of looking at security is what happens if somebody does something wrong. So one of the problems in layer 2 is like, there are many ways, many things have been discussed, like, for example, mass exits, etc., or if somebody does like a bad transaction. So what happens if you're a bad actor? So for example, one of the ways we've solved for it is by, having a slashing mechanism where you lose your entire stake, and there's a heavy penalty for going against the network. So if you have a very decentralized network with a heavy penalty, and at the same time, you have a certain volume locked into, or rather staked in terms of tokens on your network, then that in some way offers a certain level of security. Now, is that the same as Ethereum? No. Ethereum, hands down, is the most secure. But I feel these are some of the ways one can solve. Now, to quantify and how you would decide which is more secure is something, which I think we can maybe discuss, because I also am not really sure how we could put like one number behind that metric. I feel that it will be a combination of these factors which come in and then sort of define, let's say, security of a network.
Yeah, because it's definitely not just hash power, obviously. Yeah.
The problem is also, like a lot of, that's also the problem with protocols in general, right? Is a lot of the time you don't know it's unsecure before something actually happens, right? I mean, we've seen some of the big protocols recently, like Yearn, for example, and there was also like not too long ago there was like a compound like Oracle outage, where it's like, I mean, like people might have been like skeptic. I think maybe the Yearn is a better example because a lot of people have been critical of like how compound uses oracles. The Yearn was just like so complicated manipulation, right? And like, how do you even measure that? Like, because like you don't know it before it happens. And I could imagine it's going to be the same with like layer 2 solutions, right? Like some of these things is like no one expected or thought that this could happen until it actually happened. And until then, everyone had this perception that this was safe, but then something happened that, showed that it actually wasn't safe at all. So it's very difficult, right? So I think that's why like I always go back to, like what Dennis said, like total value locked versus how long has it been live? Because, I kind of like make the comparison that the value that you have in the protocol is kind of like the target you have on your back, right? And if someone managed to hit that target, they can basically scoop up the value.
Yeah, that also brings more risks to the big players because the target is bigger. So and there's like even a small chunk can be significant for try and go through whatever walls you've built around it. So yeah.
You guys definitely brought up some very interesting points about security versus prices and so on when trading in DeFi. So I guess we could have continued talking about this for pretty long, but let's go for the next topic. So what do you guys think will make DeFi scale in 2021 and beyond? So is it just a trend like in 2017 with ICOs, or is it here actually for the long term? And like, how do you see the future of DeFi?
Well, I think as I mentioned before, I think this is a completely different market that we are looking at, compared to 2017, where everything was very kind of premature, no real products, no real money, and today we can see real products working for a few years already, still very young. So even the most experienced protocols that we see are quite young, 3-4 years. That's the maximum we can go. So everything is very young, and I think if we wanna see how this scale, into everyone is talking about DeFi doing X40 or whatever during this last year or even less. It's still a fraction of what's going on, with CeFi, with centralized finance. And I think everyone is kind of trying to reinvent the wheel in a way in DeFi, instead of trying to take whatever tools we have in central finance for decades now and try to make them work also in a decentralized way. Of course, I'm looking at that through, the glasses of B protocol, which basically this is what we do. We talk about the backstop solution, and people in DeFi are still looking at us, very in a weird way. Most of them do not understand what it is, don't know about what it is. But this is basically a common practice, in most traditional finance systems, just to make sure whatever positions users take, are kind of backed, and the platform can't get hurt from that. So I think this is something important if we want to see, we're looking at BitMEX, Bybit, all those big, exchanges doing, X100 leverage for users, while DeFi offers something around 3 to 5 in most places. Some have, been encouraged enough to give, X10, and still this is, very very low, and if we want to show some better efficiency for users' funds, so we will need to bring more tools into the ecosystem to enable that. And that's one of the main issues.
Thanks very much for sharing your views. So our time is running up. We only have 8 minutes left. So I suggest in 2 minutes, let's just try to discuss what will be the future of DeFi, and then do 5 minutes for the Q&A.
Sure, I'll just take a quick crack at it. So I think one of the things so there are two couple of game changers here. So apart from being able to sort of get mainstream interest into DeFi and get your average investor also, invest some part of the savings into sort of DeFi is one part of the story where you get more volume. But what we'll see are also interesting concepts, right? Like we just also talked about real world tokenization, where people are looking at expensive art or even, for example, expensive wine to be tokenized and then sort of turned into some sort of investment asset. And of course, we're seeing this with the NFT sort of world as well. So I think this whole NFT plus DeFi element will sort of bring in some new flavors. And then, of course, we talked about security, but one way of solving for security is insurance, right? So you take it for granted that something's going to break, and then you have insurance. And like in the real world, we have insurance, and then we also have reinsurance. So there are ways of sort of solving for that as well. So I think these are some of those concepts which I see, coming out in maybe the next 4 to 6 months.
Totally agree. Cool. So let's jump for the Q&A. There are a few questions in the chat. There is one that is addressed to Gustav. So the question is, Gustav, can you tell us if there are any planned alternatives to how current auction works?
Yes. For almost coming up a year now, ever since March 12th, the community has been working on first liquidations 1.5 and then liquidations 2.0. And liquidations 2.0 will basically allow the liquidation module to tap into DEX aggregators, such as, for example, 1inch could be like a possible solution that I think Kyber might be another good example of somewhere where that could happen. So basically, it's almost finished. I think they're in the auditing process now, and then the community will launch this liquidations 2.0 module. Which will, this is just like one of the main features, but there's like a lot of new improvements that have been made. So yes, there is planned alternatives to how they currently work.
Awesome, guys. So to finalize, what advice would you give to new DeFi investors? Each of you have 1 minute to tell us.
I would tell them not to invest, just to go back to step one and start learning about blockchains and why this technology is amazing and what instant settlement means compared to what's happening in the conventional world, what we're trying to prove, what we're trying to build here, get a good sense of that, and then start learning about wallets. Just take it easy. Don't go straight diving in, and because you will lose your money, and it's a shame to do it like that just because you're rushing to make quick money in the next 3 months.
Yeah, I would say that I think Twitter is like a really good place to start. However, Twitter can both be the worst place to start and the best place to start. There's like the deep ends of crypto Twitter that is dominated by anonymous profiles and memes, which can be fun when you kind of learn how to filter what to listen to and what not to listen to. But there's also some really good people to follow. For example, DeFi Dad, I think, is putting out a lot of really great educational content. Following the different projects, seeing what they're up to. I would also agree with Dennis that jumping straight into the deep end of the pool at the beginning can give you some very expensive mistake money. So I would also recommend start learning, start following the space. If you actually enjoy it and you think it's exciting, stick around and try to maybe over time figure out what works for you. But in the beginning, I would also recommend just learning.
Yeah, same here. I think that's important, to take it slowly, learn a lot. Don't get dizzy because of those huge APYs and things like that you can see. This most of the time it will end bad. So yeah, just learn what you need before UAPing. That's probably important.
Definitely, I also second the same thing. And there's so many like DeFi.Dad is one individual who's come up with so much educational, interesting material. So there are many other blogs as well. Bankless is another amazing place to get more, maybe a higher level insight into the industry. So I think knowledge is what sets apart the people who are able to make a profit versus people who lose money. So I think the more and again, like taking it one step at a time. Like everybody gets, don't fall prey to that FOMO factor and switch off your Twitter for some time, and then just focus on really understanding some of the basics. And I think after that, everything will make sense. And then so I can't stress that enough. I think that is the single most important advice I'd give someone.
Great, Dennis, what is your advice?
Well, I mean, I think I added some at the beginning, just donate pin, and I agree with everything everyone else has said. I think we've covered pretty much everything. Just take a deep breath and just, think twice before doing anything.
Great. Yeah, so we had a great discussion, guys. We discussed many things in the DeFi space, security, risk and reward, Ethereum and other blockchains in DeFi. So now it's the time to finish, and thank you so much. It was great meeting you guys, and I hope everyone enjoyed.
Yeah, it was a pleasure. Everyone. Thank you for having us. Bye.
Thanks, guys. Take care. Bye-bye.
Bye.
Wow, what a great DeFi market discussion we just had. Thank you once again for our panelists. Thanks, Guillermo. It was amazing questions, and we received lots of comments that Guillermo is really good moderator. So thanks once again. And we are continuing our conference, and we are moving on. Our next session is DEX versus CEX. So it's like decentralized exchanges versus centralized exchanges. It's really a hot topic right now. And our next speaker is really pretty familiar guy. He is from Crystal Blockchain, Kirilo Chukradze. I hope I just pronounced it correctly. And his topic is peer-to-peer activity analysis in centralized and decentralized exchanges. I know that Crystal Blockchain, they did recently research on this topic, and I'm sure Kirilo has lots of interesting insights and data to share with us. So once again, Kirilo Chukradze, Crystal Blockchain. Let's move on.
Kirilo Chukradze, Product Director at Crystal Blockchain. Crystal is the all-in-one blockchain investigative tool that provides a comprehensive view of the public blockchain ecosystem.
Hello, everyone. Thanks for joining this session today. My name is Kirilo Chukradze. I'm going to speak about the peer-to-peer activity in general, and also I'll briefly touch the recent regulatory updates, because this cannot be ignored, given we are trying to figure out how things should be structured on that space. Again, my name is Kirilo Chukradze. I'm Product Director at Crystal, and I have to say a few words about what actually Crystal is and who we are. The Crystal blockchain is a part of Bitfury Group, and we went live back in 2018. And Crystal blockchain is a tool for ML and safety monitoring, and with that we offer our service for financial institutions and government authorities. On the market, we have a lot of different customers. Those are cryptocurrency exchanges, peer-to-peer services, banks, and some government authorities for sure. And this covers more than 150 companies worldwide. So we are all in agreement with what centralized exchanges are. However, I want to emphasize what we consider as decentralized exchanges and the peer-to-peer activity in particular. So what you see here is saying that we will be focusing on the those entities that enables direct peer-to-peer activity, cryptocurrency transactions, and some sort of trading to take place online without any third party. And you may have heard about these services. Of course, you should be aware of that. I would name for sure Uniswap, local Bitcoins, BitMax, Paxful, and so on and so forth. Okay, so what is the difference between decentralized exchanges and centralized services? From our perspective, of course, decentralized means that no third party is involved into the trading process, while decentralized utilize custody, so they operate as a custody service for customers' assets. And for decentralized services, we cannot, there is some contract or some technique behind that, behind the operations, while centralized services use another approach in their operations. They utilize hot wallets, they utilize cold wallets for store as a store of value. And of course, they have databases of their users, and this results into the KYC required. So when it comes to decentralized services, usually no KYC or ML procedures are in place for such services. However, for centralized exchanges, we see that most of them have already introduced some policies, and some user data is being collected by these types of services. Of course, sometimes trading on centralized exchanges might be a pain because it requires some sort of synchronization between different blockchains, and when it comes to centralized services, usually it's happening quite fast in terms of trading. And if you, for some reason, if you want to convert your cryptocurrency into fiat, in most cases you'll be utilizing centralized exchanges that have this possibility to send your fiat money to your credit card or to your bank account. So why it's even important to make some sort of analysis on that activity? According to the block research, the most famous DeFi protocol, decentralized exchange called Uniswap, their trade volume exceeded Coinbase trade volume in last September. And of course, regulators had to respond to that somehow. And because there might be some room for money laundering. And actually, any asset that serves as a transfer of value can be utilized for money laundering, and cryptocurrencies are not an exception to this rule. And moreover, in general, cryptocurrencies were promising us far more huge store of value than, for example, precious metals. And now, when we are entering the point of rapid adoption, it might become even worse in terms of money laundering. And now, when we are observing this bull run, let's say, which was heavily anticipated by all blockchain enthusiasts, that's happening right now. And of course, it might happen only if cryptocurrencies will be able to solve the problems which might not be solved by standard finance, by traditional financial system. And I'm talking about unbanked users, I'm talking about those who have no access to lending instruments, and so on and so forth. So technically speaking, regardless of what we are talking about, cryptocurrencies or other stores of value, it doesn't matter what we want to refer to, the adoption and money laundering will be developing in parallel. And this requires demand and reflection from the regulators. So what's happening on the regulators' landscape. It's been quite silent on a peer-to-peer specific regulatory requirements, and the FATF, Financial Action Task Force, intends to release a separate guidance on that on the peer-to-peer activity this year. Sandra Garcia, who is a co-chair of the Financial Action Task Force Virtual Assets Contract Group, is saying that the FATF is still researching on peer-to-peer platforms, but that already refers to so-called unhosted wallets. So we expect more common amendments to the recommendations, which will include red flag indicators that will describe red flag indicators that might be related to this peer-to-peer activity. However, FinCEN proactively introduced a rule in December last year that would impose data collection requirements for unhosted wallets. Basically, we were saying that all the unhosted wallets need to be analyzed somehow, but no one has said what actually unhosted wallet means. And yeah, this year, FinCEN took a break and they decided to investigate this question in more details, and they decided to introduce more amendments later this year. Beside that, there's a parallel process on the travel rule side, and all that covers almost the same. So peer-to-peer activity on hosted wallets and travel rule, all this is related to almost the same type of activity. You may have heard about the travel rule that was firstly released in June 2019, when the FATF issued a guidance for so-called risk-based approach to virtual assets. And this required virtual asset service providers to share specific user information with different other counterparties, other virtual asset service providers, when a transaction exceeds $1,000. However, it was postponed due to a pandemic, and now it's under development again. And the last week, FATF released a new, they are saying that it's set to publish an update to its guidance on cryptocurrencies and virtual asset service providers, which will include updates on the travel rule in particular. And we expect this to be live this week or later in March. So we decided to conduct our own research to understand the volumes and the counterparties of these decentralized exchanges, to understand the activity within the peer-to-peer market. And we also want to confirm or compare these volumes to other blockchain players. In our system, we have around 16,000 of different services that operate with crypto. And beside that, within this, we have more than 100 peer-to-peer services and almost 800 entities that we can consider as centralized exchanges. So we compared those two groups, and here what we were able to come up with. But before we jump into the results, I want to come back to the Uniswap entity and make a quick overview of what we are able to see within our platform. So coming back to the September's activity that was mentioned in the block research, we did notice the same, let's say, increased activity in September, and this activity is tremendous. Just today, I decided to open the Uniswap entity in our platform and filter up by the date, by the time frame. So I just picked this week for Uniswap entity, and I was able to understand that the amount of funds received by this entity now exceeds 1 million of Ethereum value, which equals, if I'm not mistaken, it's more than 1.5 billion of US dollars, which is quite substantial amount, I guess. And with that in mind, we jump into the quarter activity of peer-to-peer services comparing to non-peer-to-peer services. And we noticed again, since the market is in this bull run phase, volumes will be increasing, and it's proven by that that chart that shows how actually peer-to-peer is growing and how it's growing with regards to the growth of non-peer-to-peer services. And you may notice this increased activity in the third quarter, which also was, the spike was also happening due to Uniswap increased activity. However, we see that I think that's not the limit, given DeFi is also in its bull run stage. So we might expect more and more activity happening around that. And it's also important to mention that we did not analyze the tokens activity here for Ethereum blockchain. So we also made this analysis for Ethereum transfers and BTC transfers. And when it comes to a source of funds, so we also need to understand what are the counterparties of these services. And we decided to make this analysis. And in order to do this, we had to categorize the counterparties in some way. And what we did is we made this breakdown into 4 categories, let's say. The first one would be so-called unhosted wallets. I know this not strict. There's no strict term for that, but we consider that as wallets that we consider as belonging to natural persons. Then we have exchange services. It's the third column here, and this includes all the exchange services like ATMs, peer-to-peer plus non-peer-to-peer services like standard exchange services, and so on and so forth. Then we have other WASPs, which is the second column, and this includes online marketplaces, gambling services, payment processors, and we have the last one, the risky entities, and this would stay for all types of, let's say, illicit activity. For instance, dark marketplaces, stolen coins, scams, etc. And you see that the majority is coming from like other WASPs, and we have this percentage comparison here that is saying that for peer-to-peer services, there is a lot of funds that are coming from this, quite big group that includes virtual asset service providers that are related somehow to, let's say, non-regulator approach. When it comes to, it's also important to mention that unhosted wallets activity is also quite bigger for non-peer-to-peer services than for peer-to-peer. And that's kind of important outcome that we were able to come up with, because me personally expected that peer-to-peer activity will be mostly targeted by those who want to send their money from their hosted wallets to peer-to-peer service. And but apparently this research ended up with kind of different results. And it's also important to assess how many of the funds that are entering the different exchange services, what is the part of the funds that are considered as illicit activity. And we see that these numbers keep decreasing, because the overall trend on the industry is that this illicit activity continues to decrease. And for peer-to-peer and non-peer-to-peer services, this is kind of the same pattern. So it's not so big deal, and these numbers are not so big to. Well, it's still kind of several hundred of millions, but it's less than 1% in terms of overall volumes of those services. However, it's kind of huge amount of any activity, including peer-to-peer activity, over there. And we believe that with the kind of weighted approach on regulations alongside the blockchain analytics usage, all of us would be able to make cryptocurrencies a bit safer and a bit easier to use for everyone, not only for peer-to-peer, but for all the blockchain market players. With this in mind, I think I'll stop right here, and I would encourage you to subscribe on our newsletters, to subscribe on our Twitter account, because there are a lot of different resources are coming this year, and hope you'll stay in touch. And if you have any questions, feel free to contact me through my mailbox that is present right here.
Kirill, thank you very much. I really enjoyed this interesting insights and interesting data that they just shared with us. I think that we are still waiting for our next speaker, who is, I don't know where, but we'll try to find him as soon as possible. He will join our stream. So stay tuned, don't leave us. So our next speaker is Anton Bukov, 1inch, leading DEX aggregator, and his topic will be DEX aggregation. And also another thing that I wanted to say about 1inch, we're gonna have another speaker from 1inch. He will, Sergey, he will join us on discussion panel. And another discussion, the next one, discussion panel, DEX versus centralized exchanges, will be huge. Let me just again tell you, participants will be Alex Lebedek Sigma, Bitcoin.com exchange, Danish Shondri, DYDX David Gogel, and 1inch Sergey Kunz. It will be amazing. So we are, let me just again find him. Maybe we can, video producer, maybe we can just play something, and we have some time. So I would love to tell you something interesting while we are waiting for Anton from 1inch. So let me just give you a quick recall what we have here today in our agenda. So after this section, discussion panel, DEX versus centralized exchanges, we have next section is arbitrage and trading strategies. It will be also awesome. After that, we have section security frauds, and it will be two presentations. One is from Xex.io, Konstantin Anisimov. He will be speaking about security aspects of institutional level DeFi investments. The next one will be Dmitry Budorin. He is from Kraken, and topic will be security ranking of top 100 cryptocurrency exchanges. Next one, discussion panel, security frauds. Moderator is again Kraken, Dmitry Budorin. Among participants, Exmo, Xex.io, Amnesia, Ivan Nasser, who is basically, while we were inviting him, he was in Centric, so now he's out of the company, but still he has lots of interesting insights to share with us. And the next next section is regulation and legal issues. How DeFi is solving the stakeholder problems in finance. And we're gonna have a speaker from Aave and a speaker from Crypto Law Partners, the Law of DAOs. So I'm sure it will be very interesting, and please don't leave us. Stay with us. We cannot jump into our discussion panel, so we are still waiting for Anton Bukov to join. Maybe he has some problems with the internet connection or something. So Anna, who is a part of my team, can you please help me to find Anton. As we are waiting for him, we have like 66 people who are waiting for Anton's presentation. I'm sure it will be huge and very interesting. So you still have some few minutes to have your coffee, to have tea or something, or just, I know that it's like lunchtime is over in Europe. So take your coffee and follow our stream. Okay. We are still waiting for Anton, so let's discuss. If you have any questions, let me just go to our Telegram group. Maybe I'll find something interesting to share with you. Anton is here. Anton is here. Anton is here. That's amazing. Okay, Anton, we are super happy to see you here. So it's your turn. The floor is yours.
Anton Bukov, co-founder and CTO at 1inch. 1inch is a DEX aggregator that works out the best crypto prices across decentralized exchanges.
Hi everyone. I'm trying to share my screen now. So I hope you can see it. Okay, great. So yeah, I'm here to tell you about DEX protocols. I will dive deep a little bit for 20 minutes into different protocols, how they like differs from each other, and what is so interesting in this space, you know. So I will tell you about order book based DEXs, about liquidity based DEXs called AMMs, like automated market makers, also about impermanent loss. All AMMs are subject for impermanent loss, most of them, and about aggregation. So basically, what's the exchange? What is a swap? Is when there are like two groups of people. One of them want to buy something, and another group want to sell something. And when they meet each other at some concrete price, they both agree. Exchange happens. Historically, there are like two kind of actors here. Those who create limit orders, they are called makers. They want to buy or sell something with exact price, and they will wait until someone who called takers, who execute market orders, will come and fill their orders. So the difference is simple. Limit order providers, they execute swaps for exact price, but they should wait for someone who will fill their orders. And takers, they will have immediate execution, but the price will not be fixed. It's also like a subject for price slippage. They could execute some orders at the best price and next orders at the little bit worse price. I will also use these words like on-chain and off-chain. It's pretty simple to understand. On-chain data availability means that this data is accessible for smart contract directly. You can just call smart contract and it can read or get somewhere this on-chain data on his own. And off-chain data is data which exists out of blockchain, and you have to provide this data into arguments. You have to tell this data to smart contracts. For example, this data could contain some proofs, like cryptographical proofs, like signatures or any other proofs. So historically, we saw like appeared DEXs in the following order: Ether Delta, 0x protocol, AirSwap protocol, and Oasis. They all are order book based. This means that there are like makers who create these orders and takers who can fill these orders, as I described it previously. And they have some differences. Some of they have on-chain available orders. Some of them have off-chain available orders. So these protocols are different. For example, AirSwap works on demand. You can request for quote and you will get off-chain order, but you can't analyze their order book. It's somehow like hidden. Also, order books can be presented as this depth chart. So this is from the left side, you could see orders from those who want to buy, and on the right side, orders from those who want to sell. And this is like not really interesting because all this existed, all these ideas, they existed before. We saw them in traditional finance, on traditional exchanges, and we see them on centralized crypto exchanges as well. And the interesting thing which appeared first time on blockchain, it was liquidity-based DEXs. First of them appeared in 2017. It was Banker Network project. And the one thing all these projects solved is lack of availability, lack of liquidity. If you don't have any orders on order book based DEX, or there is like a huge spread between prices of for buyers and sellers, you can't actually trade this pair. But new kind of DEXs called liquidity based DEXs, you can just put some amount of assets inside it, and this smart contract will offer supply and demand for buying and selling. Smart contract will be a maker, and we need only takers. Those who want to swap can interact with the smart contracts. Banker Network, as I said, was first project, and it was pretty interesting and innovative. And next project who came up on the horizon was Uniswap Exchange. It was much simpler from math point of view. I will describe how it works. So you can see Banker Network has an idea that it could have multiple AMMs, multiple DEXs. Each DEX should have two assets. And using this star architecture with BNT token in the middle, you can swap any token to any. For example, you can swap DAI to BNT on one AMM and BNT to Ether on another AMM. Uniswap made the same architecture, but they used pretty simpler formula, and you can see it's like looks like Banker, and have all the pairs to Ether. And new version of Uniswap launched in 2020, Uniswap version 2, have ability to have pairs of any two assets, not only to Ether. And one interesting thing that Balancer also appeared in 2020. I will show you. Balancer is like multi-dimensional Uniswap, where you can have multiple tokens and different proportions, not one-to-one proportion. And how it looks like, for example, Uniswap formula is pretty cool. You can come and ask this smart contract that you want to swap. For example, you can see Ether and MKR assets on pool. If you bring some Ether, it can easily compute how much MKR it will give you back. And if you will bring MKR, it will compute how much Ether it will return to you. And the formula behind it, this AMM will try to keep product multiplication of balances of these two assets constant. And this allows us have like geometrical representation. This is like a chart of how balances of these two assets they move. So we can see they will never reach zero. And when you swap, for example, C minus A, you will get B minus D result. And the multiplication of these balances will be the same as you can see here. But yeah, Uniswap have 0.3 percentages fixed fee formula to allow liquidity providers to earn. So some people could put their two assets into the pool in their like equal proportion 1-to-1, and then pool will trade these assets, and at the end you will be able to withdraw, and you will earn all what pool earned for this period on this fixed fee. Balancer is a more advanced formula, and Uniswap is like one of the cases of Balancer. The formula is pretty straightforward. Multiplication of balances in power of their weights should be kept constant. Interesting fact, that both formulas for Uniswap and Balancer, they were proposed in early 2017, like 2 years before Uniswap version 1 and 4 years before Uniswap version 2 and Balancer. It was proposed by Alan Liu from Gnosis project. And one most interesting project is Curve.fi, Curve Finance. It was started in early 2020, and it have a more interesting formula for stable tokens. If you have multiple stable tokens of the same asset, like stable tokens of USD or different stable tokens to Bitcoin, you can put them into this pool, and initially, while this pool is almost balanced, the swap rate will be great. It will have like a fixed fee formula, but the more your pool is imbalanced, the more your formula will look like Uniswap formula. So it is like some kind of dynamic pool where formula is gradually changing from fixed fee formula to Uniswap-like formula. And the next thing, which is important here, is when you have, for example, Uniswap pool with two different assets of the same value, when price changes externally, arbitrage traders swap, they rebalance pool to a new exchange rate, and what's like, if you want to understand what would happen to your portfolio if you keep it on your wallet, comparing to what would happen to your portfolio if you keep it on this Uniswap pool. The difference is impermanent loss. If relative price of two assets changed with some coefficient, you can see it here. You will have the difference. The difference of how it would compare to having these assets on wallet or having them in pool. The difference is here. So if your two assets on the pool change it in price one to each other, no matter in which direction, in 2 times, you will have 5.7% loss, comparing to if you just had these two balances on your wallet and these prices change it the same way. So yeah, it's pretty complex actually. So here we came to aggregators. What aggregators are and what they do. So we discovered, me with my co-founder at New York Hackathon in May 2019, we discovered that all these DEXs have different prices, and you have to check them all before you swapping something. And then we also built system initially which allowed you to automatically select the best source for swap. But right on the hackathon, we came up to idea that the more you swap on each DEX, the worse is the rate. This means if you want to swap less on each DEX, your price will be better. This means that you can distribute your volume among different pools. That way, that price will be super cool. And we can also visualize this as a glasses with different liquidity is there white, and different price is height of the glasses. So there are like multiple ways to fill user volume, and this way is not the best. The best way looks like this. When you equilibrate the price, you will advance price on all these dexes with your swap, and you will equilibrate, and you will leave no space for arbitrage here. And this means that if previously arbitrage traders earned on you, now they can't. After hackathon, excuse me, I'm here again. So after hackathon, like half year after it, we also built more complex way to build roads. We found out that simple splitting among different protocols will improve price, but you could achieve more if you will try to build more complex roads. For example, here, if you are swapping Ether to USDT, you can swap it, some part could be swapped directly. This is not wrong, but you can swap also Ether to DAI, Ether to USDC, and then swap DAI and USDC using some stable token pools. And this means that building these roads is a really pretty interesting problem. And we found like some approaches, some solutions to it, but it have also always will have room for improvement. And that's what aggregators do. They combine all the liquidity of all the different on-chain protocols into single huge, highly liquid DEX. So that's why it matters. Okay. Yeah, that's it. I hope to see any questions from your side. Alex Lebed is asking, what's next? Yeah, the next is building more cool roads because this problem, I'm not sure it could be solved in an efficient way. Like it sounds like NP problem, non-polynomial. And we can always like build better approaches for this problem. And I see that currently we have different problem. High gas fees in Ethereum network do not allow people to trade hundreds of bucks. It makes no sense because fees would cost you tens of bucks, or some complex road could cost you 100 bucks now. And yeah, people are looking for way to optimize their spendings on fees. And we see that number of layer 2 solutions are building, like Optimism, which will be released at the end of this month. And some side chains activity like Binance Smart Chain have 8 times more gas each second, like in each block, and frequency of blocks is higher. Yeah.
We are back to our studio. Anton, thank you very much. It was really interesting data from your side. We did it. Thanks, because I was like, whew, I don't know what basically I can, this gap, what should I tell you? What should I say? So let's move on. And we have discussion panel next. It's decentralized exchanges versus centralized exchanges. And the lineup is amazing. Let me just tell you who do we have here. So moderator, Team Frost, Yield Up. Participants, X Sigma, Alex Lebed. So if you didn't know that fact, that Xsigma just launched last week, and they got more than $100 million in liquidity to their pool on the first day of their launch. I think it's amazing. Bitcoin.com exchange, Dennis Chondry, DYDX, David Gogel, and 1inch Sergey Kunz. So if you have any question to Anton, our previous speaker, you can have any questions, just text us, and we will ask another representative of 1inch, Sergey, just here in our conference. So let's move on. Discussion panel, DEX versus CEX. Move on. No, we don't want to. Video producer, are we stuck? Guys. Okay, I got a message that 1 second. No worries, it's absolutely fine for me. Okay, what topic should we discuss right now? And I have 1 second, but it's not only 1 second, it's already like 20 seconds. So once again, Bitcoin exchange, let's discuss participants. As I said, Xsigma, amazing, very, very interesting DEX launched previous week. Bitcoin.com exchange, you know it. One of the top exchanges that we have currently, and very nice interface. Oh, everything is ready, we are ready. Okay, I guess that we can move on and jump into our discussion panel. Let's go.
Hey, does everybody hear me okay?
1, 1, 1, 2, 3. How are you doing, guys?
Perfect. Hi, everyone. Hey, guys. Oh, perfect. Let's just, well, I guess we don't have everyone yet, do we? Let me see if Danish is joining us, otherwise. I think we'll get one moment, but thank you, Sergey, for your recent overview on the kind of the history of decentralized exchanges right before this. That's actually well done. So watch one of your previous videos. So
it was sent on, yeah. Thanks.
Yeah. So okay, guys. Okay, let's jump in. I think a really hot topic that it's kind of on the top of everyone's interest list of decentralized exchanges versus centralized exchanges. We have a lot of pioneers in both industries right here today. So we have Sergey from 1inch, I think one of the top decentralized finance DEX aggregators, and I think they've really been pioneers in the space. A personal fan, used them quite a bit. Alex from Xsigma. Xsigma, I think, is catching a lot of people's attention. Obviously doing a lot of work in the stablecoin exchange. And by the way, congrats on all the recent success on the recent launch. And Danish, actually a long-term friend, Danish, and has done a lot of great work with Bitcoin.com exchange, and as well as many other friends. And thank you, David, as well. So from DYDX, which is a very, very excited new decentralized project, be able to kind of offer kind of perpetual contracts into kind of decentralized finance. So a good mix for the guys today. But guys, I'd love to kind of jump in right now and kind of go into a kind of a list of things I'd love to cover today. 2020 was the year DeFi essentially came out of the scene, and 2021's really been quite I guess a rocket ship and very, very exciting in its own right. Where are we going the rest of 2021? What's it? What should we expect? And I'll start with you, Sergey.
So what we will expect, thanks, yeah. What we will expect this year from a point of view is a layer 2 very, very soon from Optimism, what I understood. ZK Snarks following at the end of this year from my feeling. And we will see a really great performance because of the layer 2. And I hope that a lot of people will switch to decentralized solutions to just eliminate the man in the middle. Yeah, don't trust anyone. Just keep the funds on your own wallet, and you can do the same actually on in decentral manner if we will have this layer 2 solution. And for sure, we are waiting for Ethereum 2.0. It should come in the next years. Yeah, and this would solve a lot of problems from our point of view. This onboarding problem, a lot of people don't understand that it's necessary to wait for the transaction, and it's not instant directly after the kind of signing it. Yeah, that's my point of view. Thanks.
No, thanks. And Alex, I'd love to kind of hear where you think that we're going in 2021 right now.
Laptop.
Alex, I think we're getting I think we don't have a great connection. Okay, I'm having personal audio problems, Alex. Let's come back to you. Maybe we can try to reconnect your connection. David, actually, on that front, 2021, where are we going right now?
Yeah, so I have to agree that I think that the main theme for 2021 is really layer 2 and scalability. So DYDX just last week announced the launch of our layer 2 solution for cross-margin perpetuals with Starkware based on ZK rollups. We're excited to be one of the first major DeFi players to make the jump to layer 2. I think it's clear that in its current form, Ethereum doesn't scale super well with just 15 transactions per second and hundreds of dollars in gas fees for simple transactions. So I think since last summer, since the liquidity mining kind of boom, fees have been elevated for quite some time, and excited to see kind of a number of layer 2 solutions come to market, ZK rollups, optimistic rollups, among others that some of which are EVM compatible, others are working on it. I think we'll continue to see a number of DeFi applications build on layer 2, and also continue to explore other layer 1s such as Binance Smart Chain, Algorand, Solana, Near, among others, until ETH2 really comes to market. So I think layer 2 is definitely going to be the theme, and there'll be a ton of experimentation over the next 12 months or so.
Okay, no, thank you for that, David. And Danish, maybe on the other side, as the CEO of Bitcoin.com exchange. So where do you see decentralized finance going right now? And
yeah, thanks, Tim. Great to be here. I mean, decentralized finance has really picked up over the last year or two, right? I mean, it's just obvious from this panel that I'm in the minority as a centralized exchange. So we know DeFi is very popular. I think from a centralized exchange perspective, we still kind of pride ourselves in the fact that, yes, it's with our custody, but it is a lot safer than any smart contract that gets hacked on a daily basis, sort of thing. Plus we've got the speed at which orders can execute and people pay less fees, etc. So there are advantages to a centralized exchange. I think there's certain things like regulatory compliance, fiat on and off sort of stuff. But I think over the next year, DeFi is kind of like that elephant you can't ignore. So, from our perspective, we definitely would want to see something that's a little bit more of a hybrid model. Obviously, there's layer 2 stuff, everything coming out as all the panelists kind of mentioned. But I think hopefully over the next year or two, we'll try and bring some of the centralized exchange advantages over to the decentralized finance market. Such as more fiat on-off ramps, which people would like, something that's a little bit more regulatory friendly, and something that can bring our centralized liquidity onto a decentralized market, be it mirroring order books or something along those lines, but giving users that experience while in decentralized fashion.
No, thank you, David, and. No, thanks, Danish. That was really good, and I think that's one of the natural challenges that decentralized DEXs have is how are they actually going to be bringing in money to the kind of ecosystem, and obviously there's a natural reason why centralized exchanges appear to still will have a major impact kind of going forward. But on just the challenges of building a decentralized exchange, and how do you go about kind of building in this kind of ecosystem right now, and especially it's evolving quite quickly. New players are emerging by the day, and just the complexity. So I guess Alex, is your audio kind of back with us? We'd love to kind of hear your challenges of actually building.
If you can hear me, can you?
I hear you good. Yes,
Yeah,
we hear you well.
Well, there are quite a lot of challenges, except what guys already told, because scalability of Ethereum, one of biggest frictions right now to bring a lot of people to the DEXs, because it's effectively creates a certain limit how little capital can you have in order to participate in all those DeFi ecosystem, right? Because the transaction costs like $50, it's just unfeasible to investor change your $100. So only for big guys right now, DeFi is a thing. And when everything will move for layer 2, there would be fragmentation problem, because some of ecosystem will move for Starkware, someone will move with a ZK sync, some will move with Polygon, etc., etc. So we will expect, at least in my personal opinion, we would expect first of all some fragmentation, like someone will have asset in this chain, and this chain, and this chain, and this creates a lot of usability problems, because for people who are new in all this DeFi, it's just overwhelming. I mean, whole DeFi concept is a little bit overwhelming, right? So all those farmings, kind of no registration, so all mechanics is new. So I would expect what is the whole DeFi market involved when a new system appears, it became progressively more complex, and we will have a very big problem. How can we bring new people and explain them in a user-friendly way? Because it's just so many moving parts. It's very complicated to distinguish real decentralized solution from some fake one, kind of to separate scam from not scam, etc., etc. So I think this usability and a sense of education problem would be the biggest challenge, kind of to try to explain in user-friendly way how new people can navigate in all this very involving space.
No, I agree on a lot of those fronts. The sheer complexity, and I guess just to kind of touch on just to expand on that, Sergey or David, the complexity of how to bring people into DeFi. It's the AUM, the amount of liquidity that's actually constantly been on a daily basis entering the market is pretty substantial. But are the amount of people really coming, and are we at a point where it's becoming usable? So kind of leave that out there, David or Sergey.
David, go ahead first, maybe, if you like.
Yeah, I mean, look, I think so far DeFi requires a certain level of expertise, right? You need to convert your fiat into crypto, presumably on a centralized exchange. You need to then transfer those funds to a non-custodial wallet before you're really able to start broadly engaging with a bunch of DeFi projects and services. And so, I think over the last year, the user experience has improved, and people are trying to reduce kind of the barriers to entry. But I think as an industry, there's still a long way for us to go. And certainly given the pace of rapid experimentation in DeFi, I would say overall the complexity of projects has definitely increased. So, I think ultimately for DeFi to go mainstream, we need to build products that users actually want and use and fit a specific use case versus just building to build and hoping that users will come. So I think that's step number one. And then step number two, I think really reducing the amount of friction and making sure that projects are appealing to a broader audience, I think it is critical for mainstream adoption. I think things are better now than they were 12 months ago, but I think there's still a lot of opportunity for the industry to increase awareness. So I think that's point number one. And then point number two, I think it does just go back to this concept of scalability. Again, I think we, given the current ETH gas environment, DeFi is no longer accessible, I would say, to like the long tail of retail who has to pay, $100 to deposit or withdraw funds and want to, make a small transaction. And so, as discussed, I think a lot of these layer 2 solutions will also help address that over the next 12 months and kind of broaden the appeal of DeFi to a larger user base.
No, thanks. Thanks. I think you hit on a number of kind of key points here, and I think I'm constantly going back to in my own mind, and as a guy who's actually building a company in this CeFi for DeFi realm as well. I think the one thing that we keep going back is we need the centralized exchanges, and we need all this infrastructure in order to give access to DeFi, and then it seems like we're going to need them on the off rails as well. So is there a point in time where essentially DEXs are not going to need centralized exchanges anymore?
I think my view is that CeFi and DeFi and SEXs and DEXs will probably, complement and coexist each other for at least the, medium term. The reality is like, I think centralized exchanges provide a lot of valuable services as, many are regulated fiat on-ramps for people. And so, whereas I would say the majority of, DeFi protocols and DEXs do not do KYC or AML and don't have the ability to support fiat. So, I see those relationships being, symbiotic, at least for the next few years. And ultimately, like, CeFi and DeFi are really still on like the same team. Like we're going after the traditional financial system and getting new people to join kind of the broader crypto ecosystem. So, my view is that the relationships are quite complementary, and you'll see kind of a greater set of products and services that are at the intersection of DeFi and CeFi. But I do think, and we see this with Uniswap, where volumes on Uniswap on a daily basis are at times larger than on centralized exchanges like Coinbase. And so I do think that the viability in the long run of a centralized exchange is put into question by community-owned decentralized exchanges, and I think that dynamic is probably likely to accelerate as more projects move to layer 2 and more projects kind of have better alignment of interest between their users and owners of the protocol.
Sorry, just to jump in here, Tim. I agree with you, David. I think there is a happy medium between centralized and decentralized exchanges. I think we can coexist towards the same cause, which is what we're working towards, and so we work with DEXs quite closely as well. Many of the projects that we list also list on DEXs as well, and we kind of share volume, etc. I do think that there is a bit of so when I look at a DEX space, I really applaud our community and users, etc. It's great that Uniswap has all that volume, and when it generates a lot of that volume, etc., etc. But I think to me, it's almost like a circular economy where one person who's already entered the market is already interacting with somebody who's already in the market, sort of thing. They've been onboarded by the centralized exchanges and payment processors to get the fiat in. But I think to really grow the size of the industry, to get new participants in, because Tim, Yield's doing really great with bridging that gap of bringing that centralized the advantages of centralized usability perspective to decentralized yield-bearing instruments and all this sort of stuff. So that's fantastic. But I think we need more of those to grow the ecosystem in general. It's not just people trading on Uniswap can trade on 1inch and everybody swaps ETH from USDC to some token. We need people in the wider industry being able to just open up an app and start trading right away, or start putting their fiat in and that sort of thing. So I think there's a happy medium. I think we can all kind of attest to that, and we're all working towards a central goal. But I think that usability needs to really come about so that you can get your neighbor onboarded onto DeFi, your grandma to start using a DeFi product for her savings rather than going to the bank sort of thing. So I think that bridge still needs to be put into focus.
No, thanks, Anish. So I think that brings up a lot of good points right here. And when are the people going to be ready for decentralized finance, or just DEXs overall? That not my keys, not my coins, that type of argument. So I've my own personal experiences and I build centralized fintech companies, and the crypto world is kind of my personal background, and I've never got over that barrier that people need to control their own assets, and just I think from the personal experience of just that people don't manage things properly. And so if we look at what does the future look like, I feel like the people who really can actually enter this field, that really know how to enter their keys. Of course, there's the youth that is entering this, and they will adopt very quickly. But there's some sort of barrier that are we going to ever cross? How is it? Where do we get to where we're potentially, I don't know, more than 50% of people that are in crypto will be essentially using directly decentralized exchanges and managing their own keys and their own coins that way, and or does it not get that way? So, Sergey, I think you've built a very incredible product with 1inch, and where do you see that going?
So I agree that it's difficult maybe for some people to manage own funds, but I see it's in the next future that people would migrate to this idea and use it, and try to keep own funds on own wallets. We have seen a lot of hacks on the centralized exchanges, and I'm pretty sure there are some hacks which were not published yet. Yeah. And of course, there are also hacks on the DeFi space, but because of teams which didn't take serious the security part of the project. So, and but if you look at the normal, like the blue chips right now on the DeFi space, like Compound, they are long-term stable without any hacks, and people are using them directly from Argent Wallet, for example, and other products. And I hope that people will manage own keys. For that, of course, you need right tools. Like you need wallets where you don't have to trust, where you are sure that the funds are safe. And there's some out there, but most of them are centralized, and still there are admin keys and possibilities to by getting hacked on the backend side. Yeah, there are still possibilities that someone will lose money. So yeah, that's my point.
Yep. Yeah, I can see you still. It seems like there's still quite a reliance on centralized exchanges and what you're thinking. So, I don't know, does anyone, Alex, do you see a near future where that chasm is essentially crossed, where people are in masses managing their own assets?
Quite honestly, yes. Probably the tools have to involve. So because MetaMask is not really user friendly, and I think it's a leader right now in DeFi space, Trust Wallet does a very amazing job. I would like to comment on stuff what you told, that you do not really see a real need for users to manage their own keys, as I understood, because you never encounter any problems with that. Because I did. Actually, I got scammed by Binance, and hey, probably you don't see because the light is back. So here's me live, Alex Levitt, and I say out loud in a conference that Binance has scammed me for 2 Ether. So I deposited 2 Ether from my wallet about 3 years ago, and up to this date, I wasn't able to withdraw my Ether. So they didn't allow me for some absolutely ridiculous reasons. And it's not that it's very often I happen situation like that, but it's once in life enough to lose absolutely complete trust for any centralized money provider, as for me. So I think more and more people will encounter some frictions and will lose money or have very huge inconvenience with centralized solutions. People will try to move for decentralized solution, even if it's less user experience friendly, even if it's less comfortable, even if it's less cheaper, right? Just because this absolutely burning feeling of losing money, of unfairness, of powerless. Because me as an individual, when I just delegate my money to some financial organization, whether it's centralized exchange or even a bank, and they took advantage of me, I feel absolutely powerless. I feel like I'm like little man. I've been able to do absolutely nothing about that. And but right now I keep 99.7% of my money in crypto. I never felt in my life such a freedom. You know, not a freedom because it just goes up. I don't really care whether it goes up or goes down, but the feeling what I'm the only person who is responsible for my own money, and not anyone in any kind of centralized exchange, not in kind of United States, doesn't really matter is it good or bad. Intention are nice, but capability what matters. Able to freeze my money. And I think more and more people who would have some problems with centralized exchanges and have a test of freedom of decentralized solution will be like an advocate of all this like DeFi movement. And it might succeed. I see some potential kind of future where a lot of people use DeFi even with this very inconvenient user experience as for now. But the more money will come, probably the better solutions we'll have. So I see the kind of transition period where people use centralized and decentralized exchanges, but honestly, I would rather see a decentralized future than like coexistence.
Yep.
So I mean, don't get me wrong. You know, I'm all for decentralized. We at Bitcoin.com we straddle both, like as in the exchange is centralized, But a wallet, which is a premier tool, is non-custodial. Your key is your money, all that sort of stuff. But I don't think that an exchange hack is justification for saying, DeFi is so much better when every other protocol in DeFi is being hacked on a daily basis, right? Hundreds of millions are being lost. Just yesterday, Meerkat Finance, I think, got away with like 30 million. Well, that was a scam, obviously. But all these protocols get hacked on a daily basis. It's just so much easier to blame a centralized exchange for one hack that happens a year, sort of thing. But again, don't get me wrong. I'm all for DeFi solutions. All your keys, your keys, your money, etc. But I think the hack is a poor argument to say like, oh, DeFi is so much better.
Just to be clear, I never mentioned a hack. Binance didn't hack me.
I'm generally commenting.
Yeah, good point. Thank you.
Yeah, I mean, I just add a few thoughts here. I mean, overall, I think that DeFi will like increase its market share over time by reducing frictions for onboarding and working with different non-custodial wallets who are innovating on private key management. The reality is like industry insiders today, like a lot of people care about self-custody, but your grandma in the vast majority of the world probably doesn't. And so I think when you can abstract a lot of that complexity away, but still provide, that core property of self-custody to users, we'll be able to onboard a lot more people. Similarly, I think, right now, most DEXs and most DeFi protocols, like the user experience and the UI are really, hard for the average mainstream user to really wrap their heads around. You have to be pretty technically savvy to just understand what's going on, and there's no standardization whatsoever. Over time, like there will be some form of convergence where I think, DeFi UI and UX will reach parity, if not supersede CeFi. With our new DYDX perpetual cross-margined exchange, like I honestly think we've built one of the most user experience products in DeFi by far. And we've hired kind of skilled designers to really build, an exchange that looks and feels like Robinhood, except that's fully non-custodial. And I think as an industry, that'll only improve over time. On the hacking side, like, I take Dinesh's point, like people have, regularly pointed out the risks of centralized exchanges in the past with them getting hacked. I think to this day, the vast majority of DeFi protocols have not been hacked, but that is the double-edged sword of open source smart contracts where, I think the most high quality projects and development teams are focused on security and increasing security guarantees, doing audits, sharing their code publicly, and allowing anyone to come in. And so, over time, as more and more protocols get hacked, people learn and they improve kind of the underlying code. But ultimately, like in the same way, users are responsible for their keys, like, users shouldn't be putting their money in untested and unaudited projects without expecting there to be a large risk of them losing their funds. And so, I think that the onus is on the user, but over time, I think security will only improve in kind of the DeFi space as more of these things happen. And then finally, I would just say, again, I think with layer 2, like the speed, usability, and the number of attractive products that will exist in kind of the DeFi world will only accelerate. I think whether it's new risk management tools like options platforms or tranche lending and CDOs or insurance, like these are all tools that help, sophisticated investors better manage their risks. And you're already starting to see like financial primitives in these types of risk management tools emerge and grow in the space. And I think as these types of tools become more mainstream, we'll see larger adoption from sophisticated investors who understand how to manage their risk across different platforms in a more capital efficient way.
No, thanks, Dave. So guys, I think I'm echoing right now. All right, so I think we got one final question for the group. So maybe just kind of one minute. Ethereum obviously has led the charge and kind of into DeFi. It's now facing a serious competition, and love to know how you kind of see us kind of shaking out, whether it's a Cardano, Polkadot, and kind of, you know, does Ethereum remain the winner, or does someone else emerge? And how do you prepare for this for your own personal businesses? So go ahead, Sergey. I would love to hear your thoughts.
I can start, yeah. So we see that something better than Ethereum can be only Ethereum. So we are waiting for Ethereum 2.0. Every one of us have to rethink everything, because we will get a sharded architecture with Ethereum 2.0. We can already train a little bit with Near protocol, for example. They have also proof of stake sharded architecture. So other chains are not really attractive for us. So we added support for multi-chains on 1inch, because we have seen a lot of traction on 1inch chain, smart chain, because there are no projects, there's liquidity, and it makes sense to aggregate and also offer own protocol on this platform. But I don't think so. There's Ethereum killer out there.
Okay, thanks. How about you, David? Anyone that can overtake Ethereum at this point?
Look, I think it's in my mind, it's Ethereum's to lose. I think Ethereum just has the building blocks, the users, the tools that have made it successful today, and it's reached, it settles at this point, billions of dollars in transactions, and has become the settlement layer for most DeFi applications and users. So I think, now you're starting to see users test and migrate to, other blockchains and sidechains. And ultimately, I think we may see kind of a multi-chain world with like interoperability solutions across different chains, with like tools to reduce the friction for developers and users to, adopt the infrastructure that best meets their needs. So, I think Ethereum will probably be the bridge among all of them, but I could see, a number of DeFi protocols support multi-chain applications in some way, shape, or form.
Thanks, David. Danish, does anyone?
Yeah, I mean, where we tend to say chain agnostic, but as we think about DeFi and venturing from an exchange perspective onto the DeFi space and seeing how we can evolve into a DeFi product as well, or at least have a swap product that's going to compete in the DeFi space. I think for us, something like Polkadot holds a lot of promise. I think Gavin's taken a lot of the stuff that he built with Ethereum and kind of optimized it to be a lot more intercompatible. I think that's going to be like the gas fee issue that's going to be resolved with Polkadot. I think the intercompatibility. I think the chain architecture that they've built with Polkadot. I think that's going to be probably the Ethereum killer. And I think he's done a good job really building that community, the tools. You can just go to the Web3 Foundation and they'll give you a ton of resources. For you to build on substrate takes like 15 minutes. You can just open it up and start coding away. And yeah, I think the interconnectivity and bridges, etc., that they're going to bring on is really going to give Ethereum a run for its money.
Thanks for adding that, Danish. And Alex, with building out X Sigma, are you guys looking at potentially adopting other protocols that you think are potential winners?
Yes, we do. I mean, I'm not in a position of making predictions which chain would succeed, but I totally see a possibility that Ethereum will lose into smart chain competition, because think about that. Like in October of 2020, like in a peak of this hype of DeFi, well, not a peak because it still kind of goes up. MetaMask had about like a couple of million monthly active users. So I can approximate what MetaMask probably responsible for like majority of DeFi users. It's nothing, absolutely nothing in scale of finance. Like a couple of million people. If you see farm project, right, there are always about 750, maybe 1,000 farmers, right, people with capital. Like the world is large. I mean, there are like 8 billion people on this planet. And Ethereum just like within this million, like I totally see how cheaper, faster, more secure, more user-friendly chain, maybe near Avalanche, maybe something new appear, will overtake Ethereum, and we will just remember it only in our stories like in 10 years. So I wouldn't be that definitive that Ethereum like winners and already like takes everything, because it just doesn't scale. It has a lot of problems. Yeah, a lot of solutions, but I'm not certain which chain would succeed. So therefore, our strategy just to be adaptive and try to ship fast. Basically, if any new chain would succeed, we'll try to like ship there as well and see how market will decide. But I'm not that decisive what Ethereum is like winner and not going to go away. Probably Bitcoin is, but not Ethereum.
No, thanks for bringing that in, Alex. And I kind of tend to agree with you. I think in the short term, it looks like Ethereum is the likely winner, but in 10 years' time, it is a lifetime away in crypto. So I'd like to thank you all, gentlemen. That was an excellent panel today, and appreciate it.
Thanks, Tim.
Yeah, thanks for organizing.
Thanks, Tim.
Sure.
Thanks.
Thank you, guys. We really enjoyed that panel, and we received lots of comments in our Telegram group that Team is amazing moderator. So thanks once again, Team, for joining our panel, for your really nice, interesting, awesome topics, questions. So thanks once again for our participants. So, and we are moving on. We have another discussion panel. The name of it is Arbitrage and Trading Strategies. So we have three panel discussions, 3 panelists and 1 moderator. So first one is Eugene Loza. You probably know him as Excavo. It's #1 TradingView trader. Michael van de Pop, he is from the Netherlands, and he was present in our previous conference in Amsterdam. And of course, we invited him for a second time. We have Eleni Steinman. She is from Bloxroad. And we have our moderator, Issele Lagevardi. I think he is Italian. But okay, we are moving on. We are jumping into our discussion panel, Arbitrage and Trading Strategies. Let's go.
Thank you for the kind introduction, Natalie. First of all, I would like to welcome all of our online participants from around the world to the online DeFi edition of the Conference.Exchange. My name is Issele Lagevardi. My friends call me Issele. I'm a full-time liquidity provider, investor, digital asset trader, and DeFi contributor in the space. Unfortunately, due to illness, Valentino Cremona was unable to moderate today's crypto trading and panel discussion. So hopefully it's nothing too serious and he recovers very quickly. Therefore, I will take on the role as the moderator today. So with all due, the aim of today's crypto trading and panel arbitrage panel discussion is to give the viewers at home a good insight into the profitable trading and arbitrage opportunities and techniques that have emerged with the proliferation of DeFi over the last 12 months. So as well as point out maybe some of the risks that traders, investors, and liquidity providers are faced with when trying to manage and deploy their risk and capital exposure within the space. So I've prepared an agenda for today's panel, which should last around 40 minutes. And if any of the viewers at home have any questions, please do not hesitate in posting questions in the chat so that I can collate them for a Q&A session towards the end of the topics of discussion. So moving on, I know Natalie's given a slight introduction to our panel members, but it would be a great honor of mine to introduce Eugene Lazar. Eugene is the chief executive of Xavo.Finance and is currently very involved in working in the DeFi space. Xavo.Finance is an Ethereum-based on-chain automated market maker that uses liquidity reserves to minimize the trading costs, pricing discrepancies, and slippage within the crypto exchange market. Eugene also has a very long history and proven track record in the crypto and finance industry as an accomplished analyst, trader, and investor that has made several good bets to date. Furthermore, it's a pleasure of mine to introduce Michael van der Pot. Michael is the founder and owner of Von Sanker Crypto. It's an online coaching platform specializing in educating investors and technical analyst traders on how to assess market sentiment and price movements accurately. And Michael is also very well known for his regular contributions in publications and platforms such as Cointelegraph, Crypto Benelux, and his TradingView posts, where he shares a lot of technical and market-based analysis and posts to his followers. And last but definitely not least, it's a pleasure of mine to introduce Eleni Simon. She's a graduate from Yale. Eleni has a long, distinguished career spanning across finance and banking, management consultancy, and strategy and operations. And he currently heads up the strategy and operations at Bloxroot Labs. And she's also very well known for her crypto blog and posts. So definitely check that out on EleniThinks.com. And she's also a contributor at ChicagoRelayNode.substack.com. So, please have a look at that. So Natalie and Anna have done a great job in putting a very accomplished panel of speakers together. So without further ado, I would like to kickstart the panel discussion and debate, and I've prepared a few questions in advance, which I'm confident will hopefully lead to a very informative discussion between our panelists and for the viewers at home. So the first topic that I prepared and I'd like to discuss is how the emergence and proliferation of DeFi assets and protocols have really impacted and changed the way that traders and liquidity providers like yourselves deploy capital in the space. So, Michael, if you don't mind kicking off the panel discussion, that would be much appreciated.
To be honest, it didn't shift too much, as I'm a very technical trader, through which I'm not really into all that like liquidity providing stuff. So maybe one of the older members of this panel do more with it than I do. The only thing that's changed is that the overall sentiment of the market has shifted from Ethereum solely towards other platforms. So therefore, you've got a completely different market sentiment. But it didn't change my way of trading at all. So,
how about you, Eleni? Have you noticed an impact in the way in which you approach trading or approach buying or selling different types of financial instruments in the space?
I definitely think it's increased the competition. Now you need to have, run multiple nodes in multiple regions, make sure you're really well connected to the network, and arbitrage opportunities are becoming much more fierce to capture those. So with more money, it definitely just means people are investing more into building better bots and chasing yield. And so I think the competition will just get steeper, and eventually we'll be somewhere with traditional finance where a nanosecond of trading is the type of edge you need to win.
Yeah, the reason I asked is because as a trader myself, I've noticed that a lot of the volume that I conduct buying and selling digital assets has was moving more and more towards DeFi, towards DEXs, towards various different types of LP tokens that I can trade into, and also not only make money on the appreciation of the underlying token itself, but also make money on potentially on the yield farming rewards or the exchange fees on the underlying LP tokens. So, so I would like to hear your opinion on it, Eugene, if you don't mind.
My trading strategy is not changed in traditional market, in traditional crypto market, but DeFi it's something new, and of course I try to be a liquidity provider on our platform, in other platforms, but you know, I see this industry will grow, and another instruments will like continue development, and I see potential in this area. Something like
So
that.
as a follow-up question, what are the, I guess, the next generation or new types of financial instruments that excite you, Eugene?
Yeah, for sure. Also, we will add synthetic assets in our platform, and now you can trade already with like SpaceX shares, like not shares but synthetic assets, and it's interesting. That's why I see potential.
Yeah, I'm a big fan of Mirror Protocol. I'm not sure if you've heard of it. It's a synthetic asset protocol which enables you to deposit collateral and then mint synthetic assets that are in essence pegged against the collateral that you provide, which allows you to gain the potential for adding exchange revenue as well as yield farming rewards to traditional assets like stocks, for instance. So as a follow-up, what part of the DeFi ecosystem do you think will be the most profitable to be in? So what part of the ecosystem do you think will generate the most alpha? A lot of people are very excited about DEXs, some are very excited about vaults, some are very excited about lending and borrowing platforms, insurance protocols, etc. So what part of the ecosystem are you most excited about, and do you think has the best risk reward or profit potential for new or less experienced investors or traders that are entering?
Did you say Eleni? Me? I think.
Yes, I did.
Yeah, I think that the answer changes with time. In the short term right now, we are seeing the protocols that are providing power to their users in the form of governance tokens or yield farming are for sure the most profitable, but I can't see that lasting forever. I mean, we saw SushiSwap come in and take demand from Uniswap, and I'm sure there'll be the next generation of comp and different automatic market makers that continue to fight over that market share. And so it'll keep moving, but as we build more of the financial Legos that you need to actually get to an end customer use space, something I'm excited about in the long term are NFTs, but not necessarily art, but in terms of digitizing digital ownership. So it's, sound bites, it's logos, it's the different widgets that can interact with a larger consumer base. And I think maybe in 5 to 10 years, the majority of yield will go towards those type of.
That's very interesting. How about your opinion, Michael? Where do you think the most, I guess, profit is to be had in the space? Just trading market movements, or do you think there are other, I guess, areas of the space that potentially interest you?
Well, definitely in the short term, it's the more lucrative and complex some protocol is, the more revenue you can make out of it. And that's what we see right now. You've been discussing it with all those LPs that is currently happening, which is not benefiting any of the retail end customer at all. As like we are already having a discussion on that topic, and I'm having a hard time understanding all those stuff either myself, and I'm a professional trader. So I think the overall concept of NFTs and making an ecosystem that is fully DeFi and we don't need any banks at all, that settlement where the end user doesn't know that they are using blockchain, that's where the actual revenue is going to be made, as that's the big end game. So I'm more focused on the entire ecosystem with DeFi, oracles, NFTs as well, but then I'm more about tokenizing value instead of the art and all the collectibles that's going around right now, that's going to be big as that's integrated into DeFi. I believe that that's going to be something that we have to work to rather than focus on making the highest amount of yield farming, because that's just some financial instruments built for the short-term gain. And the end user will never, ever use that at all.
And Eugene, do you have anything to add to the debate?
No.
Okay. So I guess the next question would be, as someone who's been around the digital asset space for some time, a concerning observation that I've been making is that many new and established participants within the DeFi industry simply do not fully understand a lot of the risks, or even are able to comprehend a lot of the risks that they are taking. So what suggestion or tips and tricks do you guys have in identifying red flags or techniques that help you, I guess, assess or measure the risk that you're taking? Michael, if you don't mind kicking off the debate.
Well, it's funny, like the more retail that's going to jump into the markets, and I speak with some of them, the first question I get is, what do you think about Ripple, for instance? That's literally the first question that I get, and not about the opinion that I have on XRP or whatever, but you have to read and understand the assets that you're really trading. And next to that, make it simple first. If you don't understand Bitcoin, don't try to understand DeFi. If you don't understand Ethereum, don't try to understand liquidity pools. So try to understand the assets itself. Trading just regular markets is risky at first. And then when you go to Uniswap or to SushiSwap to swap some tokens into liquidity pools, that's just another level. So just keep things simple. Don't listen to all the noise. Like 99% of the stuff that's on social media is complete garbage. Even MSM media is complete garbage. So just make it for yourself, make it simple, and make a long-term plan. So like low time preference instead of high time preference, and start building from there onwards instead of chasing that 50K API percentage liquidity pool. That's just not going to work out. So yeah, that basically is.
Yeah, I totally agree with you, Michael. I've had similar experiences where a lot of friends of mine have been sending me screenshots of a new farm with 10,000% plus APY. And I think a lot of the misunderstanding is that a lot of these newer investors actually think that they will be able to get risk-free returns or somewhat risk-free returns of a 10,000% interest, when they don't realize that the APYs are unstable. And the reality is that no token that pays out 10% APY will be able to sustain that rate of inflation without severely debasing the token that they're paying out the rewards in. So it just undermines the whole principle. I remember a friend of mine, he sent me a farm that he was in that was paying him 3,000 or 4,000% APY in the native governance token that he was farming. But given that they were the protocol that he was in was also paying out numerous other smart contracts and vaults, the reality is that even though he was getting thousands of percent in interest, he was actually getting a negative APY because all of the other rewards that the protocol was paying out to other smart contracts, he wasn't receiving. Thereby, these other rewards were debasing him at a faster rate than the interest rate that he was getting. So I think it's really important for investors at home or newer traders in the game to really try and wrap your heads about what is real APY and what is kind of a fake or unsustainable APY. So if someone's offering me 5% in Bitcoin, I'd much prefer that than if someone's offering me 1,000% in a very highly speculative token that is being paid or funded through the debasement of the token itself. So just as a follow-up, Annie, what is your, opinion on the matter?
Yeah, I mean, the first thing you learn in finance is the relationship between risk and reward. If you're getting a 10,000% APY, like you should be asking yourself why, and it's likely because it's such a risky investment that they need to offer such a high return to entice investors to put their money there. But on a more practical level, I think there's three things I tend to look at in any project. Like first, what's the protocol risk here? Is this contract audited? how long did the team spend trying to develop, what's their debugging process, things like that. And then the second is like, who built this? If it's a team that you know and trust and has built protocols in the past that have been successful, it de-risks a bit the fact that they're invested in the success of their product. And then the last is, you do want to look at who else is involved. For better and for worse, having VC funding does signal that this is a serious project that does have long-term horizons or long-term look of their product success, because that's what a VC will demand. And so maybe you lose on some of the APY because a VC comes in early, but it does de-risk the investment, and you're probably less likely to lose your money because there's a protocol glitch.
No, I absolutely agree with all of the points you made. I think it's a great indication, based on who's already involved in the project, how much due diligence and, I guess, attention to detail has already been, directed at the project. And if, a newer project is able to withstand a lot of the due diligence and tough questions that established VC has in the space, or some, more established participants in the space, then most likely that project has a much higher probability of succeeding than projects that, you don't, do significant due diligence there. So yeah, I absolutely agree with Eleni. As an investor or trader at home, it's really important to try and assess as many technical risks as well as financial risks before deploying money in the space, because it's very, very easy to spend money to a wrong contract. But moving on, a very interesting topic that I would like to discuss is how to try and navigate the dark forest, so to speak, or the public mempool, because as a trader that's moved a lot of his volume from centralized exchanges to decentralized exchanges, I guess one of the advantages of centralized exchanges is that no one is able to see the order flow before the orders are settled. Unfortunately, with public blockchains or trading on public blockchains, you need to issue your transaction or your unconfirmed transaction into the public mempool, so that, in other words, other actors within the space can see your trading orders ahead of time. And the problem with that is that it gives the rise to the possibility of traders trying to front run you, or program bots trying to front run your trades. And this is a problem, unfortunately, that I'm running into more and more now. What is your, opinion on it, Michael? And what solution, or I'm guessing because you're still a very technical trader, does that even affect you, given that I'm guessing a lot of your trading volume is still on centralized exchange?
Yeah, there's like pros and cons for both, right? So there's pros with centralized exchanges that you can go somewhere if something goes wrong. You can see the order flow. It's all pretty transparent, but like in some way transparent. It's not, but it's some way transparent. While in DEXs, you've got gas fees with Uniswap, etc., being extremely high, or the problem that you've discussed. I've chosen to minimize my risk through having centralized exchanges and using them still, as I don't see that DEXs are way better than centralized exchanges at this point. So I try to avoid to go into the rabbit hole and into that like big basket of all tech geeks playing around and just stick on the centralized exchange, simply also because it's quite hard for me to educate people with Uniswap stuff and let them go there. For a risk approach, newcomers, I don't want to push them towards the DEX. Let them first understand how to work with a SEX and how to work with those tradings and the volatility in general. And then if they want to deploy some money towards the market or Uniswap, then they can go there. But they shouldn't be going towards the DEX immediately, in my opinion. So I try to avoid it a little bit.
If I could make a shameless plug, Bloxroute, and I'll talk about this in my presentation afterwards, but we actually have a product that we call private transactions that allows you to send your transaction directly to a miner who is not going to propagate it to the rest of the network. So it'll sit in their mempool, mine a block and include your transaction, but that transaction doesn't become public until it's included in the block. And so we've seen a lot of our customers are sophisticated traders who are doing exactly what you said. They're trying to avoid being front run by someone else that sees their transaction and steals the opportunity.
Yeah, I think that's a fantastic point. That was one of the questions actually that I wanted to ask you about. Hopefully the emergence of private mempools will try and alleviate some of those fears. So moving on, I would like to talk a bit more about the cross-ecosystem arbitrage between the centralized institutions and also some of the decentralized applications. So one of the key trends that I've noticed is that a lot of the big volume hits a lot of the, I guess, more liquid centralized exchanges first, and then you have the market starts moving on the centralized exchanges first, and then you see a lot of, I guess, arbitrageurs arbitrage a lot of these, larger liquidity pools, and that then moves the price towards the movement of out of the centralized exchange. So, have you noticed a similar, a similar dynamic in the market, or and do you think there will be a lot of, I guess, opportunities that emerge from these types of trends moving forward? Eugene, do you mind?
He's gone, I guess.
Okay, well, in that case, I guess, I'll like to swing back to, and ask you, Annie, what's your opinion on the matter?
Yeah, I think this is related to your first question, which is, how does the rise of DeFi change things? With more participants, we are seeing markets become more efficient, and that adjustment between centralized exchanges, pricing, and decentralized exchanges is happening faster. It might not always be equal, and I think that is likely due to high transaction costs, quite frankly, on the centralized exchanges. So you might see a price that's slightly lower, but it costs you like $15 in gas to execute. So it ends up net being the same.
So as a follow-up question, a lot of people in the space have recently been talking about the emergence of layer 2 solutions, whether that be Matic, Loopring, now also with optimistic roll-ups. So what are both of your opinions on layer 2 and how that could potentially affect the trading market moving forward?
Is that towards me then?
I mean, how do you think, do you think L2 will be able to compete with centralized exchanges, given that it lowers the gas fees, at a huge order of magnitude?
Well, it's a few different topics that you're asking there. Like initially, it reminds me a lot about the start of this entire crypto space, in which we also had big arbitrage between Bitfinex and Binance back in the days when there were still only a few centralized exchanges. Over time, that decreased because of new exchanges were coming into the markets, through which that market became efficient. Then you've got the discussion between which is leading, futures or spot, but that's a completely different one. And now we've just got the first stage of DEXs coming around, in which we just have a few of them, and there's still lots to gain there. As in, the market is inefficient, which means that there's still a big gap and there's still arbitrage to be made out of there. And once second layer solutions are going to kick in, the transactions are going to be faster, through which also the fees will be decreasing, which makes it easier for new participants to join with a new DEX to make the market more efficient. So I think it's going to be beneficial for the markets in itself, as we are still in a very early stage of DeFi in general. But it just takes time. It's the same with NFTs. It's just going to take time.
If I may have another shameless plug, BlockCrowd, our mission is to scale Ethereum, and we want to do that at the networking layer, which scales level layer 1, like the actual layer. And I think in this world, the demand is so much bigger than the supply of additional things that we can provide and layer 2 can provide. And for any layer 2 to be successful, it's dependent on a layer 1 that scales. And so we see that, you know, you kind of need everything, throw everything at Ethereum to make sure that it continues to be the place that people go for DeFi, because we are seeing competition from, you know, Block, Polkadot and Cosmos and other chains that are getting onto the DeFi, into the DeFi game. And, you know, if layer 2s don't come soon, I'd be afraid that a lot of that value will move elsewhere.
Yes, I'm getting very similar feedback from my friends and contacts in the space that there's only so much gas that they're willing to, or gas costs that they're willing to accept. And it's getting to a point now whereby they are informing themselves and learning themselves about the different options and availabilities that are coming to the market, you know, whether that be Polkadot, whether that be ADA, or a couple of other of the, you know, smart contract platforms. So we got a really good question from one of our viewers, and from YouTube. His name's, or her name is Crayfish, and their question was, they're really worried about DEXs, and given that there's no KYC requirements, and there's a huge, I guess, concern of money laundering and terrorist financing amongst regulators around the world. So, you know, given the amount of money that's moving around the DeFi ecosystem, are there any particular compliance risks that newer traders or investors should be aware of, you know, going forward potentially throughout the next 6 to 12 months? Eleni.
Yeah, I mean, I think that this question must be someone who's sitting in the US, because we're a lot more concerned, I think, than people in other countries. And I would take it into the perspective of like how big of a player you are. You know, I've heard from, we're a Chicago-based company. We know a lot of the Chicago traders, and they've been jumping through hoops to be able to trade on DEXs because they can, for the exact reasons that you've described. But if I trade on a DEX, I don't trade much money. I think chances are, like, the US government isn't coming after my $100 that I'm trading, but it's for sure a risk. And if that makes you uneasy, like, I think you should probably then trade on centralized exchanges that do KYC. I think in the future, and we've kind of seen a glimpse of this, the US government has threatened to limit on-ramps. So they've made threats about getting rid of non-custodial wallets, which, like MetaMask, you know, a way that you can interact. And we might see MetaMasks in the future ask for KYCs. They're a US-based company. I mean, that's how the government works here.
Yeah, that would be very nice. So, Michael, from a European point of view, do you notice a big difference between, I guess, how the North Americans are approaching compliance issues and risks, and how many European actors within the space are doing the same?
Well, I guess it's quite similar. I'm in the Netherlands, and we are not really user-friendly over here, as there's all those restrictions coming into exchanges and KYC and making it very difficult, especially through the fiat gateway, right? That's the whole point. So what we're currently seeing, in my opinion, is that they are building systems through which they can get to crypto through that KYC policy. So they are making it more transparent. The regulatory framework is being built. That's being built for CEXes and for crypto in itself. The next layer is DEX, which is way more complicated to make a regulatory framework for, so big institutions can jump into that. So it's more like a retail thing right now, as there's not many problems for retail to trade on DEXs. However, if you make a few $100K in it and you want to cash it out towards fiat, how are you going to show that it's not terrorist money or anything else? So that's just completely different topic, and that's just another stage after the stage we are currently in. We first have to settle down with the first regulatory framework, and then we can move forward. And that we're currently in that stage, I believe.
Yeah, I absolutely agree with you. I think that's a fantastic point. The reality is that as a trader, investor, participant in the space, there's a lot of, I guess, new innovations that simply regulators do not fully understand or not even aware of yet. And as a result, it's very difficult, for you to anticipate how regulators or various different regulators around the world will compete against each other, given the regulatory arbitrage that's going on.
Well, in general, like tech is just accelerating so fast, while the law is just being behind heavily. We are currently in a discussion in the US whether privacy is real or not, and how are those tech companies going to defend your privacy, right? With Facebook and all those big guns being there. That's a topic that's 20 years old, and we're still discussing it. So imagining that those governments are able to make regulatory frameworks for the DEX is just a fairy tale. They are not going to be able to do that within the next few years. So that's something that's very difficult, as technology is just accelerating in such a pace that they can't keep up.
So I guess as a follow-up, my question would be, as a new trader or user in the space, what should my approach be? Because a lot of actors are in the space. If you look at, Binance, they've been able to establish significant market share by, playing within that compliance gray area or managing their compliance risk, quite well in comparison to other actors. So, Annie, what's your opinion on that?
I mean, I think
regulatory gray area as a new participant in this.
I think this goes back to our conversation about like risk reward, and you need to think about how much risk you're willing to take for a given amount of reward. So the first place, as Michael said to start, is like a centralized exchange, and you need that on-ramp anyway to get whatever your fiat is into crypto. And as you get more comfortable with interacting in crypto, I think DEXs and even using centralized exchanges outside of your country. So, in the US, the biggest ones are CoinList, Gemini, and Coinbase. You can do more sophisticated trading, but now you're taking on more risk. And so I would say, start at the beginning, start with a centralized exchange that does KYC.
Yeah, for sure. I agree. Well, first of all, I'd just like to thank my fellow panelists and participants for their great insight and feedback on the panel discussion, and also to Natalia and Anna for organizing the conference. And I think from our side, I think we're pretty much done. I think we've pretty much ran out of time now. So cheers, everyone. Thanks for your time. And hope everyone.
Thank you, guys. Thank you very much. Guys, thank you very much once again. Issele, it was amazing discussion panel. Thanks for your questions. Some of them were pretty tricky, so it was great. We lost the connection with our Eugene Excavo. I guess that something happened with his internet, so I hope you are safe there. Okay, we are moving on, and we have Eleni, the lady who was just in our discussion panel. So she will have a presentation for 10 minutes. The name of it is Bloxroad, a low latency network for DeFi. So once again, Eleni Steinman, Bloxroad Labs, we are welcome.
Eleni Steinman leads global strategy at Bloxroot Labs, focusing on growth, investor relations, and operational improvements.
Hi, hope you all can see my presentation. That was a great panel and a good segue into Bloxroot. I'll tell you a little bit about what we do and how we can help you trade faster and smarter. So let's start with who we are. So Bloxroot, we're a team of networking engineers, and we built a high-speed network to solve the scalability bottleneck. And we're bringing that high-speed network to DeFi. So what does that mean? In traditional finance, what matters is speed. Companies will geolocate next to exchanges to get faster execution. They'll buy more expensive hardware, put literal wires in the ground to get their data transmitted as fast as possible. In DeFi, the game is still speed, but now it's a bit different. A transaction within the network can pop up literally anywhere in the world, and you need to get your transaction to mining pools, and most of those mining pools sit in China. And secondly, which we also discussed in the panel, your transaction is public the moment you send it, and that can lead to easier front running. So if there's one thing you remember from this presentation, is that BlocksRoute can help you trade faster and trade smarter. So let's look at an example. Let's say you're running a bot, you're doing algorithmic trading. What you care about is hearing of a transaction fast and then sending your reaction transaction to a mining pool quickly. On the hearing side, as you can see, your transaction can literally pop up, or the transaction that you're reacting to could pop up anywhere in the world. This is a graph of where nodes are run in the Ethereum network. And once your bot hears about a transaction, it needs to make it to a mining pool. And they overwhelmingly sit in East Asia, which in reality is actually China. So we'll first talk about the hearing side. So as I mentioned, a transaction can pop up anywhere, but the story is actually a little worse, which is the way a peer-to-peer network works, as you may know, is you run a node, your node connects to about 25 random nodes, and those are geographically random. So a transaction pops up, it has to go node to node to node until it eventually gets to you, and it could transverse the entire globe several times. If you look on the right, you can see on average, it takes about 200 milliseconds for a transaction to propagate to a nearby node. So BlocksRoute, we like to say we're the peer-to-peer plus one. You should connect to the peer-to-peer network, but anyone that connects in addition to BlocksRoute, you're now one hop away from everyone else that's connected to us. And what that ends up meaning is, well, now transactions take about 100 milliseconds to get to you. And we've measured using our network that 84% of the time, those connected to us hear about transactions first from us, then from the network. And this is a huge advantage if you're, again, running a trading strategy that requires you to listen to what the network is telling you. I don't know if we have a product that we call a mempool stream. We will send you transactions either unconfirmed, which means even before they've hit the mempool, we can send them to you, or confirmed transactions, which means they've been validated and accepted into a miner's mempool. KeeperDAO, if you know them, did a study comparing our mempool stream to a few competitors, and we were overwhelmingly quicker. So again, that means compared to the people you're trading against, speed here is paramount, and 175 milliseconds, that's akin to the transaction even leaving its origination point. So it's a huge advantage. In addition to streaming transactions, we also stream blocks. We're connected to over half of the mining pool hash power in Ethereum. So that means now you're one hop away from a miner. And the way miners transmit blocks is they send it to each other first, because what they care about is their uncle rate. So they send it to each other first, and then they send it to the rest of the network. So you can see those connected to BlocksRoute, because you're one hop away, hear about blocks first from us 98% of the time. I mean, that's almost every time. This is important not just for traders, if you want to know what the newest state of the network is, but also for dApps. If you're a DEX and you're showing pricing information, and that's dependent on the last block that was mined, it could allow you to provide your customers with more up-to-date information. So for those who are looking for an even more advanced solution, we offer public relays, so entry points to our system in these 5 locations. And for those who are looking for more advanced and wide coverage, we have 5 additional locations that you can connect to us. So that means 5 more places. If transactions pop up, you'll hear about them slightly faster. So now on the send side, as I mentioned, we're connected to the majority of the mining pools in Ethereum, and most of those sit in China. The trick here is the Great Chinese Firewall. The Chinese government throttles data in and out of China. And to combat that, we use something called a private link. So we're able to offer our Enterprise Plus customers this faster entryway into China, invest to a miner, and also exit. We can get data out of China much faster. So to continue, another big problem that I think everyone knows about is front running. It's when you send a transaction, it becomes public immediately, and someone responds and sends a higher fee to steal that opportunity from you. It's, as I said, it's pretty rampant. You can see here this chart that was done by, I think, individuals at Cornell. They've been in their study, they witnessed 200,000 attacks, and they profited by $18 million was stolen. So to combat that, Bloxroute offers something we call a private transaction. So instead of your transaction going from you to your peer nodes and traversing the network, you can send your transaction directly to us on a secure channel, and we'll send it directly to a miner. When that miner receives the transaction, it'll sit in their mempool until they mine the next block, if you give the right amount of fee, of course. And only once it's included in the block is it sent to the rest of the network. So we have about half of the mining pools participating in our program, which means with every block, you have about a 50-50 chance that it's going to be mined by a mining pool that is participating. So the key here is your transaction is private, your chances of being front run are diminished, but you have slightly longer confirmation times because it doesn't go to the entire network. So lastly, I just wanted to give some tips of how anyone can optimize their trading strategy. A few of these are geared towards using Bloxroute, but they apply even if you don't use us. So the first would be to just run multiple bots in multiple regions. Have one in Europe, have one in the US, have one in Asia. This will decrease the amount of time it takes for a transaction to get to you. If you're using our BDN, we recommend that you subscribe to us using APIs. It's just the fastest way to get data from us. The third thing is using our private relays. Again, it just gives you more geographical coverage and can save you, 10 to 30 milliseconds, which is actually quite a lot in the world of trading. And lastly, this is something anyone can do. Make sure you have good peers. If your node is connected to a peer that has never sent you a transaction or a block, drop them. Find someone else who is better connected to the network. This is something we're doing with our customers, and perhaps we could help you figure that out as well. So in conclusion, the world of trading in DeFi is similar to traditional finance in that speed matters, but there are a few twists, and Bloxroute is here to help you trade faster and trade smarter. If any of this was interesting, you should check out our pricing page, which has a list of all of our offerings. These were just a few. So thank you. And if you have any questions, feel free to reach out to me.
It's Natalie again. I hope you're still there, alive, watching us. So we have 2 hours more. So be brave, stay with us, stay tuned. And we have lots of interesting presentations, discussion panels. So be with us. We are moving on, and our next session is security frauds. And our first speaker in this section will be Konstantin Anisimov. He is from Xex.io, the leading European centralized exchange. And his topic will be security aspects of institutional level DeFi investments. I see that Konstantin is already here, so let's move on. We continue.
Konstantin Anisimov, Executive Director at CEX.io, an international cryptocurrency exchange founded in 2013.
Good afternoon, everybody. I'm here to talk about security aspects of institutional grade investments into DeFi. I'll first do a quick intro, then I'll talk about why DeFi could be of interest to professional investors. Then I'll talk about the security aspects of such investments, and then I'll discuss how CXIO is involved. We can also do Q&A in the end if we have time left. So my name is Konstantin Anisimov. I'm the executive director of CXIO. I'm in charge of sales strategy and corporate governance. I'm an engineer at heart. I used to develop and design embedded software electronics for mission critical applications. I then did an MBA, executive MBA at Cambridge, and that is when I got introduced to blockchain. And I fell in love with the engineering side of blockchain, and I then managed to secure this role. So for the last year or so, I've also been an active contributor at top tier media resources. CXIO is a top tier exchange for those of you who have not heard of us or may not be as familiar. We have over 4 million customers worldwide. We're ranked number 8 by Crypto Compare ranking. And as Natalie already said, we were established, set up in London in 2013 with our headquarters in London and offices all around the world. We started off as a retail exchange. However, in the last couple of years, we've been developing into the institutional space as well. The main points I would like to highlight, though, is that we are an innovation-hungry business. We really like to stay current with the developments and stay on top of the developments. And we've been able to do so for the last 7 years within the crypto sphere, which is one of the fast-moving innovative industries in the world. And hence why we're also very active within the DeFi space. So why is DeFi, why could be DeFi of interest to large investors? Well, first of all, in the last 18 months, the total value locked in DeFi has grown tremendously. And if you look at the graph here on my slide, only in the last 2 months, the TVL increased from 15 billion to over 40 billion. This means that the ecosystem and technology underlying DeFi has evolved and became much more mature, and hence institutionals and professional investors are taking this seriously now. In addition to this, the annualized yields of DeFi are astronomical compared to traditional finance. So the combination of the two makes it a very interesting sweet deal. One thing I wanted to also highlight is the fact that even though DeFi has been developed with community spirit in mind, the reality is that at the moment, a small, simple retail investor cannot really participate in DeFi in a way that would be beneficial and where they wouldn't make a loss. So, for example, if you look at the top DeFi projects by total value locked, 7 out of 10 are based in Ethereum. There are other chains which are developing and gaining traction. However, as it stands, Ethereum is still the #1 blockchain for DeFi projects. What this means, though, is, as we all know, gas prices have been going up and up and up. And you can see here that the leaderboard for consumption of gas, 6 out of 10 of those wallets are DeFi projects. This means that in order to enter into an investment position, it's possible that you would have to pay upwards of $200, and then to reap the rewards, you may have to pay anywhere between $100 and $200 again. So imagine a small retail investor wants to invest $100. The concept doesn't make sense. And that means that large scale investors, probably $20,000 and up, this is the minimum level at which you can start making profits. So again, this is very interesting for professional investors. However, they can't just an organization like that cannot just make a decision to invest in a project by looking at the APYs. They need to analyze all the security concerns and potential issues with such investment. So they would look at things like custody, cybersecurity, risk management, governance, reporting, and the insurance. The paradox here is when it comes to custody, DeFi was developed with community spirit in mind and not with businesses, institutions, and professional investors in mind. And because of that, the whole custody toolkit has been lacking. However, recently that's been developed, and there are some really cool, interesting projects which would look at things like 4i principal control through multi-sigs or some other means. They would have definition of roles, so you could split between who's a trader, who's an administrator, who's a risk analyst. It's also very important for professional investors to have insurance to protect their assets against hacks and unsolicited asset access. The most crucial and interesting part of DeFi custody for institutional grade investors would be the ability to interact with multiple blockchains and multiple projects on the said blockchains in a seamless and safe manner. Because of the differences in technologies available in DeFi, it's actually very hard to build a solution that does all that. And currently, majority of investors would have to move their funds out of their safe custody into a third solution, which degrades the security of their funds for that period of time while they're investing. The next very important piece that a professional investor should look at is cybersecurity, and here they should check if a project did enough due diligence when they were building the smart contract and whether they've done QA, unit testing, etc. as an internal review. They should also try to look for external audits or maybe hire a company to do an external audit. They should check whether the said project is actually truly decentralized or whether it portrays to be decentralized and in reality, a small number of people have full control of the voting rights and of liquidity, which adds to the risk for the investment. And last but not least, insurance mechanisms for transactions and for assets which are locked in pools. So even if you have insurance for the custody, there's also a need for having insurance for when your assets are invested into a specific DeFi protocol. Again, there's a lot of activity in this sector at the moment. There are some great initiatives. I believe it's not quite there, but I think we'll see some very, very interesting projects happening very soon here. The next part, which is very important for a professional investor, is analytics. You want to stay on top of and analyze any possible changes and risks for your investments. This could include liquidity analysis, and which essentially checks things like who controls the liquidity in a specific protocol, and if there's any additional risks in the information you find. Community governance, how is that set up? GitHub activity, how active is the project? Blockchain analysis, which would look at how many wallets, for example, how many wallets are active in a protocol. In other words, it could be that even though a protocol has a lot of assets locked inside the protocol, there could be very few wallets that control, say, 80% of the liquidity, which could fall under the liquidity analysis part as well. And if one of those three wallets were to sell their position, then you could have a liquidity crisis, which would lead to some unexpected circumstances, I would say. The other part, which is very, very important, is governance. As DeFi projects are community-driven, community-based projects, it needs to be clear for a professional investor that they're invested into something sound, and it's not a scam or a Ponzi scheme. And you would look at things like whether a project has a very clear and good development roadmap, whether they have specific current initiatives which are aligned with social and economic initiatives. They would look at community activity. How active is the community backing the project? Is it real, or is it a facade? And as well, governance setup. Keep coming back to this, but it is very, very important to make sure governance setup is correct and that the right decisions are made the right way. The last point I wanted to highlight here within the governance section is geopolitical risks. Now, imagine you have good governance, you have all these points, but the whole of the community is located, say, in one city or in one country. And I know we all want to be decentralized and we all want to be disconnected from the real world. But if it so happened that the community leaders were found out and got into trouble with the government, then that could add to the risk of the whole project succeeding. So as a professional investor, I would want to make sure that the community is distributed enough and that risk is negated as much as possible, of course. The last point I would like to make on the sections of security and security analysis is reporting. As DeFi has a number of different technologies that it runs on. And on top of that, you have a huge number of protocols that are built on top of these technologies. This means that reporting is very, very different from one protocol to the other. Now, if you want to invest in multiple protocols and be able to move your funds from one pool to the other and maximize the opportunities, you also would like to have very standardized, clear, and concise reporting. Within the projects right now, there's a big variety of what can be available. What I would like to see here is a natural development for a standard for reporting, which the best projects will, again, naturally take up. Communities will enforce that or promote that, I should say. And then those moves would make it easier for a new reporting aggregator to arrive, which professional investors and retail investors could make very good use of to make sure their investments are in order. Now, how does all of this connect to CEX? Well, we essentially became one of those institutional investors into DeFi because we've seen the huge potential of it. And also we've seen the pains of very simple retail investors who would like to get into DeFi, but especially in the very beginning couldn't because of the technological, the reason to learn a lot of technology to actually get a chance. So we developed and about to launch a new product called DeFi Farming within our CEX.io Earn product offering. What will this product offer? First of all, it will manage all of the CEX.io will manage all of the complex integration to a multitude of DeFi projects. We will pool the investments from our retail clientele and invest on their behalf into DeFi projects, which means that the high Ethereum fees, which used to be a problem when you want to make a $100 investment, cease to become a problem because we're able to invest as a large investor on behalf of our clientele, and we also take it becomes our responsibility to do all of the risk analysis and to select the most trusted DeFi projects, and we would offer a limited selected list of DeFi projects to our customers. All of this will make sure that our clientele at CEX.io will have a secure, simple, and easy way to participate in the DeFi community and benefit from the yields available within DeFi, get closer to the community, hopefully learn and carry on participating and taking a more active stance within DeFi. And this is all from me. If you have any questions, I'm more than happy to answer.
Konstantin, thanks. Thank you very much for your presentation. Lots of interesting insights about your exchange, and congratulations with the news that you just had about launching new products, new direction. That's great. Congratulations once again. We are moving on, and all questions that you have to Konstantin, you will be able to ask him directly just after one presentation. That it will be discussion panel where Konstantin and other participants will be discussing security frauds issues. Security frauds topics. So let's move on. We have we don't have Dmitry. He might be he's always late. I know him pretty good, but he's awesome. I consider him as probably the best expert in cybersecurity, especially exchange frauds and different topics that is related to cybersecurity issues. If you know Dmitry, you know what I'm talking about. Let me just ask my team, where is Dmitry? Because he should be here. Because we have other participants, but we are still waiting for Dmitry, because I see that Maria Stankevich is already here for discussion, but we're still waiting for Dmitry Budorin for his presentation. So please bear with us. We're still waiting for him, and I'm sure he'll be here in a few minutes. Just let me remind you that we have one speaking slot, one presentation from Dmitry. After that, there will be discussion panel on a security frauds topic. After that, we have regulation and legal issues, where we have two presentations. One is from Ave. It will be how DeFi is solving the stakeholder problem in finance. And the last but not least is Gordon Einstein, Crypto Law Partners. His topic will be about the law of DAOs. It's also amazing. You should wait for it for sure. So 1.5 hours, we can do it for sure. So grab a coffee, bear with us, stay with us. We have lots of interesting insights. Our presentation, our speakers, they are ready to share with you their knowledges, their insights, more information. So stay tuned, don't leave us. We are here. Let me just, I know what should I do. I should call him. Maria Stankevich is here, but hi. It's not, you are a wrong person. I was expecting Dima, so let's have a chat. Okay.
That wasn't me who actually brought me to the main stage, so I'm sorry.
Yeah, so I'm just curious, is something happened with Dmitry, or he is just like always busy, I don't know, chatting with someone? So let me just I know what should I do. I should call him just right here. Wait. How is everything? Tell me, how's the weather in London?
Well, the weather is amazing, but we are in lockdown, so basically nothing to do except for, lawn walks and lawn bicycle rides. Yeah, and that is pretty much illegal also. So yeah. If someone from the government is listening. So yeah.
Okay, tell us about, is there something interesting that you just learned from our conference, or who's your favorite speaker, or what is the most interesting topic for you that you heard today?
Well, actually, I was just reminiscing this morning because you remember a year ago, precisely a year ago, we've been on this conference in Amsterdam. Like it was amazing, and yeah, they all of the speakers were amazing, and you know, the topics that are bringing up here, brought up here are just, you know, very up to date. DeFi and security. Well, I liked the I caught some part of the speaking part of Konstantin Anisimov from CEX. It was great, very up to date. Yeah, so I see Dmitry is here.
Dmitry is here, finally. So two ladies, can you imagine? Two ladies waiting for him in this room. So Dmitry is just Dmitry. Okay, Maria, thank you very much for this quick chat. Please wait in our hidden room for 20 minutes for Dmitry to shine. So Dmitry, your turn, and we'll get back with you, Maria, in 20 minutes.
Dmitry Budorin, co-founder and chief executive officer at Kraken, a leading cybersecurity company targeting corporate and consumer markets.
Hello. Hi, my name is Dima Budorin. Thank you for inviting. Today we'll speak about security and the whole. We'll speak about the ranking of exchanges and where all this thing is going. Basically, we are in the middle of new regulation to be born inside the crypto industry. The regulation will not come from the abroad vault. The SEC or any other guys who will try to regulate crypto, they would be ignored. You just can't implement those regulations, metrics that you do with banks to the other industry, which is absolutely different. And you will not be able, when you are like already 45 years old guy or 50 years old guy, everything is good in your life, start changing your mind and trying to catch up the crypto speed is just like no chance. So the regulation in crypto is in some way necessary so that people are protected from scam and fraud guys, and it will come from the industry. This is what our team is trying to do, and I will share our presentation today with you, and hopefully you will get a better understanding. So let me just give me a second. I will have to. Give me 1 second. I will turn on the full screen. Okay, share my screen. All right. So you see my presentation. So cybersecurity ranking of top 100 crypto exchanges. Yeah, very briefly, I will speak about current landscape of the crypto exchanges security rankings, about our partnership with CoinGecko, what does it mean, and we will speak about some data that we gathered after the start of cooperation with CoinGecko, how the industry changed, and we will speak about new initiatives that will change the security markets in 2021. Yeah, briefly, what about me? Yes, so I earned some good karma working at Deloitte for 8 years, and I know how it's to see a world in purple glasses, in pink glasses, and hopefully I will bring to crypto. I'm bringing to crypto industry only good things about it, and yeah, for the last 4 years, Kraken Group has worked with almost all industry leaders, and not only in crypto world but outside. like including Chainlink, CoinMarketCap, CoinGecko, Binance, 1inch, Bitfury, like many others. Yeah, we have 4 products: is B2C application Hacking bug bounty platform Hacking Proof, Hacking cybersecurity services. We are #1 penetration testing for crypto exchanges, a consulting company, and we are top 5 smart contract auditor. And of course, CR, our ranking platform. So in CR is not, it started from doing analytics of fake volume at crypto exchanges. We were the first who were loudly screaming about it. And then we started to do more focus on security of exchanges and the wallets and balances that are on that exchanges operate. Then CR developed into DEX security ranking, and right now we are also filling the data about all the bug bounty and all the security audits of all the crypto industry. Basically, like cybersecurity atlas of crypto vault. This is what CER is about. So in 2020, we partnered with CoinGecko. We created this Chainlink security oracle, and we continuously improve the methodology. So what this partnership with CoinGecko mean? So every exchange has a trust score, and this trust score is something that really influence the decision-making process of traders, new token holders, or even investors, whether this or that exchange can be trusted or not. So as everybody knows, I think in 2020, CoinGecko became a leader of, for sure, it's the biggest independent crypto aggregator in the world, but I see that right now it's already the biggest crypto aggregator, not dependent whether it's standalone or in some big exchange group. So CoinGecko Trust Score became a very powerful tool, and exchanges who have very low trust score, they are simply losing clients, and they cannot put good prices for the token listing fees. So that's why before, when crypto CR was operating, and we were ranking exchanges and providing analytics, nobody really cared about it. Exchanges were like, yeah, whatever. And then when the partnership happened with CoinGecko, and when 20% of trust score started to be from our data, suddenly all the exchanges started to pay attention to it. And obviously, because they keep receiving requests from their clients, why your cybersecurity is not 100%. Aren't you're saying on your website that you're the most secure exchange in the world? And CoinGecko says the opposite. So this became very overnight. It became very important. So as you can see at this slide, that 20% they are coming from the CR ranking, and CR ranking is from 0 to 10. So maximum two points for cybersecurity you can get if the your CR ranking is from 8 to 10, and you can see the lower ranks as well. It's pretty straightforward. So the next is how this 10 ranking according to CR comes up. So it has 3 most important elements. First is server security. You can see the list of the things that we are checking. We are checking using automated and manual tools, and we do the checks for all the existing exchanges, not only that are included in CoinGecko or CoinMarketCap list. We're checking user security. So a lot of crypto exchanges, they are trying to do the UI UX of new users as simpler as possible. So they try to avoid any red flags that can stop a user from registering an account. So for example, if the user is not requested to do a complicated password, then most probably, then the flow is easier for him. So there are exchanges that don't care about what is if the user puts the password, the word password, they really don't care. So for such exchanges, we are very we underline that this is bad attitude to your customers, and they just don't get the good security ranking from us. In any case, these things are easy to fix, and we see huge progress from lots of exchanges who are improving the user security factors since the start of the partnership. And the next is preventive security measures. So we have 4 very important elements. Every exchange has to submit penetration tests on all the web infrastructure and mobile apps the testing result, the audit report. This audit report has to be no later than 1 year ago, and it has to be on the current web infrastructure. So we are constantly checking if there is some new application released, that whether it was there was a proper penetration test report. So this is something that comes from my previous life, our previous life, being a Deloitte auditor. So we are basically creating a market for regular penetration testing of crypto exchanges. There is no doubt that this is super needed. There is no doubt that there is a fact exchanges are spending on security less than 1% of their budgets, and everybody keeps saying that we are the most secure. And in fact, we as people who are very big believers in crypto, we see our big goal to keep pushing these exchanges to do regular penetration tests on all the infrastructure. That's why it is here. That's why it's very supported by CoinGecko and other companies. And this public ledger of penetration tests, it will just become a standard, not only for exchanges and for other DeFi projects and so on. I will tell about it later. Of course, it's bug bounty. Yes, so a lot of exchanges don't have bug bounty, neither private nor public. Even if you find some bug, we made a lot of experiments. We were finding a lot of bugs in our free time, of course, and sending them to various exchanges, and replies that we were, in most of the cases, we were not even receiving the reply. So we know that this is a problem. So the next important thing is we started to require ISO certificates. This is, of course, another level of crypto exchanges who can do it. Right now, I think it's only 7 or 6 exchanges who has ISO certificate, but this is something like crucial for security of the organization that acts as a custody for millions and billions of USD equivalents. And fund insurance. Here, it's something like SAFU at Binance. We believe that the secure exchange has to have an element where they are where they have their clients insured programs. All right. So right now, the top 5 cybersecurity exchanges that are, according to our audit, is Crypto.com, Binance US, Binance, Coinbase, and Kraken. Looks pretty, reasonable, and this is, we were changing our methodology several times, and, the picture that you see right now is pretty fair in terms of how much these exchanges are investing into the security. So congrats to representatives, especially Crypto.com. I know these guys are doing an amazing job developing their products, and of course all the rest. Kraken fund insurance thing is just another level example to follow to all other exchanges. On the right, you can see another ranking for exchanges on the top 5 ATH and BTC balances, which basically, in my opinion, represents the size of exchange the first place. So we believe that the crypto balances that are held on behalf of the exchange are the most important metric when you are saying who is number 1, who is number 2, like we are top 5, okay, top 5, whatever. So in this ranking, is Binance holds more than 20 billions of BTC and ATH. Would be a little bit less. By the way, Binance is just very recently they became number 1 custodian for BTC and ATH. For quite a long time, Huobi was like 2-3 times ahead Binance and Coinbase, and Binance was 3rd, by the way, and after Huobi and Coinbase. Right now, Binance is the leader, so right now they are unanimous. And Gemini, Gemini is rapidly growing. 12 billion USD of crypto assets. It's huge, to be honest. And Kraken. So Kraken 5th place there and there. Congrats. So there is a small data set. So around more than 100 exchanges requested their cybersecurity score analytics. And what was the process? They are requesting they're sending a request to us. We're giving them, we verify that this exchange account is legit, who have requested it. We are given the explanation of the score, and we give certain recommendations how the score can be improved. So because of this few examples on how exchanges reacted, so 40 exchanges have prepared security audits from third parties and submitted to us for the last half a year. 60% growth in public bug bounties for crypto exchanges from 48 to 77. It's also very impressive. And 15 exchanges started performing security audits with our company, sister. Sorry. Oops. Then what actually we did? So, sorry. This is the last topic about cybersecurity ranking of exchanges, and this is something that we are very proud of. Basically, we launched this market, and we are not going to stop. And it will be more and more difficult to have a good cybersecurity ranking for exchange at CoinGecko. The CoinGecko has we are working very tightly with them, and they support us in methodology updates. So we are here to stay. And the next thing is, yes, what we're working on right now is that we started to create the public ledger for all the smart contract audits for crypto projects. There is a very strange thing, why not so many why there is no public ledger for all the audits. I do think I have an answer, because a lot of smart contract auditors, they have, sometimes they audit projects that are not that, that had, in fact, the security holes, security vulnerabilities, and then it's hit on the reputation when it's publicly shown that this project was audited by this company and then there was a drain. So maybe because of this, I don't know, but it is really sad that people don't have transparent information on when they are. They rather go and check. They know where to check the Telegram chat, but they don't know where to find the legit information about passing the security audit. So so we started to search for this information, and publicly we found we have reviewed more than 1,000 crypto projects, and publicly we found only 23.5 that only 23.5% of the projects did the security audit. Most of them are DeFi, of course, and this is something that we want to involve a community very soon. We will have a project called Hack and Scout, and we will remunerate people with some funds for helping us to crystallize this database and to contact every single crypto project in our vault, so that this database is very, very, up to date and transparent. And after this, of course, I'm sure crypto aggregators will love to have this on their website. So yeah, if you are a crypto project, you have to be in a hurry to do the smart contract audits. Otherwise, when this database will be live and with full data, your community will give you a question mark. Why? Yeah, so just for your information, another slide is the landscape of smart contract auditors. So most of you know probably smart contracts who have a token. It's Kraken, Certic, and Quentin. But the rest are also very strong, like very strong and powerful teams, and 75% of all the audits are performed by this, I would say, top 13 smart contract auditors. For bug bounty programs, also is the competition is a little bit smaller. Basically, there are two companies, HackerOne and Background, US companies that are leaders in non-crypto vaults, and two crypto-focused companies that have bug bounty platforms are also doing well in this market. It's Hack and Proof and Slowmist, the Chinese one, the Asian one. So, sir, in 2021, we will see new updates of the methodology. It will be more complicated. We will create the cryptocurrency market knowledge base for cybersecurity. Of course, the database for security audits for all the space. This is ambitious task that I personally manage, and it will be done. And of course, we will continue improving the security rankings of DeFi projects. There is so much there. Summary: security audits have become a trend for crypto projects. A lot of people are.
Nima, hello. You don't have time anymore. You are enough time. But please, I'm giving you 1 minute to summarize, as you said, and we are jumping into our panel discussion where you are a moderator, and you will continue whatever you want to say. Okay?
Absolutely perfect. Thank you. In fact, I just wanted to say that security audit reports became a must factor for a decision making process for current DeFi investors. If you don't have a security audit, probably people will not invest in you. The second thing is that security of most of crypto exchanges remains weak, while we see a very big change in minds. And just comparing like almost nothing was happening from 2016, let's say, to 2020. In 2020, there was a breakthrough. We see a growing number of bug bounty programs, and the bigger the exchanges, the stronger is the security. And the increased focus on cybersecurity demonstrates that the industry has become mature, and this is a big win. Thank you so much. Yeah, you can follow me on Twitter. I'm quite active there. And yeah, let's switch to a panel.
Yes, thank you very much. You still can add what you want in our panel discussion that just goes like a few seconds, so stay with us. Just to remind our audience, so we have panel discussion, security tools, participants, Exmo, Maria Stankevich, Sex.io, Konstantin Anisimov, and Ivan Nasser, who is from Amnesia.io, and moderator, of course, the Zerion Kraken. Let's move on.
Hi, guys.
Hello, hello.
Hi, everybody.
Do we have everybody?
Yeah.
Hello, Quentin. Hello, Ivan. Hello, Maria. All right. Where are you guys now? I'm at home. You see, I have a baby place. But yeah. What about
So
you?
you stole the room from. So you stole the room from your baby,
Yes,
right?
yes. I did it. I did it.
Well, yeah. I'm in London. I'm actually at the office because I kind of felt I can't do that anymore at home, because you probably know that we have a lockdown here, and Konstantin escaped this and ran away, but I'm still here. Yeah, so I'm at the office.
Yeah, I'm also in an office in Tallinn, in startup capital, and I've hired a desk here temporarily, and I've already got acquainted with a couple of people working for crypto startups. So it's quite a cool place to be in.
And Ivan, you're muted.
Yeah, I'm also working from home, which is, I guess, it's been my office for the last 12 months. And I'm actually in the Caribbean. I used to be in New York, and then COVID happened, and I have a wife and kids, so I figured I'd be better off on an island.
Okay. Oh, nice. Yeah, all right. Let's do some small intro. Then I will ask a few questions about the some interesting hack accidents that you are aware of or was a part of, and then we will discuss each case, what measures would be in place so to that case never happened. So yeah, Ivan, can you tell us your new intro?
Yeah, so there's been a lot of changes lately, actually. So I've been in the blockchain cybersecurity space for the last 5 years or so. I used to lead professional services at Hosho and more recently Certec. But I very, very recently essentially set up a new auditing and smart contract development firm called Omnicia. So you can find us at omnicia.io. And what we do is pretty straightforward. We focus on the development and auditing of complex smart contracts and decentralized systems. And we also offer penetration testing services, spot checking, technical due diligence for investors and funds. So yeah, really excited to be here today, and looking forward to talking about some of our war stories.
Yeah. Konstantin, short intro. I guess we can do a very small intro, just in case that someone didn't see your presentation.
Yeah, of course. So I'm an executive director of CXIO. We're a large centralized exchange, so I guess we're representing the classical world of cryptocurrency here compared to some of the DeFi folks.
Thank you. Thank you. I'm sure everybody knows Maria, but...
Hi, Dima. Pleasure to be here. Like, you remember a year ago, same time, almost the same place. My name is Maria Stankovic. I'm the head of business development for the Exmo crypto exchange. Well, Exmo is one of the top spot exchanges in Europe, so that's who we are.
Yeah. All right. So let's start with you, Maria. Do you have some stories to tell us?
I know what you're asking. Well, basically, Dima knows something. Well, he knows a lot. And we got hacked in December. We got hacked for $11 million. That was a very unfortunate story for us because on the 25th of December, we received this amazing news. Crypto registration with FCA, temporary crypto registration, but still it was amazing, and we felt amazing. And the next day we got hacked. So basically, the hacker, he stole private keys, and he withdrew all of our hot wallets. The amounts. It was 5% of the total amounts of the total amount of funds that we have on the exchange. It was 11 million. Of course, we stopped our operations for a week or so, maybe for 5 days. We closed deposits and withdrawals, but we renewed all the operations, and we replaced the stolen funds with our own. After that, we onboarded with three custodians that are Fidelity, that are Ledgervault, and the third one is Coiner. They're British-based. So that was a tragic story that actually, we learned a lot from this story, and we learned, every year. Actually, I remember my last year presentation, I was speaking about security also, and my first slide was, bragging about how we never got hacked, and Dima was laughing actually at me. And now I'm thinking like, maybe you have something to do with this. I was really proud because that was 6 years, actually 7 years in the market without any such story. And I felt pity, and I showed the slide with BitHump that actually got hacked, and we returned all of their funds. But the important gist of this story is that half of our funds went to Polonic. And these guys don't have proper AML, and they let the hacker withdraw all of the funds. It was 2 hours difference from the deposit and withdrawal, and they let this hacker to do this. And of course, we filed all the reports to cybersecurity police and all the governing bodies. But I believe that the funds are gone, and that is also because this is very important to have the AML rules and AML policies on the exchange. So they needed actually to ask this hacker for the source of funds, at least.
Yeah, I absolutely agree. But this is some. First of all, thank you for your honesty. I know the details that some of the funds from that were stolen went to other centralized exchanges, and that they even didn't reply to lots of requests that, hey guys, do something with this. It's the funds that hacker just stole, and they just ignored.
We're just comparing this story with our story that we had with BitHump. I mean, these guys wrote us at night, and we were furious. We were like, guys, I woke up every department, compliance department, and we blocked these funds immediately. And that was like, we returned all of the funds that went to our exchange. And I'm just comparing this situation with the situation that happened with Polonics. Like, it took them 5 hours to reply. I mean, and Oh my God, this is just crazy. I mean, we are here in the same boat, and they're just, they're just ignoring us. And then when we started to, like to ask them why they didn't block the funds, they started to reply us in a very impolite way. Let's put it this way. So I'm just, this is so frustrating.
Yeah, I think it's a very important question, and okay, we don't have a lot of time, but yeah, the key outcomes from this story is that you did great that you had the limit for the hot wallets on the 5%. I wonder if you even decrease it lower.
That, yes,
yeah, that's great. To 3%. Cool.
Yeah.
Second thing is that you started to use third-party custodials, which is also, for sure, it's a level up for security of the funds. And third, yes, we all see that there is a very big need for new, tool that is working with all the exchanges, and that if something happens like this, if there is, a legit, request from exchange or from any other DeFi project, whatever, to immediately block some funds, then there should be a tool that notifies all the exchanges and that they do press this button.
Absolutely.
Yeah, of course, we all understand the crypto is about, that everybody has to send anything. There is should not be any regulation, but the justice is somewhere if you want the justice, then you need to fight with scammers and frauds.
Absolutely.
Yeah. Okay. Ivan, can you share some nice story? I'm sure you have a lot.
So I have a lot of stories, but I don't think we have a ton of time. So I'll just maybe speak to one particular story. It's actually it's a common client of ours, Dima, and I'm not gonna name them because I don't want to name anyone. But this was kind of a typical audit. We were contacted by a client. Worked with them. Did a really good job on the audit, found a lot of major critical findings, worked really closely with them. They addressed all the issues and remediated everything right away. We gave them the audit report. Everyone was really, really happy. And then, 2-3 days later, I get an email telling me that this particular project got hacked and that $30 million were drained. And so, of course, when that happens, and audits are not, bulletproof. Like engineers may sometimes, miss things, and this happens. So we went back, looked at the audit, and really couldn't quite understand what happened. And so we worked through the night to really kind of figure out how this had all worked, and so replaying the attack with our security engineers. And so we actually realized that the code that had been deployed was not the same code than we had audited. It was very, very similar, but essentially what the attacker had done was inject malicious code prior to deploying the smart contract. And so what that allowed them to do is essentially exploit that bug to essentially drain the contract. And so this really speaks to, I think, the space and how audits are necessary and useful to the project, because the idea of an audit is that you're going to really raise the security standard of your work, and we're going to help you identify obvious bugs. We're going to help you identify edge case scenarios that are a lot harder to identify. We're going to help you optimize your code so you don't, it is gas efficient and makes sense for people to use. But ultimately, the responsibility of the deployment is never that of the auditor, because the code is not ours, and we wouldn't be able to take on that much liability. But it is very important for investors, token holders, anyone really that interacts with these contracts, to make sure that the code that has been deployed and that is live is actually the code that has been audited, if it has been audited. And so I think some of the lessons learned, and one particular spin of that story is that that particular project had actually outsourced the development of the contract to a third party. And that third party had outsourced the development of that specific module to another third party, or actually a contractor. And what we found over the 2 months that kind of followed that hack is that this particular individual had actually developed smart contracts for quite a few projects out there and had planted bugs in all of them. And so, it's great that we were able to actually identify the culprits and talk to the clients that had worked with them. But this is basically the lesson learned is work with, if you're working with third-party developers, please make sure that they're reliable. Please make sure that they've worked on other projects and that people can vouch for their work. Please talk to the engineers. You'd be very surprised. There are a lot of folks out there that are doing a great job at selling development work and audit, but you actually need to know who's going to be doing the audit. And so always, please, if you're looking for development work or auditing work, speak to the engineers, because they're going to be the one developing your contract or auditing your contract. So I think this is really kind of the key takeaway, is that this is this industry is growing exponentially. There's a lot of people that are in it for a quick buck. There's a lot of those people. But there are other folks like Hacken, there's a lot of other reputable companies that are actually known to do good work and that have been in the space long enough to have earned a reputation for the quality of the work that they do.
Mm-hmm. Yeah, thank you, Ivan. Yeah, this is very typical case when last minute the team is uploading the different contract. This is like we also experienced such stories, and so I think I know what company you are speaking about. Yeah, I definitely know. But for this case, like a preventive measure, what I'm thinking is, again, that there should be some public ledger that states that, even that the smart contract was, audited, there should be a final check that the auditor comes and said, yes, this is the smart contract that we audited, and the ledger should be available to everybody. And I think again, it's a big job to do it, but hopefully with cooperation, through cooperation, it can be done as soon as possible. All right, thank you, Konstantin. Do you have some funny story, or I guess not very funny?
Well, I think it's not going to be very funny, but it's the one everybody's heard of. The one I want to talk about is KuCoin and what happened there. It's a bit bigger. It's over $275 million worth of a hack from different cryptocurrencies. And what's interesting about this case is a centralized exchange was hacked, not a DeFi exchange, but then the DeFi ecosystem was used to launder the money which was stolen. And this is, I think it's kind of an open question. It's not a story, it's an open question. What do we do about this? What should we do about this? The story that Maria told us was two centralized exchanges or multiple centralized exchanges, whereas here it's even more complicated. You go in from at least a field within cryptocurrency where regulation exists into DeFi, which goes against regulation. But in my mind, and this is what I touched upon in my presentation, I believe that it is actually good for DeFi to have some basic code of conduct for the community to accept that this is the way things should be done. I wouldn't use the word regulation. I would use a phrase kind of best practice or industry guide. And then if they happen to receive funds from stolen funds, there should be an agreed way a project responds to that. It doesn't matter where the money comes from, but it's quite easy to track. I mean, it doesn't matter who owns the wallet, but it's very easy to track where the money came from. So that's the story I wanted to highlight. I think it's quite interesting kind of interconnection.
Thank you very much, Konstantin. You're actually very hot topic. It's true. Like you don't need Tornado Cash anymore. You can wash your money at any of those swap exchanges. Really, Uniswap became the biggest mixer right now in crypto space, and definitely something needs to be done with this. I know because we're working on some solution that we want to embed in the crypto sphere. So we want to build a set of smart contracts that immediately notifies the DeFi project that that there was a hack case and that they should not accept the swap from this or that addresses. And in terms of the tech side, it's quite straightforward how to do it. In terms of business development side, it is super complicated to do, because none of the DeFi project or decentralized exchange will accept like to put some these measures in order to block stolen funds, because it will be a hit on their potential liquidity, and second, they will not be, like complete DEX, because they will stop some of the operations. So
I can give you the potential sales idea for the business development, because we are the members of Crypto UK organizations, and we are developing the laws for the UK, and UK is considering to implement such a decision. I mean, not probably they don't know, of course, that this is even possible, but they are gonna implement some sort of auditing, like mandatory auditing of the smart contract, or they probably even don't think of it, of this decision that you just told us about, but they are gonna to implement this on the government level. So basically, it will not be possible for the UK users, for example, to use the DeFi exchanges. I have no idea how they're going to check, but still, I mean, you can just come to them and say that this is a great idea. You can just implement it on the governmental level, and all the DeFis that want to work in the governmental space and in the regulatory space, they can use your decision. This is like an idea from business development.
Yeah, thank you. However, I also don't understand how you can prevent anyone to trade from decentralized exchanges. Like at this point of time, I don't have even one idea. But and second thing is that I think CoinGecko is much more powerful than UK government right now in terms of having influence.
That's a very big assumption.
I am truly believer in it. CoinGecko guys are super powerful right now. If they put some, red flag on this or that DeFi platform and say that this platform is used as a mixer to launder money, I think people will avoid this exchange. All right, so we have just a few minutes left. I guess last words. Ivan, do you have some words to share how to improve security landscape of our crypto vaults?
Yeah, no, I mean, with regard to the CoinGecko trust score, or in general?
No, in general, how to fight with hackers.
I mean, I think a lot of the solution. Yeah, I mean, I think a lot of the solution that you discussed are a valid one. It's very easy to blacklist addresses, and everyone knows what these addresses are. If there's a hack, where just follow the money essentially, and being able to essentially blacklist these addresses so that the attacker cannot go on a centralized or decentralized exchange to essentially dump whatever they stole is obviously something that is useful, and some exchanges are doing it, but not everyone is doing it. So there is a need for having like more of a universal standard as to how people essentially try to combat these attackers. I mean, so we don't do a whole lot of work with exchanges at the moment, and hopefully we will do a lot more. But I think being transparency, I think, is everything. And so, like you said, if players like CoinGecko could essentially provide more transparency as to what the exchanges and projects are doing. Like what steps are these guys taking to make sure that their systems are sound and safe, and not just saying, hey, it's safe, because there's a lot of I've been in this for 5 years, and there's a lot of projects, a lot of team that will essentially use audit reports or penetration testing report as PR. A lot of them will just want to get it so that they have a stamp of approval. Maybe the work that has been done isn't great, but they kind of trick investors into thinking that whatever they build is really sound and safe when it's actually not. And so being able, being able to have this kind of a centralized, transparent way of sharing all this cybersecurity information is, I think, really big and necessary. Because at the moment there's just so many flaws. I can, when we audit, some project might be great from a security standpoint. There's no bugs, there's nothing, but actually there's a centralized control on all the tokens, so they can pull the rug anytime. And very few auditing companies are actually bringing that information up because the projects are intending to pull the rug. And so if the auditing companies tell the project in their report that there's a potential for a rug pull, then they're not going to want to work with them. So like finding companies that are unbiased, that really pride themselves in the work that they do is, I think, very, very important. And we're going to see a shakeout in the whole security space for the blockchain space, just because there's been a lot of abuses lately. And I think people will realize that, getting a stamp of approval from someone isn't everything. It doesn't really mean much in many cases. Sorry.
Thank you, Ivan. I think very legit point, guys. Just one idea, Konstantin. What to do? How to improve?
Well, I think first of all, I don't think we can regulate DeFi. That's not right. I think it should be community-driven and community-based. And again, there shouldn't be a central party that prescribes who's good, who's not. However, if there was a transparent way of showing which projects are for the good and for the long run, then I believe the community will make a decision for them, and it just will not be. It will not make any financial sense to launder money through a project because community will know about it and nobody will come to you. So I think it's a natural way. We just need to find a process to make it transparent and simple.
Yeah, thank you. I agree. But the information on CoinGecko, it's not about regulation. It's about transparency and education.
Exactly.
Yeah, Maria, last word.
Yeah, and the last words probably about the centralized exchanges. Well, I'd like very much that everyone would be playing by the rules as we are playing, and that would be amazing, and that will definitely make our life easier, not only with the hacks, but with everything else.
Thank you. I want to sign at every single word. We're on the same page. All right, guys. Hope to see you next year, same place. It's a great conference event. Bye-bye.
Bye.
Thanks, everyone. Bye-bye.
Thank you very much, guys. Security issues discussion panel is over, but we have 2 speakers more. So please, we really want some power to have these 2 amazing speakers. So we are moving on to our final section. its regulation and legal issues. And the first speaker will be from Aave, the top project. Do you agree with me? The topic is how DeFi is solving the stakeholder problem in finance. And we are welcome Ajit Tripathi. 20 minutes. Enjoy presentation from Aave.
Ajit Tripathi, Head of Institutional Business at Aave, a London-based technology company focused on creating a transparent and open infrastructure for decentralized finance.
Hi, it's been a while since I did a conference on anything except Zoom, so this is quite a nice experience. Thank you for inviting us to present and talk at this event. It seems to have been really put together very well, for which I should congratulate the organizers for putting up a great show. Now, so my role, just to give a bit of background about myself, I've been in the whole blockchain and crypto space since 2015 January. So I used to I built the PwC's blockchain business back in 2015 when it was very early days, and that was the time when institutions didn't really want to talk about Bitcoin, right? So if you ended up in a meeting with a bank and you said, "Hey, you guys should look into Bitcoin," then they would look at, "What the hell are you talking about?" And everyone wanted to talk about DLT, which is kind of private enterprise blockchains and so on and so forth. So that was 2015. Then at that time, we did a really interesting project on Ethereum with the Bank of England, which is UK's central bank, and they were quite interested in the technology, but more from a central bank digital currency point of view. Then I went to Consensus and built out the Fintech, played a major role in building out the Fintech business and the London office for Consensus. After that, then the bear market hit us really badly. And Ethereum wasn't quite clear where Ethereum was going to go, but I think the developer interest was only growing. The 2018, 2019, is when institutions started to look at it, and everyone was talking about institutional wall of money. The wall of money is coming, and every day on Twitter, everyone was sort of talking about it. But not a lot was happening, except builders were building infrastructure in the back end. There were lots of companies building crypto custody. There were some early days with Coinbase Pro and Kraken Pro and other folks starting to build institutional venues. Then the DeFi movement, the folks like Stani, Jordan, they've been in the space for 4 years in the DeFi space. They were building a great product, and other builders as well, right? Uniswap, Synthetics, and so on. Quite a few interesting engineers building really, really great and interesting product, but there wasn't a lot of attention on DeFi, and a lot of us, who went to DevCon were very early. And then the whole world shifted to digital. In 2020, everyone became locked in their houses, and then we started using Zoom a lot more. Everyone became comfortable with remote access. The interest in everything digital just went up, right? So fintechs did really well in 2020 after the March crash. It suddenly picked up. Then, Aave was relaunched around Jan as a sort of a pooled lending protocol, or what we now call a liquidity protocol, because the users are much broader than lending. And somewhere around around March, the whole interest in DeFi started to pick up tremendously, and DeFi now has gone from 600 million to what, almost 40-50 billion in TVL on any given day. Easily similar 40 billion odd in market cap for tokens. So I think the question is, where do we go from here? And obviously, there has been some discussion about regulation today. Now, what I do for Aave is institutional, DeFi. So it's still early in my space. But what does that institutional really mean, right? Because if you look at Bitcoin, so Bitcoin was the first digital asset we all know. Bitcoin is basically a bearer asset. There have been some enhancements to it, but you can't really do a lot with Bitcoin, right? I mean, it's basically an asset. You can hodl, you can pay with it. That's great. Now, then comes along Ethereum as a developer platform. Sure, you can build some interesting applications on that. That's great. Then comes along, then come along things like Flow Protocol and so on, where you kind of build NFTs and some other applications that are not necessarily for crypto native people. They even anyone, any artist, musician, whoever can use some of those applications on either Ethereum, Flow, or whatever it is, right? So that's the next generation. Then DeFi, and that's the time when we're doing CryptoKitties, asteroid mining and whatnot. And a lot of moonshot projects were going on at the time, like token curated registries and whatnot. So I've seen kind of 3 or 4 bull and bear markets now. And in crypto, you never know on any given day where you are. So now institutional has a few things, right? So institutional is about, so what characterizes retail from institutional? The first thing is a lot of lawyers, right? So as soon as you get into institutional, so you're dealing with 2 things. Either institutions have their own money, which we call proprietary, or it's client money, other people's money. So things like asset managers managing other people's money, family offices managing some, or private wealth institutions managing rich people's money. And at the far end, you have retail, which is the likes of Revolut, Monzo, whoever. And these are, typically customers that require a lot of protections, right? So because on one hand, it's great that everyone can now invest on Robinhood and trade freely. There is all this democratization of risk taking. Anyone can do whatever they want. But at the same time, that looks great in a bull market. That doesn't look so great in a bear market. So what happens is, retail customers love to trade and speculate, and when things are going up, and they want to be let alone to do everything they want to do. But when the markets start to crash, then it's the same investors that then are complaining to regulators. And I spent 6 months at Binance doing some fiat on-ramp work, and one thing I learned is that retail customers tend to be very bullish on the upside, and then they tend to ask for a lot of legal and regulatory protection on the downside. So institutional across when it comes to managing other people's money, and when we take institutional in that sense, asset managers, hedge funds, so on, then there are requirements, right? And those legal and regulatory requirements are designed to protect investors. So on the upside, great. On the downside, we need protection. We all want regulation, right? So that creates some interesting challenges. Now, since 1933, when the US installed the Securities and Exchange Act, there has been a lot of regulation, right? And especially since the financial crisis in 2008, there has been more regulation created than in the previous 100 years before that. So I used to work in compliance and regulatory change for PwC part-time, and in addition to my blockchain job, and it was all about rules, and new rules created to fix the old rules that weren't working. So all of those rules have a good intention, right? They're designed to protect investors from things like scams, from losing money, from being taken for a ride by unscrupulous actors, and and so on and so forth. So a lot of rules have good intent, and especially when things are not going well in markets, then all of those rules come in very handy for a lot of small investors who don't always know what they're buying, right? So right now, everyone is chasing the same. Every crypto currency is going up. It's great, but when it's not going up, then investors want protection. So and we saw that with GameStop and whatnot, right? And now, so institutional is basically you take the current technology and product, that's great. Now you start to think about regulation. And what are those regulatory areas? There is obviously KYC, which is who is actually investing, who is actually doing things. There is AML, which is, things like transaction monitoring. Is there like criminal money getting into this? And yeah, sure. And there is a whole aspect of censorship resistance where you want to, make sure that people who are protesting regimes like Venezuela, or are suffering in failed economies, are not restricted by oppressive governments from participating in Bitcoin or public blockchain applications. So that's very, very important. But it's very hard to draw a line between that and, so let's say criminal money or not necessarily, sort of money from good actors in the ecosystem. So regulators have a hard job on their hands. So do innovators, right? So innovators, if all of the innovation today has to follow all the rules that have been built since in the last 400 years, then there will be no innovation. Whereas if no rules are followed, then also there will be no innovation. And if Coinbase, Coinbase wouldn't have scaled if they hadn't got a good compliance program. Coinbase wouldn't have scaled if they hadn't got the right UX, customer service, asset protection, so on and so forth. So to scale beyond where DeFi is today, right, and to go from, let's say, 40 billion to 1 trillion in TVL and assets, there is going to be more regulation. I mean, that's not something that I think anyone should try to avoid. So what I do on my in my day job is sort of 3 or 4 things. One is I do a lot of work, or we do a lot of work on working with institutions to understand their requirements and needs. Right. So what we are committed to is public permissionless blockchain applications. This whole DLT, deploying a blockchain inside somebody's firewalls, that's not a thing, right? Then blockchain doesn't necessarily add a lot of value. So it has to be public permissionless blockchain. It has to be smart contracts on the public blockchain. It has to be decentralized, as in it should not be controlled by a bank or 1 or 2 rich people. Or some guy who runs a large exchange or something. It should be governed by a broad community of lots of token holders that have, some stake in the well-being of the protocol. And no one particular party should have a lot of, says, because then it's not decentralized, right? If one guy can vote in whatever proposals, then it's not decentralized. So institutions actually like decentralization from a customer asset protection perspective. And when we think of decentralization in those terms, I haven't had anyone in our sort of partner base or anyone say, look, this is not a good idea, or decentralization is not a good idea. So decentralization is actually a good thing from a regulatory perspective. Now, the challenges that are created because of that are, who is liable? So a DAO is not necessarily a legal person. If something goes wrong, then you cannot take a DAO to court. Or all the DAO members who are voting on a DAO, will they accept liability, and will they want to be represented in court? So I think some of those legal questions are things that regulators are thinking very closely about, and institutional market participants are also informing that. Then custodians have a central role in asset protection. Right now DeFi is by definition self-custodial. Right. So, but at the same time, self-custodial doesn't work for everyone, right? So self-custodial is great for me. I know what to do with my private keys. I know what to do with my wallets. I know what to do with my 24 words. Now, for a lot of, let's say customers who are not as tech savvy or are not necessarily engineers, it takes a lot of training and education and informing. And then, they would rather not lose their Bitcoin, right? They would rather not lose their tokens. So when you ask them to prioritize, then a lot of retail customers retail customers who come in through institutions want asset protection more than self-custody. So DeFi, being financial infrastructure, needs to serve all individuals, right? So if some people prefer to custody their own assets, like me, great. If some people want to go through Revolut or wallets or so on, then they should have that option. So ultimately, everyone should have choice, and DeFi is about consumer choice. So what's happening today is that today there was an announcement about a Nash wallet integrating with Aave. So Aave is a decentralized protocol, which means anyone can build. The source code is online. The liquidity is on the public internet. So Nash created a wallet which essentially allows. They do the KYC, they onboard retail customers, but they can use Aave as an infrastructure in the background. And Aave sort of becomes this pool of liquidity, which provides sort of high interest rates to Nash's customers in an environment where the yields are very, very low, or almost zero interest rates. So it's an opportunity for customers. And then the role of the protocol is to be like Bitcoin, right? So Bitcoin is infrastructure. Ethereum is infrastructure. Similarly, DeFi is also infrastructure. It's just an evolution of the same digital asset world. So that's kind of how we see it now. On the more hedge fund, large, the Goldman Sachs side of the world. So custodians have a critical role because custodians do take responsibility for a lot of compliance and asset protection. So they do the KYC, they do transaction monitoring, they sign legal contracts with sort of customers saying they will protect those assets, right? And sort of make sure they have the right controls in place and so on and so forth. So custodians become the gatekeepers. And of course, in the original vision of Bitcoin, we don't want a lot of gatekeepers, right? But again, is that more important, or is consumer choice more important? So at the end of the day, consumers should have the choice. If they want to use an app, they want to use MetaMask directly, they want to use a hardware wallet, or they want to use a custodian. So it's not up to us as infrastructure builders, it's up to the customers, and that's great, right? Consumers and users. So they get to decide how they want to interact with the protocol. Now, and it's the same as Bitcoin, right? Some people prefer to use Bitcoin through a custodian, and that's perfect. So DeFi now on the other thing is insurance, right? So DeFi has had a little bit of headline risk. We obsess with security. We spend more time and money on security than on almost anything else. And that's because, it's kind of our responsibility as the DeFi community to make sure that we treat assets with the responsibility that comes with those, people trusting us with their assets. And that's the only way DeFi will scale. If we don't take that responsibility seriously as developers and engineers, then, people won't trust in the tech and as much as they should be doing. So that's so security. We have done 5 audits. We have done formal verification. Our community spends a lot of time on providing feedback on various risk parameters and so on, and that's something institutions value. So now this is a very cool phenomenon where the interests of individual customers and institutional customers start to align, and that hasn't been the case in banking for a long time. So what happens today in banking is that managers and shareholders win and everybody else pays, right? So banks take a lot of risk, and then there is a big financial crisis, or banks decide to charge customers for things that they didn't tell them about. There's no transparency. So what DeFi is doing is sort of solving that stakeholder problem, because now if you are a stakeholder in DeFi, then you have an incentive to work to sort of look after the protocol, make sure you know what you're getting into. And initially it was all apes and degens, but now with a lot of sort of lawyers, regulators, institutions, sort of ordinary non-technical people coming into the space, that sort of stakeholder alignment is starting to happen more and more. Now, historically, and what does this do, right? So first of all, DeFi is open source. All the tech is on chain. The code is on GitHub. Risk parameters are online. Documentation is online. If you don't trust the documentation, you can go read the code. If you have a proposal on Aave, you can make that proposal, right? So if you want the protocol to change in some way, you can get voting power from someone else. You don't need to buy a lot of tokens. So we take this decentralization responsibility very, very seriously, because that's kind of how the incentives get aligned. And incentive alignment solves the stakeholder problem, right? So right now, banks have an incentive to do whatever they want to do behind the firewall or behind their walls with 5 guys sitting in a closed room making decisions. That's not how DeFi works. In DeFi, if you have bad code, it'll get hacked. If you have if you haven't done proper testing and you're testing in prod, bad things will happen. So whereas if a protocol is completely centralized and someone owns 80% of the tokens, you can't hide that, right? People will know about it because it's all on chain. So what that does is everyone who is participating in a DeFi protocol like Aave has an incentive to secure the protocol, has an incentive to come up with ideas that sort of help the protocols evolve and scale and create new applications on top of that. So that's a fundamentally new way of architecting financial services. And when we talk to regulators, and policymakers about this idea that, look, instead of creating more and more rules and paper that people can hide behind and align with the language of the law, but not necessarily the spirit of the law, why don't we create this, the DeFi as sort of the transparent infrastructure that anyone can look at, that is completely not hidden. It's in front of everyone. It's transparent. The logic is there. If there is anything dodgy with it, you kind of know about it, right? So that transparency is how stakeholder incentives are aligned, because if you're a user, and you can see what's going on. If you're a developer, you can see what's going on. If you're an investor, you know exactly what's going on because you have a lot to lot at stake. So this sort of what I've seen as coming in from traditional financial services and getting into DeFi is that this transparency of logic has created a lot of stakeholder alignment, which hasn't been the case, and that's kind of in my mind, across individuals, institutions, regulators, and everyone else, we are starting to see that, and that's something we look to drive in the future as well. That's pretty much it from me.
We are here in our studio. We have one speaker left. The last one, but not the least one for sure. He's an amazing speaker, one of my favorite, to be honest. So his topic for 20-minute presentation will be the law of DAOs, and it's Gordon Einstein, Crypto Law Partners, and we have 20 minutes presentation, the last presentation that we have in our conference, and I think it's great to finalize, to wrap up our conference with this presentation. Let's rock.
Gordon Einstein, founding partner at Crypto Law Partners, an international practice law firm providing professional legal services, blockchain, crypto, and other high-tech startups, ventures, and investment funds.
Hey everyone, it's Gordon Einstein. I am in Dubai, and it's my pleasure and honor to be here. And Natalie, thank you so much for the invitation. I really appreciate it. I thought the last speaker was very interesting because he mentioned some topics I'll be touching on, which is the involvement of lawyers in certain areas and whether or not that's a good or bad thing, and also the advent of DAOs, decentralized autonomous organizations, and how they might relate to DeFi and these other ventures. My presentation is going to be relatively brief. It's going to just sort of touch on an overview of the law of DAOs, the law of decentralized autonomous organizations, how one might use them, what's the origin of a DAO, how one might use them, the pros and the cons, and sort of their evolutionary status over time. And I'm honored to be the last speaker of the show. So I'm going to share my screen. I'm going to get my PowerPoint going, and I will try to keep an eye on the chat. So hopefully you're all out there in cyberspace watching. Let's see, here we go here. Let me maximize the screen. Give me a moment, please, guys. Application window, there you go. One sec. I'm battling multiple screens. Oh, that should work, hopefully. Great. All right, let me just make that full screen. Oops. Oh my gosh, it worked. Amazing. Okay, so it's protecting your DAO from legal attacks. I'll skip the sort of early stuff, but just basically I'm a lawyer, but I'm not your lawyer necessarily. Don't take this as legal advice. It's just a general overview. But I can tell you all, don't commit crime. How's that for easy? Okay, so what are DAOs? What does a DAO stand for? The term DAO. It stands for a decentralized autonomous organization. And what does that actually mean? Well, as most of us are probably familiar with at this point, it's a way of organizing group behavior and group governance and group cooperation on the blockchain. Now, groups have been around for a long time. Humans, it's very hard to be successful as an individual human, as an individual actor. And as life and society becomes more complex, it becomes progressively more difficult to do things as an individual. Humans naturally form groups to get big tasks done. There's a whole philosophy about how you can accomplish large things, whether it's Max Weber coming up with the idea of a bureaucracy, or the idea of a nation, or the idea of a tribe, or the idea of a corporation, or a community, or a church, or an association. Just human beings naturally form groups, both for self-protection. There's a famous quote that I like, which is, we cooperate in order to compete. You can't cooperate just with yourself. You need to cooperate in a group. But what's neat about blockchain and what's neat about smart contracts is that they enable new forms of group organization, new forms of group activity to accomplish our goals. Now, why? What value do they add? Well, for the longest time, people either formed their groups in an ad hoc manner, meaning that they would sort of meet on the street or meet in a tribe and just do things based on certain sort of social understandings. And then in more recent human history, they've organized their group activities through legal forms, such as a company, such as a corporation, such as, say, if you're in Germany, a GmbH, or Aktiengesellschaft. There's all these different terms, or society, society limitada, if you're in a Spanish-speaking country. So there's these legal forms that allow us to perform activities, especially economic activities, but they have problems. They have problems because they're a little dated, they're a little long in the tooth, and they're not quite up to task to handle our global blockchain-based, high-tech, high-moving distributed world. So the idea of porting over group activity and group coordination onto the blockchain, onto this decentralized network is proving attractive, hence the DAOs. And so let's take a little historical back. What is a firm? And by firm, I mean, what is a company that's formed in order to conduct business? Well, sure, it's potentially a legal form, such as in America, you might have a Delaware corporation. But there's an economic philosophy behind it also, which is that a firm is basically a nexus of contracts. There's something called the theory of the firm, which is just that a company is just the aggregation of its contracts, maybe even its smart contracts. So can a DAO, can an organization that's living entirely on the blockchain be acknowledged as, if not a legal firm, as a sort of traditional economic model of a firm? And the answer is maybe on a theoretical basis, but not necessarily on a legal basis. Because yes, these DAOs can be a nexus of smart contracts. Yes, they kind of fit the model or idea of a firm, but are they really legal people? Are they really legally recognized? And the answer is no, not yet. No, why is that? Why is it the case that I can form, for example, a Nevada limited liability company, but I can't form a Nevada DAO that lives on the blockchain? Well, the simple answer is that you can't automatically take onto yourself certain corporate forms. You can't automatically take onto yourself certain company forms. It is a mandate or a license that's granted by the state to individuals who want to work together, such that another legal person is created, such that a corporation is created. So in the world we live in now, in 2021, for the moment, there's no such legal thing as a DAO that has a unique legal personality or legal characteristic separate from its individual owners. The prior speaker was getting to that a little bit, about whether or not the members of a DAO can protect themselves from liability or take on liability or enter into contracts. The answer is, at the moment, not really, but maybe they should. One of the things I'm working on is the idea that we can push out this idea of legally recognized DAOs on the blockchain. So why does legal personhood matter? Why do we want this? Why do we care about what governments think? There's an argument that maybe we shouldn't. Maybe we should just move beyond the state, move beyond governments, move beyond traditional methods, set up economic organizations on the blockchain and just do what we want. And I have to admit, I feel a certain sympathy for that point of view. I would like to get to a world where governments don't grant the ability to act as a company or act as a corporation, but that's not 2021. In 2021, you need legal personhood. So what's reason number one? Well, once you get a group of people, how do you enter into contracts? How do you get into legal relationships? You need some sort of legal entity in order to be a counterparty to a contract. Right now, it's not really plausible that a DAO can be a counterparty to a contract. And on one hand, that's good because maybe someone can't enforce something against you. But on the other hand, contracts are great. They can make you insure yourself, get employees, pay people, plan for the future. Unless you're doing ad hoc barter-like exchanges, you need contracts in order to guarantee mutual performance over time into the future. Also, it's one thing when you have 2, 3, 4, 5 people trying to work as a team. That's maybe manageable without some kind of corporate form. But when you're working at scale, when you're working at the size of an IBM or a Microsoft or a Google or something, you need legal functionality to allow people to coordinate at that scale. And that only is possible through legal personhood that's granted by the state. And you get into all sorts of related topics like, could a DAO lease an office? Well, right now, a DAO could not lease an office. A DAO can't technically employ someone. It may be able to pay someone, but can't employ them in the legal sense. It can't create intellectual property and have that intellectual property clearly owned by the DAO. It can't necessarily license that property. It can't get insurance. And insurance matters. I mean, it's one thing when you're a rebel and no one knows who you are and you can just kind of cause all this potential harm to other people. But if you're trying to operate at scale and own real property in the real world, you need to have insurance. And at the moment, DAOs can't do all these things. Yet DAOs are very attractive because they allow all this functionality that isn't presently available with traditional legal forms. So what do you do about it? Well, you do have some options. And I'm just going to cover this at sort of a high level. One option is just not to worry about it and just operate on the blockchain, ignore governments, and make your money quickly and stay anonymous and hide after you make your money and live a good life. That's possible. People have done that. I think they did that a lot earlier in the crypto world, in the crypto times. But these days, it's dangerous because governments are aware of what's going on and they're watching. So you have to make a real strategic decision about whether you want to live your life that way. I can't really recommend that as a lawyer, to be honest. And even though part of me has an anarchist soul, that's not really what I'm proposing to my clients. What I'm proposing to my clients is that they form some sort of traditional legal entity that is tied to or tethered to the DAO, that takes directions from the DAO, and that legal entity can enter into contracts on behalf of that DAO, can create and license intellectual property on behalf of that DAO, can create employment relationships, can get insurance. And we've actually made a decent amount of progress in this idea of creating a parallel legal entity to handle the DAO's legal affairs, such that the DAO can conduct operations in the real world. Excuse me. It's almost like the DAO is the mind and the legal operation is the body, or the DAO is the brain and legal operation is the body, so that there's a way for this thought process that's happening up on the blockchain to have a real life impact on the world. So what kind of legal form would you want to create to represent your DAO? There's of course many permutations out there. One thing I've been working on a lot is various forms of Swiss entities. Switzerland has pretty advanced law relating to crypto entities, and traditionally people have been looking at Swiss foundations. Swiss foundations are good for software development. They're good for managing grants. They're good for sort of continuity over time where you don't need something to change. The newer thing we've been looking at that maybe doesn't replace foundations, but it augments your selections, is to form a Swiss nonprofit association. The word for an association in German, which is one of the primary languages in Switzerland, is a Verein. So if you want to look up the legal law about associations in Switzerland, just Google, Schweizer Verein or something like that. Those are a little bit more flexible than foundations. Foundations tend to have a locked-in board of directors that doesn't change so often, and foundations tend to have a locked-in legal mandate that's very difficult to change. Associations are more flexible in that they can have members, just like a regular association can, not just a board, and that they can evolve their mission over time. And you can have decisions made by the membership rather than a very narrow board, which kind of matches the idea of a DAO. When you think of a DAO, you don't think about 4 or 5 people running this distributed organization, because otherwise, why would you even have a DAO? A DAO evokes the idea of tens, hundreds, or even thousands of people or entities or robots, who knows, interacting with each other on sort of an ad hoc basis, coming and going, having the option to do something, but not necessarily doing something. So I think the idea of an association more closely matches what we think of when we think of a DAO than a foundation does. So I would encourage everyone who's watching this, who's interested in DAOs and creating legal representation for DAOs, to take a look at associations, specifically Swiss associations, because they seem pretty functional. And I think that's a good overview of DAOs and how you want to approach things. I think I'll add in there also that when you're coming to DeFi, you don't necessarily need a DAO. You don't necessarily need a foundation. You don't necessarily need an association, but they're potentially useful. If you want to get out of whenever you have one person running a platform, whether it's Uniswap or Sushi Swap or whatever it is, whenever you have a single person running a platform, if that person is well-intentioned, if they're like a Vitalik, that's okay. But there's always the problem of an exit scam or a mistake that can be made by one person, and that leaves your organization vulnerable. You do need, if you're trying to create a system that has legs or has governance over time, you really do need to go down the DAO route. And do you necessarily need a parallel legal organization in the real world to represent your DeFi project? Not necessarily. You might be able to just get away with a DAO, but to the extent you want your DeFi project to have real world interaction or to be able to work through gateways, especially gateways into fiat world, it could be potentially useful to have a legal form like an association that takes its direction from and is dependent upon the DeFi platform and the DAO that's behind there, but nonetheless can enter into contracts, can nonetheless interact with regulators, and can form law and do all sorts of neat things. So this is an evolving area, obviously. I encourage anyone who's interested in this to reach out to me. I'm heavily involved with a Swiss association, nonprofit association called the Emerging Technology Association. I'll say that again, the Emerging Technology Association. It's ETA, it's emergingtech.ch. We're really exploring this idea of creating a legal framework for DAOs, a legal framework for forms that are associated with DAOs, so that we can push regulation forward and allow DAOs to do things that traditional companies or corporations can. So I don't know if we have any time for questions. I'm going to stop sharing my screen, or try to. And let's see if there's anything in the chat or anything we can hit. Or Natalie, do you want to jump in and let me know?
Warren, thank you very much for your presentation. We don't have any questions. So
that was pretty fast, but you know, it's a big topic, and I just wanted to kind of hit it.
Of
And
course.
I know I'm the last speaker, so I want everyone to go enjoy their beers wherever they are.
Yes, thank you very much once again for jumping into this presentation, into this conference. So I hope you enjoy your time in Dubai, and I hope to see you soon in Ukraine. So thanks once again.
Well, actually, it's funny you say that. I am heading off to. I have an ultimate destination, which is not Ukraine, but I'm stopping on Ukraine on the way to that destination. So I'm off in 2 days. So I will see you there.
See you there. Thank you. Bye bye.
Go. Thank you. Have a great night. Thank you so much. Appreciate it. Bye.
We are here back to our studio, and I would like to say thanks to all our audience, to all our speakers, to all our partners. We really appreciate your time, your efforts to being with us today, the whole day, 7 hours. So thanks once again. Hello from Ukraine and from all our team here. Yeah.
Hello.
Thank you.